Yes, let's begin the next topic, capital gains. Okay, for the financial year 24-25, nothing but the students who are writing exams in assessment year 25-26, May 25, September 25, Jan 26, these three attempt students, capital gains is toughest chapter for these three attempt students only. For next attempt onwards, May 26 onwards, like those who are writing exams in assessment year 26-27, May 26, September 26 and Jan 27, capital gains is an easy moderate chapter. Like why? Because there is an amendment called 23rd July 2024. One amendment is there. Yeah. One amendment is there. One amendment, just a minute. Yes. So there is an amendment called something called 23rd July 2024. One date is there. I don't know how many of you know this. See, one point I just want to tell. Forget whatever capital gains, if at all you know earlier. Forget everything. Throw it out. And I prove that whatever you know is completely vague. Okay. I will prove it so easy, the capital gains chapter, crystal clear. Okay. No confusion at all. Crystal clear principles. But as I told, assessment year 24-25, capital gains chapter is the toughest chapter for assessment year 25-26. May 25, September 25, Jan 26. For these three attempt students, capital gain is toughest. Option number 1, which I recommend, is leave this chapter. Those of you who are not listening to my class, okay, tell your friends also. Those of you listening to my class and ready to take little stress, very attentive, you can take this. I guarantee whatever question comes, you will write. I guarantee whatever question comes, you will pakka get full out of full. And one normal notion among all the students, since capital gains contain lot of amendments, mini marks, no, 8 marks only will come max. Every attempt also 8 marks only will come. Now also 8 marks only will come. Maybe if it comes, 2 marks extra might come. Whether it might come as part of MCQ or descriptive, we don't know. That's it. That's the only difference. Okay. The weightage of the chapter will be always same only. Worst case 10 or even worst case 12. Not beyond that. Mark my word. Go and see the May paper, September paper, Jan paper. You will not have a marks more than 10 to 12 on capital gains. That's it. Clear? So every attempt also it is 8 to 10 only. 6, sometimes 6 marks, sometimes 8 to 10. Average 8 on capital gains. Okay. Average is 6 to 8. I can say that. Fine. Now, so see, the approach in which I'm going in capital gains is completely different. In the sense, there is a way to learn this chapter. Okay. First of all, when capital gains apply charging section, all that, okay, I know I know capital gains charging section is there. Okay, first we will see the charging section. You see, many think that charging section is 45. No, charging section is 45 subsection 1 only. Main charging section is 45 subsection 1. 45 has so many subsections. By the way, in capital gains, the section that we are going to discuss is from 45 to 55A. 56 onwards, other sources will start. 56 onwards, other sources will start. Now, what is the main charging section? First, let us read and then interpret the entire chapter, how we are going to discuss. Okay. Any profits and gains, or profits or gains, whether you call profit or gain, doesn't matter. Don't interpret on that. Okay. Both are used interchangeably. Okay. Any profits or gains arising from the transfer of a capital asset. Any profits or gains arising from transfer of a capital asset affected in the previous year. Previous year means what? Relevant to previous year. For example, you are all writing exams based on previous year 24-25. If the capital asset is transferred in that year, shall be chargeable to tax. Shall be taxable in the year of when it is taxable. In the respective year itself it is taxable. In other words, in the assessment year you have to pay tax on it. Understood? For 24-25 year it is taxable. In assessment year you have to pay tax on it. On what you need to pay tax? What is taxable? Profit is only taxable here, not the sale proceed. Not the sale proceed. Profit only taxable. Any profit arising on transfer of a capital asset. What are you transferring? Capital asset. Now, what is a capital asset? Here there is a big definition given, but many will only interpret very normally. Capital assets can be two types. Capital assets are two types. Very simple. Capital asset means something other than. Okay, first let me discuss in a general way. SSCs are two types basically. Business or profession SSCs, other SSCs. Other SSCs, any asset they have, okay, any asset which they have, just look at this, any asset which they have other than movable personal effect, other than movable personal effect. Personal effect means what? It's a movable item used for personal purpose. Okay, it's a movable item used for personal purpose. But personal effect definition does not include jewelry, archaeological collection, painting, drawing, sculpture, any other work of art. I'll come back to it later. Okay, simple. For any other SSE, any asset that he owns is a capital asset. Any asset. Sir, the SSE is a business SSE. Then for a person who is doing business, no, okay, for him we divide the assets into two types. Business assets, non-business assets. Non-business assets means what? My wife is wearing jewelry, I am wearing some jewelry, I'm having my car, all that. These are all non-business assets, for example. Not used for business related, they are not business related. My residential house, these are all non-business. Same logic will apply here also. What are capital assets? Non-business assets are by default all are capital assets except movable personal effects. All non-business assets are all non-business related assets except movable personal effects are capital assets. Understood? Sir, business assets, sir. Business assets are again two types from income tax point of view. Depreciable assets, non-depreciable assets, and there is another type called stock in trade. Inventory, raw material, work in progress, stock in trade. This is also an asset. This is also an asset. This is also an asset. And there is another type of asset called financial assets. Financial assets, cash and bank balances, all that. Getting the point? Fine. Let me not classify financial asset discussion. Okay, these three remaining assets are broadly classified under these three categories: depreciable, non-depreciable, stock in trade. Stock in trade is not a capital asset. Stock in trade is not a capital asset. Depreciable assets, yes, it's a capital asset. Non-depreciable assets is a capital asset. And if you recollect in PGBP, depreciable assets will be classified under block of asset in case of normal companies. In case of electricity companies, either it is block of asset or a straight line method asset wise. And we already completed depreciable assets, how to compute capital gain, section 50 and section 50A. Remember, in PGBP, block of asset wise. For depreciable assets are not identified asset wise, but it is identified block wise. And capital gains are computed block wise. As on 31st March, block is existing, value is there, depreciation will apply. As on 31st March, full block sold, capital gain or capital loss, short term. Remember, in PGBP we covered. Okay, so typically speaking, assets are broadly divided into two types. Now I discussed originally into business and non-business, all that. Assets are now broadly divided into two types: business assets, non-business assets. All non-business assets are capital assets other than personal effect. Agreed? That's what I told right now also as a whole. Business assets are again two types. Okay, business assets are again two types: other than stock in trade and stock in trade, correct? Other than stock in trade, again two types, depreciable assets, non-depreciable assets. Are you clear, everybody? And what about non-business assets? By default, all of them are non-depreciable assets. By default, all of them are non-depreciable because, array, my residential house here, that's not a depreciable asset. Sir, house will depreciate. No, I will not claim depreciation. No. Under income tax, what is depreciable asset? You know, on that you can claim depreciation. Any asset on which you can claim depreciation, that is called depreciable asset under section 32. If that asset comes under 32, then only it's a depreciable asset. Sir, I have a residential house, sir. The value depreciates, but that is not treated as a depreciable assets. Why? My personal house property residential, it is not coming under section 32 power. It is not coming under business or profession. So it is treated as non-depreciable asset. Sir, why you were discussing in this context? Previously also I know about capital asset, but why are you discussing in this context? Very simple. For depreciable assets, the capital gains is computed as per 50. For non-depreciable assets, capital gains are computed as per 48. That's the major difference. Depreciable assets, no, capital gains has to be computed as per section 50, which we already did. For non-depreciable assets, the computation mechanism is different. And tell me, in PGBP, house property, everywhere we saw how to compute capital gains. How to compute profit under each head. Gross income minus deductions is equal to income. Here also the same thing. Depreciable assets, sir, amount received how much? Minus gross block value is equal to income. This is no receipt minus the value of the asset given. Balance is income. Just that names are different. Amount received on part of a block more than gross block value, that's a short-term capital gain, income. Yes or no? Amount received on full block less than block value, that's a short-term capital loss. Amount received on full block more than gross block value, that's a gain. Format is same always, names are different. Yes or no? Now non-depreciable assets, how to compute? Same. Consideration how much here? Minus you purchased at what price here? Did you make any capital improvements? Okay, acquisition cost to improvement cost, you remove, balance is capital gain, over. Computation of capital gain is very simple. No much complication, same like any other head only. House property we did the same, gross value minus deduction net value, income. Salary, gross salary minus deduction taxable. PGBP, total incomes minus expenses deductions is equal to PGBP income. Capital gains also, income minus expense is equal to receipt minus expenditure is equal to income. That's it. But the names are different. So the first thing that you need to understand is, in capital gains, the computation that we need to do is different for depreciable assets and non-depreciable. When you're reading a question, if at all it's a business asset, depreciable asset, block values and all given, immediately you should remember section 50. Otherwise, you should throw that out. You should compute capital gains as per section 48. Are you clear? Apart from this, there is one more computation mechanism. There is a section called 50B, slump sale. What is it actually called as? Slump sale. What is slump sale? I will discuss later on. So that is one more computation mechanism. 3 computation mechanisms we have in capital gains. 1, depreciable asset, non-depreciable asset, and slump sale. That's it. So I hope now you got some idea. Now, you might have seen already, sir, capital gains in the basic concepts also we saw. What we saw? Capital gains are 2 types. What are they? Long-term capital gain, short-term capital gain. Sir, many a times we saw 112 capital gain, 112A capital gain, short-term capital gain also, 111A short-term capital gain, and other short-term capital gain. Like that we saw, correct? Yes or no? Now, what we know, sir, 112 capital gain, we know. Before amendment means what, you know? Before Before 23rd July 2024, the tax rate is 20%. On or after 23rd July, the tax rate is 12.5%. 112A, 112A, before amendment, the capital gain is 10%. After amendment, the capital gain is 12.5%. In both the cases, cumulatively, up to 1.25 lakh, up to 1.25 lakh, no tax. Yes or no? All of you, correct? This is what we covered. Hello? Yes or no? No, just a minute. You can pause the videos and then make a note. I will not give this PDF because I'm scribbling just like anything. Are you clear? Why I will not give PDF, I'll tell you. I can satisfy you and just export and then give you. I don't have a problem. Tomorrow it will be confusing for you. You unnecessarily waste your time without knowing. Everything is much more beautifully presented in the book already. Don't worry about it. That's the reason. And even in marathon is there, in that also you can watch. Okay, fine. So this will be confusing. Today it appears very attractive. Okay, very clear. Tomorrow after 1 week, if you again open this, it will be confusing. Unnecessarily you will waste half an hour and then you will realize I will read from the book only. I don't want your half an hour, 15 minutes also to waste. If you're sitting, it should be productive. Okay, so that's why if at all when I'm writing, when you feel anything important, please make a note of it. Are you clear, all of you? Then this is long-term capital gain tax rates. This is what we saw. Then there is another capital gain called short-term capital gain. By the way, look at long-term capital gain. There is a section called 112. By the way, remember, this is not constant. There are some situations, all that is there. We will discuss that. Depth we will discuss. We'll go. First, let me give you a brief introduction. What are we going to discuss? So, transfer before. By the way, capital gains arising before means nothing but sale is happened when before 23rd July. Before 23rd July means before 2022-23, like that. Array, we are doing problems in 24-25. In 24-25, 1st April 2024 to 31st March 2025. Within this, up to 23rd July. Sorry, before 23rd July, if a sale happened, long-term capital gain, that to 112, 20% tax rate. After 23rd July, tax rate is 12.5%. Here, no, with indexation. Here, without indexation. Sir, what is indexation? Don't worry, I will cover to it. Come back to it later. Okay, now 112A. 112A from the day one, right from introducing that section, no, there is no indexation. Listed shares and all, there is no indexation. Fine. Before 23rd July, 10%. On or after 23rd July, 12.5%. However, initial 1.25 lakh capital gain 112A in this entire year. First 1.25 lakh, no tax. After that, gain is there up to 23rd July, 10%. After 23rd July, 12.5%. Now, short-term capital gain. Short-term capital gain, there are two sections. 111A, one section only is there. Other short-term capital gain. 111A, again, before 23rd July, what is the tax rate? 15%. Now it is increased. Short-term capital gains. Hare, you're making short-term, pay me more tax, 20%. You see, long-term 12.5 only, but short-term 20. So government is taxing more who are doing more frequent trades. Many know they show it as a capital. Many know what they do. Earlier they show it as trading. Suppose if I'm a trader in shares, no, they don't show it in PGBP. They show it in capital gains listed shares. 15% they just pay, even though they are in 30% slab. Now department, what they did to prevent this, they increased the tax rate 20. And in order to reward more long-term people, okay, in order to reward long-term people, they're rewarding 12.5% only. Remaining all other short-term capital gains, no rate is given. If a particular income, if a no rate is given, that income is called as normal rate. That income is taxable at what rate? Normal. Suppose if the SS is individual, slab rates, that income will be taxable. Clear? And remember, this normal short-term capital gain shall not be excluded from total income when you are determining surcharge limits. For determining surcharge limits, what incomes you will exclude? Dividend, short-term capital gain 111A, long-term capital gain 112, 112A. That's it. Clear? All of you? So we are going to discuss all these combinations. Are you getting it? Now, what is a capital asset? First, Now let's go back. Now let us discuss once from the capital asset order. Now you got an idea. Okay, yeah, so there are so many types of capital gains. There are so many types of rates. There are depreciable assets, there are non-depreciable assets. The formats are different. Understood overview of how we are going to discuss capital gains? Yes. Now what is a capital asset? Anything is a capital asset. That's what I told. No, other than it does not include stock in trade. Any asset is a capital asset other than stock in trade. That's what I told. So property of any kind held by the SSE, whether or not related to business or profession. Business asset is a capital asset. Non-business asset is also capital asset. Okay, yes or no? However, stock in trade is not a capital asset. Stock in trade is not a capital. So stock in trade business related. No, you said first point capital. No, stock in trade is specifically excluded. And remember, capital asset definition starts with means exhaustive definition. The definition is exhaustive. Only the following is capital asset. Any other asset, not a capital asset. And charging section will apply only if it is a capital asset. Charging section says what? Profit, capital asset, you are getting money, taxable. Suppose no, I am selling this phone. For example, I bought a phone. Okay, after 5 years, this phone got more demand because of some special features involved. For example, okay, I am selling this phone and I made a profit. It's a sale of asset and made a profit. That's not my business also. I made a profit. Nowhere in the income tax it is taxable. Why? When I sell my personal asset for profit, it's a capital receipt. To tax a capital receipt, there must be one section. There is no section till date in the income tax. To tax various capital receipts not covered under other heads, not covered under any of the head of income or any of the section. Getting it? If I made a capital receipt and made a profit on that, there is no head of income which is taxable. Fine. Anyhow, stock in trade is not a capital asset. Personal effects are also not capital assets. Personal effects means what? They are movable assets, yeah, and they're used for personal purpose. Movable assets, personal purpose. They are all personal effects. Personal effects are not at all capital. Sir, I'm wearing jewelry, sir. Movable, personal. No, that is not excluded. However, the following personal effects are treated as capital. The following are personal only. Still they are treated as capital. What are they? Jewelry, archaeological collection, drawing, painting, sculptures, any other work of art. So some valuable materialistic items, you know, if you observe, no, these are generally appreciating assets. These are generally appreciating assets. Appreciating assets, no, all of them are appreciating generally in nature. So appreciating personal assets are capital assets. Phone, depreciating. Personal laptop, depreciating. Car, depreciating. Personal, I'm talking. See, again, if the phone is in block of asset, it's a capital asset. Sir, phone is a capital asset, a personal asset. If I show this in income tax under block of asset as a business asset, it's a capital asset. Why? It's not personal, no. It's not personal, no. It's a business use, no. So, movable personal assets, movable assets will be there, right? Whether they are capital asset or non-capital asset, the question comes, if at all they are used for business, straight away capital asset. Because they form part of depreciable asset. Sir, my personal phone, sir, my personal car, sir, personal television, sir, bed, cart, yes or no, grinders, televisions, refrigerators, washing machines, what are all this? They are all personal assets, yeah, movable personal assets, sir. They are not for business. Sir, I have a refrigerator in office, sir. That's a depreciable asset. That's a depreciable asset. That's a business asset. Be careful. If paper has to be very tough, they will ask questions like this. Getting it? They are depreciable assets and they will be within the definition of capital asset. Because what is excluded in the definition? Personal effect is excluded. Movable asset, personal use. Sir, I have personal building, sir. Me and my family stay in my house. Personal, sir. What about that? It is not movable, right? It is not movable, right? So will exclusion apply? Will exclusion apply? No. When exclusion does not apply, automatically it is a capital asset. That's it. Are you getting it? So property of any kind, movable, immovable, tangible, intangible, doesn't matter. Every property is a capital asset here. Exclusions only not covered. Bottle covered under exclusion. Personal effective movable. Yes or no? This is not a depreciable asset, a capital asset like that. No, no longevity. This is not a capital asset. Yes or no? Remote, part of AC value. Personal purpose, house personal purpose, then it's a personal effect. Business purpose, it's a capital asset. Are you clear? So it depends on where are you using it. Are you clear? This is a consumable, we call it as, this is a consumable. Water bottles, all these are consumables. They are revenue expenditures. Clear, all of you? Understood? So personal effect. So what is not a capital asset? Only these items are not capital assets. Apart from that, there are few more. Rural agricultural land, I already told. When I'm discussing agricultural land, agriculture topic, I told that time itself. Rural agricultural land. Rural agricultural land means what? Land not situated in specified area. Specified area means what? Urban area. If a land is not situated in urban area, it is what? Rural area. Land is situated beyond 2 kilometers, the municipality population is less than 10,000. The land situated beyond 6 kilometers, the municipal population is less than 1 lakh or 10 lakhs. The land is situated beyond 8 kilometers, whatever population, doesn't matter. It's not a urban land. It's a rural agricultural land. Rural agricultural land is not a capital asset. This regarding this agriculture land discussion, mapping and all, we discussed in basic concepts itself. If any student directly watching this chapter, please do not watch directly. Please watch from the beginning. Okay, please watch in the order, the class. Don't directly come to capital gains. Yeah. Clear, all of you? Next, what is not a capital asset? You see exclusions, so many exclusions. Special gold bonds which are issued in 1977, 1980. Special bearer bonds which are issued in 1991. Gold deposits bond which are issued in 1999. Certificates under gold monetization scheme which is under 2015 or 2019. Gold monetization scheme related certificates or bonds. Gold monetization general is not called as a bond, it's called as a certificate. Gold monetization scheme is not a capital asset. Once again, you see, what is not a capital asset? Stock in trade is not a capital asset. Movable personal assets are not capital asset. However, these personal items, jewelry, archaeological, drawing, painting, sculpture, work of art, these are all still capital assets. Rural agricultural land is not a capital asset. You see, I clearly gave in orange color certain things and purple. Orange color only you remember. That is only important. These are all long back, 1990, all this, why irrelevant. Certificates issued under gold monetization scheme is not a capital asset. What is capital asset then? Anything is a capital asset other than that. Anything is a capital asset other than that. Now, gold monetization point, I will immediately tell one important clarification is there that I will tell you. Securities held by foreign institutional investors, special provision for them. Foreign institutional investor. Who are institutional investors? You know, banks, mutual fund companies, insurance companies. What are all these? These are all institutional investors. If you and me buy shares in stock market, no, we are called as retail investor. We are all who? Retail investor. A bank is investing, institutional investor. Insurance company, NBFCs, these are all institutional investors. Getting it? Which institution investor? Securities held? Foreign institutional investor. If a foreign bank is investing in Indian shares, if a foreign insurance company is investing in Indian shares and securities. Getting it? So securities held by foreign institutional investors is always capital asset. Sir, the bank is trading, sir, daily. The security they are trading. Foreign bank is buying and selling every day. Citibank is buying and selling every day shares. Still, it's a capital asset. They will never be called as stock in trade. In their books of accounts, they may show it as business. In their books of accounts, for them it is a business activity, revenue from operations, banks and all. No, it's a capital asset under income tax point of view. What about securities held by domestic institutional investors? It's a stock in trade. It's mostly stock in trade. Sir, Indian banks, Indian institutions are investing, sir. For them, it's a stock in trade. only for foreign institutional investors. Even though securities portfolio for them is a stock in trade, we will not apply that logic. We will always treat it as capital asset. Are you clear? So that's why you see, intention does not matter. How are they holding does not matter. Stock in trade is not a capital asset. However, other than securities held by FII. Sir, FII is saying it's a stock in trade. For you it is not excluded. Okay, for you it is always a capital asset. Understood until now? Next, what is also capital asset? ULIPs. Any ULIP to which 1010D exemption do not apply. Nothing but taxable ULIP policies. Taxable ULIP policies where annual premium that you are paying in any 1 year is more than 2.5 lakh. ULIP taxation we don't have in CA Inter. We will discuss it in CA final. ULIP taxation we do not have in CA Inter. Until now clear? Everybody? Yes. Now last exclusion is what? Certificate under gold monetization scheme certificate. Now you know there are actually relating to gold certificates are bonds are there are 3 types. Okay, right now what we have seen, certificate under gold monetization scheme 2015 or 2019, correct? Apart from this there is something called sovereign gold bonds. There is another concept called sovereign gold bonds. There is another concept called EGR, electronic gold receipt. One is sovereign gold bond, another one electronic gold receipt. Now these two are capital assets because they were not excluded. These two are capital assets, whereas certificates under gold monetization scheme is not a capital asset. Sir, what is a gold monetization? I mean sovereign gold bond, EGR, certificate under gold monetization scheme. What is the difference between all these 3? Very simple. Gold monetization scheme, what is it? You know, some bank will be given a power. What power? Dear bank, people will come to you. They will give you their gold. You melt it, convert it into biscuit, sell that biscuit or keep it with you, value the biscuit. Okay, the customer will give you ornaments or whatever gold he has, he will give it to you. Okay, identify the value of the gold. Suppose I'm a customer, I went to bank, took some 1 kg gold to the bank. Okay, I gave it to the bank. The banker told 90 lakhs is the value of the gold. Yeah, please keep it with you, sir. Give me a certificate for 90 lakhs. Bank will give you certificate. 10 years maturity. What is it? 10 years maturity period. That certificate, it's like a FD certificate. Gold monetization. Gold converting into money. Gold monetization. Are you getting it? So 10 years validity. Converted into 90 lakhs. Banker gave me certificate for 90 lakhs. He mentioned gold clearly 1 kg. This kg is important. Value 90 lakh that time. After 10 years, I will go back to bank. Again, give this certificate back. Give me back my 1 kg. Banker will give you. This 10 years, the asset is secure, no? Your gold is secure. Certificate is in your name. Even if you lost a certificate, nothing gone wrong. Nothing gonna happen. Your Aadhaar linking is there. Everything is safe. Now, this 10 years, what the bank will do, you know? What is the value of the gold? They identify at the time of certificate. Every year they'll pay 3%, 4%, 2.5% interest as per RBI guidelines. See, instead of keeping your gold idle, you convert it into money and give it to the bank. They'll give you interest also. After 10 years, again your gold is you're getting back. Market value appreciation you got back. Everything is there. Are you clear? So that is gold monetization certificate. Certificate given under gold monetization scheme is not a capital asset. Fine. What is electronic gold receipt? Electronic, you know, fine. Electronic gold receipt is another way. What is electronic gold receipt? This is another way for trading purpose. Technically, this scheme is different, this scheme is different. Okay, electronic gold receipt is a capital asset. What is it? Electronic gold receipt? Very simple. Physical gold is there, na? I'm converting it into digital gold. I'm converting it into a digital gold, not with a scheduled bank. With some NBFC, somebody is there. I'm converting that into a digital gold. Okay, so I have some gold, I convert into EGR. You are having EGR with you, you can sell anybody anytime, no restrictions, no conditions, you won't get any interest also, just that your physical gold is converted into EGR. Tomorrow if you want, you can sell EGR and then get back gold also, that is also there. It is also something similar to EGR only. But for gold monetization scheme, they excluded capital gains applicability, because in a gold monetization scheme, generally in a gold monetization scheme, what happens is the owner who created the certificate, he will only get back the maturity amount. Suppose no, I want to sell in between to somebody, I want to trade, then GMS, gold monetization scheme, is right option, not right option for you. You go with EGR. The point is, EGR is also treated as capital asset. You are selling EGR, you made a profit, that's capital gain. You sold an EGR, you made a profit, that's a capital gain. Now you are converting the gold into EGR, right? Conversion, that is not a transfer. That is not treated as a transfer. Fine, I will discuss transfer definition later. Are you getting it? EGR, you understood EGR? What is EGR? I will come back to it later more. SGB, what is SGB bonds? Sovereign gold bonds. We people buy gold, right? Why to invest in physical gold? Why to buy physical gold? Why to protect all that? And moreover, ornament and all, 12% to do, 12% to do, 20% to 25%, 30%. If the customer is illiterate, not knowledgeable on gold valuation, 30-40% and all he will lose. Getting it? So much fraud. Gold industry is very big fraud. If you don't know how to value the gold, you will be gone. Getting it? So, SGBs, you buy digital gold, no wastage at all. You have 1 lakh rupee, buy bond for 1 lakh. 1 lakh will be there. Grams also will be allocated. For 1 lakh, what is the market value? That grams. After 5 years or after 1 year, after 3 months, you want to sell. That many grams you will sell. SGB is like buying gold in digital format. Buying gold in digital format. That is also digital format only. Just that schemes are different. That is also a digital format. Sovereign gold bond. Okay. Sovereign gold bond you buy. It is just like that, buying physical gold only. You keep with you. Sovereign gold bond, 5 years or 10 years time limit is there. Wait for 5-10 years. Give it back the bond, you get back the gold. Give it back the bond and get back the gold. That is exempted. Why? I purchased gold long back here, 10 years back only. Bond they gave. Now I am collecting my physical gold. That's it. There is no transfer involved here. Okay, fine. This point again I will come back when I'm discussing transfer definition. Okay, when I'm discussing transfer definition, I'll come back. Okay, that's it. Understood? All of you? Now, so entire capital asset definition is completed. Easy or not? Now, jewelry, I have given some wordings here. You see jewelry. What is jewelry? Jewelry means, jewelry includes ornament made up of gold, silver, platinum or other precious metal without precious metal or semi-precious stones, metals worked as suvana into apparel, include precious, semi-precious stones, whether or not set in furniture. Everything is a jewelry. Agriculture discussion already we did in basic concepts. Refer concept number 10. I clearly told. Okay, agriculture, rural land I gave a hash mark. So there you go back and then see. Clear all of you? So jewelry. Are you clear? One important observation is silver utensils will be there, right? Silver utensils. Okay, in homes generally we use silver plates, silver glasses and all, which we use consumption purpose. Silver utensils is very common in India. They are not treated as capital asset. Silver utensils alone were not treated as capital asset, and that too it depends on case to case basis. Assessing officer will see on a case to case basis. Silver utensils used for personal purpose. Suppose I have silver utensil for wealth appreciation purpose, capital asset. Able to understand? You are using it for daily food eating, all that. That's not a capital asset. Clear? So these are all long back judgment. But gold utensils, they're always capital assets. That's it. Capital asset definition is over. Now remember, when capital gain set of income will apply, the capital gain set of income will apply when you transfer capital asset. What is capital asset? We understood. Now we need to understand what do you mean by transfer. Generally, all these days transfer means what? Selling is what we think. Sometimes without selling also you can get benefit. You don't sell directly that asset, you don't sell, you still get the benefit. Are you getting it? All those situations are also treated as transfers. What are they? Transfer includes sale, exchange, relinquishment of an asset. Relinquishment means, for example, redemption of debenture, redemption of shares. They are all called as what? Relinquishment means asset is lost, you are getting money. That's called relinquishment. Extinguishment of any rights therein. Extinguishment. Extinguishment means what? Asset will be there. It transformed into another name. It transformed into another shape. That is also called as extinguishment. For example, sir, I have preference shares, sir. I converted into equity shares. That can also be treated as extinguishment. That is treated as what? Extinguishment. Sir, I have a gold, sir. I converted into electronic gold receipt, sir. That is coming under extinguishment. Sir, I have an asset, sir. Because of this, I got bonus shares. I have shares in one company, sir. Company allotted me bonus shares because I have shares. That's an extinguishment. Because of the asset, you are getting some other asset, or this asset is changed to some other dimension, some other way, some other format. All these are called as what? Extinguishments. Means if I convert also, that's a transfer. My gold, physical gold, I converted into electronic gold receipt. It's a transfer. Transfer of capital asset. Profit arising, taxable. Sir, I just converted, sir. I'm not selling to anybody. Money and all is not there. What about that? That's why there is a section called 47. There is a section called 47. Exempted transfers. What is it? Exempted transfers. Some transfers, no, they're exempted. Okay. For example, I gifted my property to my children. Will you tax me? No. Are you getting it? You should not tax me. Are you getting it? So there are so many types of transfers which are covered under exemptions. Exemptions. Okay, we'll discuss that. Once we finish transfer, then immediately we'll go and discuss 47. You will get a better idea. Some transfers are not at all taxable. Okay, now, so sale, exchange, relinquishment, extinguishment of any right therein. I am transferring right in the asset. That is also a transfer. Compulsory acquisition, sir. I did not sell, I did not transfer, sir. They only compulsory took from me and they paid me money in my bank account. Okay, you got profit knowing that? Yes, I got profit, sir. Profit and all I got. Then pay tax on that. Compulsory, voluntary, I don't bother. Capital asset is there. It is no more with you now. For transferring it, you got a profit. Whether you transfer voluntarily, under compulsion, doesn't matter. You made a profit. Taxable. Clear? Conversion of capital asset into stock in trade by the owner. Sir, I have a land, sir. I have a land. I started real estate business now. My personal land is there, right? My capital asset is there, right? I converted into stock in trade. Conversion is treated as transfer. Getting it? How to tax this conversion? 45 subsection 2 talks about how to tax it. We will discuss that later. Okay, next. Maturity or redemption of zero coupon bond. Remember zero coupon bond I told? PGBP, sir, 100 rupees I paid, sir. 1200 rupees or 1300 rupees bond value. Bond value 1200 or 1300 face value. At last I waited for 15-20 years. I gave back the bond, I got back my money. Redemption, maturity of zero coupon bond. Redemption is also transfer. How to calculate in zero coupon bond? You know, I paid 100. After 10 years, I got 1000 rupees. 1000 is the sale value that time. Minus cost of acquisition. What is the cost at which I acquired the bond? 100. 900 is a capital gain. That's it. Are you clear? Next. Part performance of a contract. I sold a house actually. 30th March itself. 30 March 2025 itself. Keys and all I hand over. Possession given. Consideration also I got. But registration when happened, you know, next year it happened. April 2025 registration happened. Previous year 25-26 registration happened. But in substance, sale completed when? 24-25 itself sale is completed. It is treated as transfer in 24-25, not transfer in 25-26. If at all in substance, as per section 53A of Transfer of Property Act, if at all transfer is completed, it's a transfer in that year only. We will not wait up to registration date. Understood? Next. Any transaction which has an effect of transferring or enabling enjoyment of any immovable property, any transaction because of which somebody can enjoy immovable property, your immovable property, that is also treated as transfer. Gift, transfer. Inheritance, transfer. Will, through will, my children or somebody is getting house, that is also transfer. If it is a transfer of a capital asset, is liable for capital gains tax. Every transfer is liable for capital gains tax. However, some specific list is given. The following transfers are not liable for capital gains. What are the transfers not liable for capital gains? I will tell you later. Here one example they gave. For example, no, this and all not required. The waste, this and all gone. That culture gone. Once upon a time, no, when we want to buy a house in a flat apartment, no, big apartment gated community, no, that gated community will register as a society or as a company. Buy shares in the company, you get that apartment. Now if I buy shares, no, what I bought is shares, but because of this what I got, I am enjoying now immovable property. That is a transfer of immovable property, not transfer of shares. Are you getting it? That's what they mean to say. Okay, irrelevant. Now and all it is not there. Clear all of you? Next. Now remember transfer. Any transfer of capital asset is what? Any transfer of capital asset is any transfer of capital asset in the year, profit and all is straight away taxable for capital gains. Correct? Now I told you there are some transfers which are exempted. You see, transactions not regarded as transfer. Indirectly they are exempted transfers. They are also transfers, like some conversion would have happened, some extinguishment would have happened, relinquishment would have happened, sale itself would have happened. The following transfers are not treated as transfer. Indirectly they are exempted transfers. What are exempted transfers? Just 2 minutes. Yeah, let's continue. Okay, what are the transactions which are not treated as transfer? Once this is understood, this list if you understand, from here it will be much more easy. You know, distribution of capital assets on partition of a HUF. HUF is dividing into normal families. Distribution of assets happened, not a transfer. But the member who got the property ultimately sold outside, got money. That time it is a transfer. That time he has to compute profit and pay capital gains tax. Understood? Next. Any transfer of capital asset by individual or HUF under gift, will or irrevocable trust. My immovable property I gifted to my friend. I don't have to pay any tax on it. Getting it? Because I didn't make any profit here. I gifted them. Yes or no? So I don't have to pay any tax on it. Gift, inheritance, will, irrevocable trust, all that comes here. Getting it? He received it, right? Gift. For him other sources provisions will apply. As per that, sometimes it is exempted, sometimes it is taxable. Accordingly it will apply. Chain. Okay. Later he sold. For him he need to pay capital gains tax. Are you getting it? Fine. You know, one important amendment. This is first time amendment for you. Okay. For May 2025. You know, use ESOPs, you know. ESOP. Okay. Suppose if you are getting ESOP specified security from a company where you are working, you got allotment. You got ESOP allotment. You exercised the option. On the date on which you exercised the option, that is the year in which perquisite valuation will be done. Correct? In salary chapter we saw. In which year it is taxable? In the same year only it is taxable for perquisite. Eligible startup only 4 years time is there, 48 months time is there. Normally if a company is giving me ESOPs, that is taxable in the year in which I exercised the option. Market value on the date of exercising option is treated as perquisite. Fine. Salary taxed over. Now I have shares. I gifted the shares to my wife. I gifted the shares to my friends. I gifted the shares to somebody. Earlier ESOP shares if you're gifting to somebody, no, that is taxable. Earlier that is taxable, but now earlier up to assessment year 24-25, nothing but up to 31st March 2024, this is taxable with effect from 1st April 2024 onwards. Nothing but assessment year 25-26 onwards. ESOPs you got, right? You are gifting or will or inheritance irrevocable. You are transferring to somebody without consideration. Not taxable now. Now it is coming under inclusion of exemption. Now it is covered under exemption. Earlier, no, gift, will, inheritance, irrevocable trust, no, ESOP, no, gift, will and all, no, that is treated as transfer. Because no, gift, will and all is exempted. For that exception is given, that is ESOPs. If an employee who got ESOP, no, that ESOP is transferring to somebody as a gift. That ESOP is transferring to somebody as a inheritance, all that, gift, will, all that. Earlier it is taxable. up to 31st March 2024. For your Jan 25 exam, it used to be taxable. For May 25, September 25, May 25 exam onwards, if at all in 24-25 year, remember transfer date must be 24-25 financial year onwards, ESOP gifting is exempted. ESOP gifting is exempted. Now the other person who got the gift, right, he is selling it to outsider, he is making money. Profit has to be computed. For him it is taxable. How to compute all that we will discuss. Clear all of you? So however, transfer of ESOPs under gift will or trust is treated as transfer up to assessment year 24-25. Understood? Important amendment. MCQs, it might be important. Next. Now which means they may give you transfer of securities allotted under ESOP under gift will or irrevocable trust is treated as transfer with effect from 1st April 2024 onwards. Wrong. That is exempted from 1st April. Up to 31st March 2024 only it is transfer. Clear? Next. Transfer of capital asset by holding company to its 100% subsidiary company, which is an Indian company. Transfer of, see here, no, you will get some discussion. Transfer between companies. In all these companies, no, transferee company must be Indian company. Remember thumb rule. Transferor can be any company. Transferee must be Indian company. They will tell you holding, subsidiary holding, amalgamation, demerger, like that they will discuss so many issues here. In all the cases, who is transferring doesn't matter. Who is transferee? It must be Indian company. Then only I am transferring, right? That is exempted. Then only it is exempted. Are you getting it? Now, transfer of capital asset by holding company to 100% subsidiary company. Sir, 100% subsidiary, in reality it is not possible, sir. 100% subsidiary, how they will be? No, nominee shareholders will be there. What? Nominee. Suppose you take Tamil Nadu State Electricity Corporation. Tamil Nadu State Electricity Distribution Corporation, you take power bill, you will get on that company name will be there. You open their annual report, you open their balance sheet, only one shareholder, Tamil Nadu government, 7 other shareholders will be there. Some 7 or 8 shareholders will be there who will have 1 share. That's it. These are nominee shareholders. That company is a 100% subsidiary. 100% subsidiary means not legally, beneficially. How it is 100% subsidiary? I am beneficially 100% owner. Able to understand? Beneficially. Legally I am 99.9999% owner. Beneficially it is 100%. Beneficial ownership. Able to understand? So holding company transfer into 100% subsidiary. Not a normal subsidiary. Remember. Not a normal subsidiary. If in the company minority's interest is there, that's it. You are transferring some capital asset to them. Consideration is there, yeah. Consideration is there. Doesn't matter. Okay. If I am transferring to my 100% subsidiary, they are paying me money also. Nothing. Not a transfer. But if I am transferring to my normal subsidiary, fully taxable. For me, capital gains will apply. Same way, a subsidiary is transferring to holding company, which is 100% holding company, provided holding company is Indian company here. Remember, in all these cases, recipient must be Indian. Why Indian company recipients and all? For me, it is exempted. Tomorrow, if they sell, no, tax will come. Na? That time, department will collect tax happily. 100% subsidiary. What does it mean? You know, from one of my pocket to another pocket, I am transferring asset. Why to tax it? 100% subsidiary means this is my company only. I am only. Yes or no? How come if I'm not transferring to any outsider and making profit? Insiders only. Are you clear? Next. Transfer of capital asset by amalgamating company to amalgamated company in a scheme of amalgamation, provided amalgamated company is an Indian company. Amalgamating company stands for into amalgamated, amalgamating selling company, amalgamated purchasing company, amalgamating transferor company, amalgamating transferee company. Correct? Yes or no? A company is closing down and selling its all its assets to another company. Now they are selling so many assets, no, they are transferring so many assets, no, they are getting purchase consideration, no, exempted. It's not a transfer. Same way, transfer of capital asset by the demerged company to resulting company in a scheme of demerger. You have a demerger accounting in CA Inter. Do you have demerger? No. I think maybe in final FR you will have it. Okay, fine. Transfer of capital asset by demerged company to resulting company. Demerged company, nothing but one company is there. It is splitting into multiple companies. Now when they split in multiple companies, this company will give some assets to each company. That is exempted. Provided resulting companies are Indian companies. Resulting companies means newly formed companies from demerger. They are called as resulting companies. I hope every one of you know demerger meaning. Yeah, that's it. Next. Now tell me, in amalgamation and demerger, not only exchange of assets happen between companies, shareholder shares also gets exchanged. In amalgamation, what happens? This company assets become that company assets. This company liability become that company liability. Same way demerger. Not only this, shareholder shares, no, they will relinquish and get new shares. Correct? Huh? Extinguishment, conversion, their old shares will convert into new shares. That is also transfer only, na? That is also exempted. Not only for companies, even for shareholders who are exchanging shares, no, that is also exempted for them. So transfer of, you see, any transfer by a shareholder, okay, of shares in the amalgamating company in lieu of shares in Indian amalgamated company, are you getting it? That is treated as a transfer. Same with demerger. Any transfer of shares by resulting company to the shareholders of demerged company, if the transfer is made in consideration of demerger, are you getting it? Any transfer of shares by demerged company shareholders or resulting company shareholders, whatever it is, that shares, that is exempted. In a scheme of demerger, your shares, no, resulting company is allotting new shares to you. In demerger, what happens, you know, my original company shares will be as it is, will be there. The resulting company will be allotting me new shares. That is not a transfer. Clear, all of you? Next. Here they have given one word, except where shareholder itself is amalgamated company. Example, subsidiary company amalgamated with holding company. Example, I have a subsidiary company. Now I'm amalgamating it. 100% subsidiary. All these days we both are two different companies. After amalgamation, we are one company only. After amalgamation, we are one company only. So generally here what will happen, in subsidiary company I have 100% shares. Now I'm merging it into my own company. Will I allot my own shares to myself? Huh? Hello? Yes or no? Shares exchange will not be there. That's it. Okay, that's what the meaning. Except where shareholder. Except means what? This is not about taxability point. Shares exchange will not be there in this case. That's what they're trying to tell. So this point which I highlighted in green color, ignore it, no problem. Clear? Next. Transfer of government security. What are you transferring? Government security you're transferring, which will carry a periodic payment of interest. Means government debt securities, government bonds you are transferring. Where are you transferring? Outside India. Who is transferring? Non-resident is transferring. To whom he is transferring? Another non-resident. Sir, non-resident outside India to another non-resident is transferring. First of all, why capital gains will come, sir? Okay, it is covered here. But why it will come, sir? Because it's government security, Indian government security. Capital asset is situated in India. Section 9, deemed to accrue or erase in India. 9 subsection and clause number 1. Business connection, capital asset, property situated in India. Then even though transactions happen also, it doesn't matter. Asset is transferred, ownership is transferred. It's an Indian income, but it is exempted. Why it is exempted? 47 gives it. All of you? Hello? Any of you heard capital gains earlier? Capital gains, have you? Yes. Fine. Redemption of sovereign gold bonds is exempted. Remember, redemption only exempted, not transfer. I purchased a sovereign gold bond. I sold it to my friend. I sold it in open market. Taxable. Profit is taxable. I purchased a sovereign gold bond at 10 lakhs. I sold it tomorrow at 12 lakhs. Taxable. Sir, I didn't sell it. I waited for 10 years. Again, I gave it back to the bank, RBI. They paid me back my gold. That's redemption. In a redemption of sovereign gold bond, what you will get, your money you will get back, along with appreciation in the gold value, or gold you will be given. That's just a redemption. That's just a physical delivery taken. Yes or no? That is not a transfer. A redemption of sovereign gold bond is not a transfer. Are you clear? Same way, conversion of gold into EGR, vice versa. Okay, what is it? Sir, my physical gold, I convert it into digital gold. Gold is with you only, ultimately. There is no third party, sir. Third party and all know that. This is not treated as transfer. EGR, now I am converting into gold, sir. I have an EGR, sir. I bought from somebody. I am not selling it to anybody, sir. I am just converting into gold, sir. Means the certificate you are converting into gold. There is no transfer here. Both are with you only right now. If ownership changes, then the problem will come. So gold to EGR, owner is same. Easy or to gold, owner is same, therefore it is not a transfer, it is exempted. Easy or not? Next, suppose no work of art, archaeological, scientific, art collection, book, manuscripts, drawings, painting, photograph, print. There are some assets like this. What am I doing with these assets? I am transferring to government. I am transferring to university. I am transferring to museum. I am transferring to art gallery. I am transferring to national archives, public museum, institution notified by central government or renowned throughout any state. Notified authorities, I am transferring some valuable assets. I am making profit also. Still exempted. It is not taxable. Are you clear? This is to encourage people to give archaeological collections to government. Suppose I found archaeological collection in my farmland. Okay, if I give it to government, they're taxing me. They're paying me money and they're taxing me. And I don't want to show it. I want to protect it. So government want to encourage people. No, archaeological collections will give us. It will be very helpful for us to demonstrate to foreign tourists and all. It will help to the government of India. Tourism will grow. So give it. What benefit? You're taxing me if I have a profit also. No, I will not tax you. Don't worry. I will not tax you. Exemption. Easy or not? Next. Any transfer by way of conversion of bonds, conversion of debentures, conversion of debenture stock, conversion of deposit certificates into shares, debentures, whatever. Conversion of bonds into debentures, conversion of bonds into shares, conversion of debentures into shares, conversion of debentures into securities, conversions exempted. Same way, conversion of preference shares into equity shares. Owner is same year. Asset only changed. Conversion happened, extinguishment happened. That's it. Owner is same only. What benefit I'm getting? Are you getting it? This is not taxable. After conversion, that asset you sold to third party and made money, received money, made a profit also. That is taxable. Next, transfer of capital asset under reverse mortgage. Reverse mortgage. Mortgage means what? Keeping my property in a bank into loan, I will take a loan, I will repay the loan and get back my property. This is mortgage. Reverse mortgage means what? I will not give here also mortgage only will happen. Yes or no? Here also mortgage will only happen, but I will never get back the property in my hand. Okay, so it's a reverse mortgage. What does it mean? I'm a senior citizen. Reverse mortgage scheme is generally applicable for senior citizens, 60 years and above age generally. Okay, what is reverse mortgage scheme? Suppose senior citizens who retired, they generally will not have any monthly income. Their only asset that they have in their lifetime is house only they have. But if the house is rented, that rent will not be sufficient. If they sell the house, where they will stay? That to senior citizens and all, nobody will give rent also, because at any time they may expire. So no, so people know the very hesitant to give loans to, rental premises to senior citizen. Now they are in a dilemma what to do. So RBI brought this reverse mortgage scheme. Don't worry, you happily stay in your home. You come to bank, don't sell it, keep it under RM, reverse mortgage. Keep it under reverse mortgage to the RBI. Okay, keep it under reverse mortgage, and RBI will give you, the bank will give you monthly amount for your survival. You stay in the home, happily survive. Upon expiry, bank will take over the property, sell the property. Suppose the bank gave you monthly so and so amount, right, in the form of loans. Yes sir, their loans, nothing but their loans. Okay, you got so much amount, right? Upon expiry, if bank made a profit, house they sold, and then loan amount is settled, balance amount is called as a profit. That profit will be given to legal heirs. At the time of reverse mortgage itself, nominees who they will write, they will get it. Are you clear? All of you, this once asked as a straight theory question. Okay, what is reverse mortgage? Senior citizens can mortgage their house to a bank or a housing finance company, either for a lump sum money or regular income. But remember, they can still stay in the house without repaying the loan. You don't have to repay. That's why it's called reverse mortgage. Normally in a mortgage you have to repay. In a reverse mortgage you don't have to repay. Bank only will pay you. Getting it? Next. Loan limit not required from exam point of view. Okay. Property will be revalued once in 5 years. That is also not required from exam point of view. Reverse mortgage, how it works, they're telling administrative mechanism. That's not required for us. Now usage of the loan. Loan, no. For what purpose you can use? Medical, emergency, family expense, any other purpose. But you should not use it for trading, speculation. You should not use it. Disbursement, lump sum method they can give, or through annuity sourcing institution. Like loan is given to first LIC or IRDA insurers, they will give you monthly some amount, annuity, pension they will create out of it. Maximum loan tenure, 20 years generally. Recovery of the loan after borrower death, the loan and interest will be recovered by selling the house. Excess amount will be paid to the legal heirs. Legal heirs preference. Legal heirs can do one more thing, sir. Legal heirs, they can repay the loan and interest and reclaim the property before it is sold. Now, transfer of house and reverse mortgage is not a transfer. Senior citizen is getting monthly money, lump sum money, no? That is not a transfer. Accordingly, no capital gains. Further, bank is giving monthly amount, no? That is exempted from income tax. Loan amount received is exempted from income tax, which is a very good scheme. Reverse mortgage. Easy or not? That's it. The best way is what, in a banks, best way is what, tomorrow. You can give advices to your bigger clients. If they have a very big property, high value property, if they want to sell it, and they're not in urgency also, they want to sell it, tell them to keep it under a reverse mortgage. Get monthly amount, lump sum amount, you get it. Use that money for buying some property. Keep it. Okay? Tomorrow, upon the death of the person, you repay the loan and then get back the property. In the meantime, you got the money. Yes or no? Fine. Of course, you can even keep it under loan and then get also some tax planning we can do by using reverse mortgage and all. Okay, fine. Anyhow, that takes little time for me to discuss. It's okay. Enough. Understood? Are you clear? So we understood charging section. We understood what is transfer. We understood what is capital asset. We understood what is exempted transfer. Yes or no? We understood exempted transfers. Now we need to understand what are various types of capital assets. You remember I told at the beginning there are capital gains of two types: long-term capital gain, short-term capital gain. So what is a long-term capital gain? What is a short-term capital gain? I understood. Now once again, I told you capital gains are two types. One is long-term capital gain, another one short-term capital gain. Remember? And if you recollect, depreciable assets block. Whether a gain or loss is always short-term. The gain is always short-term. But generally, whether a gain is a long-term or short-term, it depends upon what, period of holding. Period of holding of capital asset. Before you transfer, how many months you are holding it. That decides whether it's a long-term or short-term. Suppose if it is a long-term capital asset, if you transfer that long-term capital asset and made a gain or loss, then that's accordingly a long-term capital gain or long-term capital loss. Suppose if the asset is a short-term capital asset, then you sold, you made a gain or loss, then that's a short-term capital gain, short-term capital asset. Now, what is a long-term capital asset? What is a short-term capital asset? So from here, next level discussion will start. Until now, a base level. From here, next level discussion will start. What is a long-term capital asset and what is a short-term capital asset? The discussion will start now. Clear, all of you? Everybody? That's it. Okay, we'll go ahead after a break. We'll take a lunch, we'll take a break and then we'll get back and then discuss. Confident? Yes. Now, in the previous session, we understood that a long-term capital gain and short-term capital gain is dependent upon the type of the capital asset. If the asset is a long-term, then the gain is a long-term. If the asset is a short-term, generally the gain is a short-term. However, there are some capital gains. Capital gains arising from transfer of following assets is always treated as short-term capital gain, irrespective of period of holding. What are they? Section 50 AA, there is one capital gain. Section 50, there is another capital gain, capital loss. Even 50A also you can add. Here you can even add 50A, electricity company. Okay. Now 50AA, what is this section talking about? Units of specified mutual funds acquired on or after 1st April 2023. Some specified mutual funds. What is specified mutual fund? Later somewhere we will get it. Okay. So if at all you are getting unit of a specified mutual fund, or if you are selling market linked debentures, for a market linked debentures, units of specified mutual fund, you see unlisted bonds, this is the latest amendment, unlisted bonds, unlisted debentures, transferred, redeemed, matured, doesn't matter, on or after 23rd July. Bonds and debentures, simply speaking, unlisted bonds, unlisted debentures. Listed is not covered, remember. Unlisted bonds, unlisted debentures, if at all they are transferred on or after 23rd July, from those unlisted bonds and debentures, whatever the gain, whatever the loss, it is always treated as a short-term capital gain, short-term capital loss. Remember, they are talking about the nature of gain. They are not talking about nature of asset. The asset might be a short-term capital asset. The asset might be a long-term capital asset. Asset might be anything. But the gain is treated as short-term. Even 50A. Capital gains arising on transfer of depreciable assets will always be treated as short-term capital gain, irrespective of period of holding. But the block of asset is there, right? All the assets are long-term might be. The asset might be long-term, but the gain or loss is always short-term. Are you clear? This is most important point. Okay, unlisted. Earlier, no, under 50AA, two sections or two items only covered: specified mutual fund, market linked debentures. Now two more were also added: unlisted debentures, unlisted bonds, with effect from 23rd July 2024. MCQ most important. It might be relevant for MCQ. Clear? Now coming back. So what are various types of assets? Long term, short term. It depends upon what? Capital gains are broadly classified into long term, short term capital gain based on period of holding of the capital asset. POH means period of holding. Now, what are various types of capital assets based on period of holding? Capital assets are broadly two types. What are they? Short term capital asset and long term capital asset. What is a long term capital asset other than short term capital asset? A long term capital asset is an asset which is other than short term capital asset. What is a short term capital asset? That's what we are going to learn. Short term capital asset is an asset held by SSE. Obviously, the one who is selling this asset, that SSE. How long he is holding? Held by SSE for not more than, which means up to, less than or equal to 24 months or 12 months, as the case may be, preceding the date of transfer. Today I am selling, ignore today. Till yesterday, how many months I am holding? Up to 24 months or up to 12 months. Two criteria were there. We'll discuss what are they. Then they are called as short-term capital asset. Preceding the date of transfer, exactly 12 months or 24 months I'm holding, or less than 12 months or less than 24 months, then it's a short term. Preceding the date of transfer, if at all it is more than 24 months, if it is more than 12 months, then it is not a short-term capital asset. If an asset is not a short-term capital asset, that's a long-term capital asset. Yes or no? All of you? Next. Now, period of holding, like I said, no, 12 months or 24 months are like that criteria. You all know before amendment. What is the before amendment? Asset transferred before 23rd July, nothing but with effect from 23rd July, entire provision has been changed. Before 23rd July 2024, how the situation, we have three criterias: 12, 24, 36. Right now only two criterias: 12, 24. Some assets, 24 months criteria. For some assets, 12 months criteria. For some assets, 36 months criteria is applicable. For some assets, 36 months criteria is applicable. Understood? Now, what are the assets applicable for 12 months, 24 months, 36? First, I will show you 12 months criteria. What are the assets? Listed securities other than units. Listed securities other than units. Remember, listed security. Security means what? Debenture, bond, shares, units, everything comes under security definition. But other than units, they clearly mentioned. Second point, what they mentioned: listed units of equity oriented mutual funds. Listed units of equity oriented mutual funds. There is something called mutual fund. Mutual fund means where we invest in a company, we buy mutual fund. One scheme will be there. In that scheme we will invest. Like that, some hundreds and thousands of people invest in that scheme. Money, we just give the scheme to the money. We just give the money to the scheme. In that scheme is managed by some person. That person will invest all our money into multiple securities. That scheme is called as what? Mutual fund scheme. Now when I invest in that mutual fund, no, they will give me shares, right? That shares are called as units. In a mutual fund, it is called as unit. Now in which scheme I invested? Equity oriented mutual fund, which means major amount is invested where, you know, equities. See, in stock market you can invest in equity, you can invest in debt. Equity major portion, major means what, you know, 65%, not 51%. 65% is in equity. Okay, we'll discuss that. So units of equity oriented mutual funds, that to which units, ma? Listed units, not unlisted. Look at unlisted security not covered, unlisted units not covered. That too, units covered, right? Listed units, they are equity only. Sir, I have debt oriented mutual fund units. I have units of debt oriented mutual fund. What about this? Are you getting it? They are not liable for, they are not coming under 12 months criteria. First criteria is what? 12 months. Up to 12 months, short term. If the holding period is more than 12 months, it is a long term. Third asset, units of Unit Trust of India. Units of Unit Trust of India, zero coupon bonds. 4 assets. Listed equity shares, units of listed units of equity oriented mutual funds, units of Unit Trust of India, zero coupon bonds. Only these 4 listed shares, ma, listed securities, ma, sorry, listed securities, listed equity oriented mutual fund units, units of Unit Trust of India, zero coupon bond. This list you have to remember. I call them as highly volatile assets for convenience purpose. We call them as highly volatile assets. That's a name given by me. Okay, let us call them as highly volatile assets. Now for them, what is the period of holding? 12 months. Criteria is what? 12 months. Up to 12 months. Like what does it mean? Period of holding means what? When I got the shares, when I'm selling it. If the duration is 12 months, if the duration is 12 months, then we call it as what? Long term. Sorry, more than 12 months, long term. Up to 12 months, short term. Up to 12 months or less than 12 months is short term. How many days I'm holding it? How many months I'm holding it? That's it. What are the assets? Once again, listed equity share, listed securities other than units of equity oriented mutual fund, units of Unit Trust of India, zero coupon bonds. For these 4. Now after amendment, no, from 23rd July, no, any other capital asset, means what? My buildings, unlisted securities, equity debt oriented mutual funds, unlisted units of equity oriented mutual funds, jewelry, archaeological collection, drawing, painting, sculpture, debenture, unlisted debenture, the 2, unlisted bonds. Understood? Market linked securities, market linked debentures, specified mutual funds, everything will come under which category? Other capital assets. Everything will come under other capital assets category. Only listed securities, every security, bond, share, preference share, equity share, everything, listed security, that's it. Publicly traded on stock exchange, highly volatile, these are basically, therefore 12 months. Units of equity oriented, listed, that too, highly volatile, 12 months. Units of Unit Trust of India, 12 months. Even zero coupon bonds also volatile only. They are not constant. Their prices are very volatile depending upon bond markets, all that. Getting it? Unlisted bonds I have. Unlisted debentures I have. Unlisted securities I have. Unlisted debt oriented mutual fund, equity oriented mutual fund, unlisted. Listed debt oriented mutual fund I have. Jewelry, archaeological collection, painting, drawing, sculpture, any other work of art, depreciable assets, business assets, everything, the criteria is 24 months. That's it. Simple. Easy or not. This is on or after 23rd July. Only 2 criteria. Simply. Are you getting it? Once upon a time, 24 months criteria, only 2 items were there. Unlisted shares, only shares. Again, not debentures. Bonds is not there again. Unlisted shares, land, building, or both, only for these 2 assets 24 criteria is there. I told, right? Unlisted debentures, unlisted bonds, debt oriented mutual fund units, unlisted equity oriented mutual fund units. Remember, jewelry, archaeological collection, painting, drawing, sculpture, for all of them 36 months criteria. For all of them 36 months criteria. Simple. I am selling my gold jewelry. Okay, one necklace is there. I am selling that on 10th August 2024. I am selling it. By the way, 23rd July is what? Asset transfer date. 23rd July is what? When you are selling it. That is the reason why capital gains is applicable to you. When you are computing capital gains, you need to decide, is it long term or short term? Yes or no? For that reason, on which date you transferred? 23rd July or later or before? I sold on 10th August. When you purchased it? Just 2 years back I purchased. 24 months back only I purchased. 3 years back? No, 2 years back. It's long term. Suppose if I sell this on 10th July. If I sell the same jewelry on 10th July. 2 years is not the criteria. 3 years is the criteria. Are you getting the point? That's the consequence. If you are selling it, if you are transferring it before 23rd July, 36 months we will apply for all the assets, various assets. So 36 months we will apply. And land, building, unlisted shares only 24 months criteria. Every other asset is 36. That too, volatile assets is same again. For highly volatile assets, 12 months logic is same. That is there before amendment same, after amendment same. So highly volatile assets 12 months, unlisted shares, land, building, immovable property 24 months, any other capital asset 36 months. That's it. Clear? All of you. Now immediately you should also remember, come to the last pages of the capital gains, last page of the capital gains chapter. What is the page number? Last. Yes. You see, now there are two more sections, 112A, 111A. Remember, we have seen so many times this one, basic concept chapter, 112A, 111A. 112A, what assets are covered, you see. What are you transferring? Transfer of listed equity shares, units of equity oriented mutual funds, units of business trust. Be careful. All are listed. All are listed. That is the reason STT is paid on them. Securities transaction tax is applicable generally on listed securities. Securities transaction tax is applicable on listed items only. Only 3 assets covered here. Listed securities, no. Listed equity share. There, 2 subsection 42A, capital asset definition, short term capital asset definition. First category, highly volatile assets, listed securities covered there. That is very wide. Whereas 112A section, 111A section, both the sections are dealing with 3 types of assets. Listed equity share, listed preference share not covered, listed debenture not covered, listed bond not covered. Yes or no? Listed securities, they're not covered, only equity share is covered. Units of equity oriented mutual funds, units of business trust, units of UTI not covered, zero coupon bond is not covered. Careful. Listed equity share, listed equity oriented mutual fund, listed units of business trust, all listed. If at all you are transferring them, especially if you are transferring on or after 23rd July, by the way, 112A section, 111A section talking about what is the tax rate. They are talking about tax rate. These incomes, no, 112A, 111A, they told these assets, right? You are selling these assets, sir? Yes sir, I am selling these assets, sir. Is it a short term capital asset, long term? Check out. By the way, listed equity shares, no. Listed equity shares, no. Just now we saw period of holding concept. Listed equity shares comes under listed securities. Yes or no? Listed equity shares comes under listed securities. Which criteria? 12 months or 24 months or 36 months? 12 months. List units of equity oriented mutual fund listed 12 months. Units of business trust before 23rd July 36 months, on or after 23rd July 24 months criteria. First of all, assets covered are what? 3 assets. Tax rate. Now here we are not discussing whether they are long term or short term. Whether an asset is a long term or short term, there we just know we covered. Which assets are long term, which assets are short term. Listed security other than unit. Units of equity oriented mutual fund. Yes or no? Zero coupon bond, units of unit trust of India. 12 months is the criteria. Land, building, both unlisted shares before 23rd July, 24 months criteria. On or after 23rd July, 24 months only criteria. Remaining all other assets 24 months on or after 23rd July, before 23rd July, 36 months criteria. That's the, there only we discuss. That's it. Whether an asset is a long term or short term, over, we decided. How to classify whether an asset is a long term asset or short term asset, we decided. Sir, I sold listed equity shares, sir. I sold equity oriented mutual fund. I sold units of a business trust, I sold. And it's a short term, sir, or it's a long term. How do you know it's a short term, long term? Apply the definition. Listed equity share comes under highly volatile listed security category, 12 months. Units of equity oriented, highly volatile category, 12 months. Units of business trust, there it is not covered. It is not covered. Other capital asset category. Other capital asset, before amendment, other capital asset, 24 months criteria. Sorry, after amendment. On or after 23rd July, on or after 23rd July, if at all I am selling business trust units, no, 24 months is the logic. If at all I am selling the units of business trust before 23rd July, 36 months is the criteria to know whether this is a long term or short term. Understood or not? Fine. Sir, it's a short term, sir. What is the consequence? It's a short term capital asset? Yes. Is there a short term capital gain? Yes. Did you pay STT at the time of sale? Yes, sir, I paid STT. I paid STT at the time of transfer. What is the tax rate? 20% is the tax rate. What is the tax rate? 20% is the tax rate if transfer is on or after 23rd July 2024. Sir, I am transferring before 23rd July. Then 15% only tax rate. Then 15% is only tax rate. See how complex this is. This especially. Date of transfer is so important. Suppose I am selling units of business trust before 23rd July. Is it a long term or short term? First I need to decide. 36 months is the criteria. Less than or equal to 36 months period of holding, it's a short term. And if it's a short term, since transfer is before 23rd July, tax rate is 15. Suppose it is a long term, then 112A section will apply. If it is a long term asset, 112A section will apply. As per 112A section, if the transfer is before 23rd July, what is the tax rate? 10%. If the transfer is on or after 23rd July, the tax rate is 12.5. However, in the entire year, how much capital gain is exempted? 1,25,000. It's not actually exempted. Up to 1,25,000, no tax liability. There is a difference between exemption, no tax liability. Up to 1,25,000, no tax. Sir, before amendment, no. Here 1 lakh is there, na. Why here 125? Is it a printing mistake? Some student asked me. No. Getting it? No. In this entire year, 1,25,000 is the base limit for exemption. Base limit for no tax. Beyond 1,25,000, if at all capital gain is there, very simple, ma. I got capital gain, simple. I got capital gain before 23rd July. I got capital gain before 23rd July, 3 lakhs. Again, I got capital gain. Again, I got capital gain on or after 23rd July. Let us assume 4 lakhs I got. Total capital gain, how much? 7 lakhs. Now, when I am computing tax, no, again I will split this. Before 23rd July, 3 lakhs. After 23rd July, 4 lakhs. Here 1.25 lakh I will claim. FIFO order. Here I will not get any benefit because already 125 there I utilized. Balance is 1.75 lakh where the tax rate is 10%. Here 12.5% over. Whatever the tax amount you get, no, that is long-term capital gain tax under 112A. Understood? Everybody, don't reduce it here and here separately. Remember, 10% exceeding 125, 12% exceeding 125. Here, I think I would have given a note point. Okay, note. Aggregate limit in a year is, aggregate limit of no tax in a year is, how much it is? 1,25,000, that too FIFO order. Yes or no? FIFO order, first capital gains only. Are you clear? All of you? Yes. By the way, sir, 112A, unutilized basic exemption limit benefit you can apply. Even 111A, unutilized basic exemption limit is also applicable. Now, remember under 112A, rebate is not applicable. Long-term capital gain under 112A, rebate you can't claim. Whereas that restriction is not applicable for 111A. In 111A, rebate is applicable. Rebate is available. Are you here instead of using the word rebate? No, rebate available. Rebate under section 87A available. Chapter 6 reduction you don't get. Here also you don't get chapter 6 reduction. Sir, what do you mean by not getting chapter 6A? It is covered by me in next chapter 6 reduction. It will be covered. Clear? That's it. Now, 112A when applies? Three assets I told. If you sell any of these assets, only 112A will apply. STT must be paid. In short term, no, at the time of sale, if you pay, that's enough. But here it is not like that. Both shares, listed equity shares, STT must be paid at the time of acquisition and at the time of sale. Whereas for mutual funds and business trust, no, at the time of sale, if STT pay, that's enough. Whereas for equity shares alone, STT must have been paid at the time of purchase and at the time of sale. Then only 112A section will apply. Sir, I sold equity share which is listed, but when I acquire it, no, that's an unlisted share. Okay, now I am selling it, equity share, listed share. 112A does not apply. If 112A does not apply, how to tax it? Any long-term capital gain, which is not covered under 112A, naturally comes under 112. This 112 we will discuss at last. This 112 section we will discuss at last. Once again, this entire link I will tell you. Now, simple. 1 minute I will summarize. What are whether an asset is a long term or short term depends upon period of holding. What are the assets? Highly volatile assets. Listed securities other than units. Units of equity oriented mutual fund. Yeah, units of Unit Trust of India. Zero coupon bonds. For them, 12 months is the criteria. Up to 12 months holding period, short term, after long term. Whether before amendment, after amendment, it is same. Okay. Land and building. You unlisted shares, land, building, or both. For these two, before amendment 24 months, after amendments also 24 months only. Remaining all other assets, after amendment 23rd July onwards, 24 months. Before amendment, it is 36 months. Like this, you remember. Coming to, okay, long term or short term, we know how to decide. What is the tax rate applicable on long-term capital gain? What is the tax rate applicable on short-term capital gain? This is the question. I already told briefly. Yes or no? Long-term capital gain. Yes, I mean, if at all, if 112A, 111A, 112, these are the only three sections that talks about tax rates. At what rate capital gains are taxable? Only three sections are there. 112, 112A. Both are talking about long-term capital asset related tax rate. 111A is talking about short-term capital asset related tax rate. Sir, apart, what assets are covered under 112A or 111A? Common, same assets. Listed equity share, units of equity oriented mutual fund, units of business trust. Equity share listed, 12 months criteria. Units of equity oriented mutual fund, 12 months is the criteria. Last one, business trust, before amendment 36 months criteria, on or after amendment 23rd July, 24 months criteria. Accordingly decide long term or short term. If it's a long term, 112A section will apply. As for 112A, equity share, STD paid at the time of purchase and sale. Remaining two assets, STD paid at the time of sale. If both the conditions are satisfied, then the tax rate is 10% if the capital gain is arising before 23rd July and 12.5% if the capital gain is arising on or after 23rd July, provided initial 1.25 lakh of capital gain is not liable for tax. Clear? If it is a short term, then yes, at the time of sale, if STT is that's enough. 111A can be applied. If it is a short term capital gain, before amendment, the capital gain is taxable at 15%. After amendment, 23rd July onwards, it is taxable at 20%. Clear, all of you? Everybody? That's it. Now remember, remaining all other short term capital gain, there is no special section for that. Sir, some other asset I sold, sir. I got a short term capital gain. Depreciable assets I sold, or block of assets I sold, sir. Short term capital gain is there. At what rate it is taxable? 111A is not dealing with it. There is no section on that tax rate section. In such a case, it is taxable at SSE specific rate. At what rate it is taxable? SSE specific rate. SSE specific rate means in case of individual slab rates, depending upon default tax regime, optional tax regime. Are you clear? And again, one more important point I'll tell you. Capital gains is the only head of income where optional tax regime, default tax regime, there is no link at all. Tax regime does not have any link in capital gains. You can see. Capital gains head of income does not have any link with 115 BAC section. Clear, all of you? No link at all. Capital gains is not at all linked to 115 BAC. One important point you should remember. Okay, remaining all the heads of income are affected by 115 BAC. Salaries 115 BAC. Default tax regime impact is there. House property impact is there. PGBP impact is there. Other sources also where very minor impact is there. Are you getting it? Set off and carry forward impact is there. Clubbing no impact. Chapter 6 reductions impact is there. Okay, then we don't have impact on TDS TCS provision. Advance tax also we don't have any impact on. Return of income also we don't have any impact. Clear all of you? That's it. So again, going back. So 112A is completed. 111A is also completed. Now again coming back. So what is the page number? 10? Okay, ma. Now I hope you are clear on capital asset. When an asset is a long term, when an asset is a short term, yes or no? Now, what is an equity oriented mutual fund? MCQ, it might be relevant. What is equity oriented mutual fund? Simple, 65% more of the total proceeds. No, I am a HDFC company. I am running a mutual fund scheme. Most of the people, whatever money they gave, no, out of the entire fund, no, 65% or more are invested in listed equity shares of domestic company. Domestic company, listed equity share. Then only it is called as a equity oriented mutual fund. Another case is, sir, I'm a mutual fund, right? I'm not directly investing in shares, sir. I am investing, people invested in my mutual fund. I am investing in another mutual fund. How much? If the fund invests 90% of the total proceeds, 90% or more of the total proceeds in listed units of another fund, and such other fund invest 90% or more in the listed equity shares of domestic company. See, people gave me money. I directly invest in equity shares, 65% or more. I'm an equity oriented fund. Sir, I'm not investing directly in equity. I'm investing in another mutual fund. Okay, that mutual fund where it is investing, sir, that mutual fund 90% and above investing in listed equity shares of domestic market. Then the units I purchase it, right? This mutual fund, that is also called as equity oriented mutual fund. Are you clear? All of you? That's it. Now, the percentage of equity shareholding is calculated based on annual average of monthly average opening closing figures. That's not an important point, not required. Are you clear? What is a zero coupon bond? It is a bond issued by infrastructure capital company, infrastructure capital fund, infrastructure debt fund, public sector company, scheduled banks, infrastructure capital company, ICC, infrastructure capital fund, ICF, infrastructure debt fund. These three are basically NBFCs. NBFCs, banks, insurance, public sector companies. Yes or no? For which no payment or benefit is received before maturity. In a zero coupon bond, before maturity date, nothing you will get, which is notified by government. Yes or no? Income from transfer of zero coupon bond is treated as capital gain. Transfer includes maturity or redemption. Sir, zero coupon bond is a stock in trade for me, sir. Then it's a stock in trade. PGBP head of income will apply. Are you clear? Further, the one who issued, right? Issuer of the bond. Discount is nothing but interest expenditure, right? That we can claim deduction under 36 in the hands of the issuer company. Correct? We have seen 36 pro rata basis. That's it. Are you clear? All of you? That's it. Now that's about types of capital asset. All that. Confident until now? Now let us understand how to compute capital gains. How to compute? See, by the way, what is an amalgamation? What is a demerger? Some definitions were given. That's not required. You can easily understand also. Okay. Only conditions you should remember. You know what is amalgamation under income tax? You know, all the property of amalgamating company shall become property of amalgamated company. Nothing but pooling of interest method conditions there. Similar conditions only there. All liabilities of amalgamating company shall become liabilities of amalgamated. At least 75% of the shareholders in value shall continue, must become shareholders in amalgamated company. Yes or no? And a transaction is not treated as amalgamation if one company purchases property of another company. Suppose I'm buying properties of another company. All the properties I'm purchasing of another company. Just because all properties I'm purchasing, that doesn't become amalgamation. Amalgamation is by process. That company me amalgamating in a scheme of amalgamation. Then only it's called as amalgamation. The property is transferred after company wound up. Suppose a company liquidated, their properties and all we bought at a time. Just because we bought all the properties at the time of liquidation, does it mean amalgamation? Hello? In amalgamation, what happens? We apply application to go for amalgamation, then they will be wound up. First we will take the assets, then they will wind up. In a liquidation, what happens? That company wound up. At the time of wound up, they sold us. It is not through amalgamation. Are you clear? That's it. Okay. That is also what is not amalgamation, important for MCQs. Careful. Next. Demerger. When demerger, conditions for demerger. Conditions only, remember, the transaction is treated as demerger only if the following conditions are satisfied. Simple. All the properties of the undertakings being transferred becomes the property of resulting company. In a demerger, generally what happens, no? A company will have 2 or 3 segments, 2 or 3 divisions. One division is splitted into a separate company. That is called undertaking. One undertaking. A company will have 2 or 3 undertakings. Undertakings means what? Segments. One segment is demerged and then created as a different company. All the assets of the undertaking shall become assets of the resulting company. All the liabilities related to that undertaking shall become the liability of the resulting company. Property and liability are transferred at book values as appeared in the original company, demerged company. The resulting company issues shares to shareholders of demerged company on a proportionate basis. Shareholders holding at least 75% must become shareholders of the resulting company. Demerged company shareholders, no, 75% of them shall continue in the resulting company in value. Transfer must be carried out as a going concern, not as a discontinuing operation. Be careful. Yes or no? The demerger must follow any other conditions. Easy. They may, very rare they might ask you, what is demerger under income tax law, what are the conditions. Remaining points, no, you can study on your own, remaining points you can study on your own. Okay, that's it. Able to understand, all of you, everyone? Now, and if you remember, already section 45 subsection 1 is completed. What is 45(1)? Charging section, general charging section under capital gains. Profits or gains arising on transfer of capital asset during the year is taxable under this section. Correct? When it is taxable? Year of transfer. Year of transfer means what? Based on date of sale, not based on agreement date. Suppose, I entered into agreement to sell with a party on 31st March, but actual sale happened on 10th April or 20th April or somewhere, and it is no part performance of contract. That is not a part performance. Possession, substance over form, nothing happened. Only everything happened only in April month. Next year only it happened. Then that is taxable in next year only. Clear, all of you? Next, indexation. Cost of acquisition can be indexed up to year of transfer. This point you can't understand right now. For that I need to discuss further few more things. Now, understood basically? Section 47 completed. 2 subsection 47 transfer completed. 2 subsection 14 capital asset definition completed. 2 subsection 42A short term capital asset meaning completed. 2 subsection 29A long term capital asset meaning completed. 111A short term capital asset tax rate on 3 assets be completed. 112A long term capital asset 3 assets we have completed, tax rate. 7 sections we completed until now. Clear, all of you? Now let's look at how to compute capital gains for non-depreciable assets. And if you recollect, 50 completed, 50A is also completed. Depreciable assets, that is also completed. Total 9 sections completed till now. Able to understand? Yes. Computation of capital gains, other than, look at this, depreciable assets covered under section 50, which is related to block of asset, other than depreciable assets. This format is applicable for other than depreciable. Depreciable asset means what? If an asset is coming under section 32 purview, then only it is depreciable. Sir, I have a residential building, sir. Generally it's a depreciable asset only, but under income tax it is not treated as a depreciable asset because that is not forming part of block. Simple. If an asset is forming part of block only, we call it as what? Depreciable asset. Now, non-depreciable asset, how to compute capital gain? If you are able to understand this from here on, I'm telling you, nobody, what capital gain specialty? We are discussing so much complex, right? Once you get to know in capital gains, it's not how you remember, it's how you recollect. When you're reading it, you're able to recollect it. Getting it? That's enough. You're able to recollect that point, exact point. Capital gain problem solving, whatever size of the problem, 1 minute only takes. You give me 12 marks problem, I'm telling you, 1 minute is what it takes, or worst case 2 minutes. Solving time is only 2 minutes. If at all you're taking more than 2 minutes for thinking answer, that means you're doing wrong. I'm telling you scientifically. I will show you 99.99%. Not more than 1.5 minutes it takes. Reading the question and solving. If tax computation is also there, another 1 more minute. That's it. Maximum 2 to 2.5 minutes is what takes mental calculation of capital gain problem. Presentation takes some 7-8 minutes depending upon the size of the problem. That's it. Whereas PGBP, Even for computing answer generally takes 3 to 4 minutes. Capital gain is the only head of income where time takes is very low. House property also the same. But salary PGBP is not like that. They take time because you have so many computations. Whereas capital gains is dead easy. The only thing is what you should remember correctly how much value to take, at what value, long term or short term, fat, you should be able to decide. Getting it? For that, the only way is grip on the entire content. You must be able to remember the moment I say listed equity shares 10th April I sold. Immediately you must say 12 months before 23rd July listed equity share 112A 10% tax rate up to 1,25,000 basic exemption. Immediately you should be able to recollect like the entire chain. Are you clear? Now, how to compute capital gains? How to compute capital gains? See, same format you must follow in exam. Particulars amount. Any problem, any profit, how we will compute? See, consideration minus cost, correct? Consideration minus cost is equal to gross capital gain, correct? Capital gain. On this, you don't have to pay directly tax. There is some exemptions. You got a gain, right? If you invest that money somewhere else, you are exempted. Balance taxable only, balance gain only taxable. Sometimes it will be 0. Are you clear? Now, first step, every student will write in exam sale consideration. Never write that word. Full value of consideration. Full value of consideration. What is full value of consideration received? Sometimes consideration will be received by you partly money, partly non-monetary. That time market value of the non-monetary, whatever you receive, that you need to add. Full value of consideration. See, I gave a note number 1, which means below notes is there, 1, 2, 3 below is there, you see. And here I gave 1 point. All the below points, they are discussed in detail under separate topics below later. Okay, so these are only brief topics, brief points. Again, full value of consideration, you see clearly it is covered here. Okay, now let us look at what is full value. Full value of consideration will be what? Actual consideration I got, or deemed consideration as discussed under 50C, 50CA, 50D, as the case maybe. It's not whichever is higher, whichever is lower, not that also. Sometimes actual only you will take. Most of the times actual only you will take. But there are 3 sections. 50C immobile properties, 50CA unlisted shares, 50D a residuary section. I'll tell you what is it. In all these 3 cases, consideration, how much you consider, there are some conditions. Sir, I sold listed equity share in stock market, sir. Listed equity share in stock market, how much you got? 2,000 per share I got, sir. 100 shares I sold. Actual consideration 2 lakhs only, full value of consideration. 2 lakhs only, full value of consideration. Sir, I sold immovable property. How much? 2 crore. You can't directly put 2 crore here. 50C section you should see first. First, what you should see? 50C section you should see. Okay. Now, that is briefly the point. Fine. Understood. Okay. Full value of consideration means either actual amount or 50C amount, 50CA amount, 50D amount, as the case maybe, that amount I will put. Okay. Now, from that, what I need to reduce? Transfer expenses. Generally for selling, we would have given advertisement for selling the land. For example, I would have paid brokerage, transfer expenses and all were there, that and all calculated. Generally transfer expenses, sometimes they will give you percentage of consideration. So calculated on actual consideration, sometimes as a percentage of actual consideration they will give you. So that time, that one. Note number 2. You see note number 2. Expenses related to transfer. What are they? Expenses which are incurred exclusively for transfer, such as brokerage, stamp duty, registration fee, legal expenses, all that. Most important point, no deduction for STT paid on transfer of listed security. For example, sir, I am transferring, for example, I am transferring listed securities. I am transferring listed securities. On that I am paying STT. That is not given as deduction in capital gains head of income. However, if the same security is a stock in trade in PGBP, STT paid will be claimed as deduction in 36. Remember? That's it. That's why I always tell capital gains, don't watch it. Without watching PGBP, don't watch it. So first you need to finish PGBP, then come back to capital gains. Many points we will connect there. Clear? Next. Okay, so we understood what is full value of consideration briefly. We understood transfer expenses means what in depth. Okay, then Okay, sale consideration minus transfer expense is equal to net consideration. This is a net consideration you got, correct? This is a net consideration you got. To get this consideration, you sold asset. That asset, how did you get? You purchased it. Cost of acquisition is there. What is it? Cost of acquisition is there. Reduce that. Not only acquisition, after buying, no, improved a lot. I did so much capital expenditure on that. Cost of improvement is also there. That also reduce it. Then what you will get is called as capital gain depending upon the asset holding period. You sold, right? Before you purchased it, right? Acquisition date is there, right? Sale date is there, right? Depending upon the gap, it might be long term or short term. Accordingly, the gain or loss will be long term or short term. But in case of a depreciable asset, we already saw. In case of a debentures, market linked debentures, unlisted bonds, unlisted bonds, unlisted debentures transferred on or after 23rd July. Unlisted bonds, unlisted debentures transferred on or after 23rd July. The gain or loss is always short term. Sir, if I am transferring unlisted debentures, unlisted bonds before 23rd July, then based on 36 months criteria, based on 36 months, see how cleverly I'm using the word, based on 36 months criteria, because they were transferred before 23rd July. Before 23rd July, unlisted debentures and bonds, what is the criteria period of holding? 36 months. Accordingly, either it is a long term or it is a short term capital gain. Suppose if I am transferring unlisted debentures, unlisted debentures, unlisted bonds on or after 23rd July, the asset is long term, short term based upon 24 months. However, the gain is always short term. The gain is short term, not the asset is short term. Asset short term, long term always decided based on 24 months or 36 months or 12 months. That logic only. Understood or not? Computation format is same. By the way, 112 capital gain is the rate. How that will be computed? Same format only. Same way only we compute. All non-depreciable assets, shares, securities, debentures, bonds, immovable property, jewelry, archaeological collection, for every type of asset, computation format is same only. On this capital gain only 112A, 12.5%, 15%, 20%, 111A, on this only we will apply. Understood? All of you? Now, once I computed capital gain, then I have something called exemption under 54 series. What is 54 series? Note number 5. From gross capital gain, deduction can be claimed subject to investment in new capital assets under 54 series. What do you mean by investment under 54? I told you here already. All the below points are discussed in detail, separately. Understood or not? Yes. Now, what is cost of acquisition? You see, cost of acquisition. Cost of acquisition means what? Array, actual cost, yeah, I paid money and got. Or deemed cost of acquisition. There is something else called deemed cost of acquisition. Sir, deemed cost, what is it? We are going to discuss it in section 49 and section 55 as applicable. What is cost of acquisition? We are going to discuss there. No deduction towards interest on housing loan. Suppose no, sir, I am selling a house, sir. To buy this house, I paid money, sir. Even after that, I paid interest on housing loan, sir. Interest on housing loan is called as capital expenditure. Hello? I am paying interest on housing loan. Will I call it as capital expenditure? Already that interest you claim a deduction. Will you get 1 second deduction here? Exactly. Indexation available on transfer of long-term capital asset before 23rd July. You see one important observation. If at all the asset you are selling before 23rd July, long-term asset, indexation facility is available. Remember, indexation is only there on long-term. Indexation is not there on short-term. Sir, what is indexation? I will come back to it later. There I will discuss. Indexation facility is not there on or after 23rd July transfers, even though the asset is a long-term capital asset. Understood? Now, what is cost of improvement? Actual cost of improvement or deemed cost of improvement. Deemed cost of acquisition, deemed cost of improvement. What do you mean by deemed? I didn't spend any money, but department assumes that I spent. Department assumes that I only spent. Okay, so as per 55, indexation is available on improvement cost also if transfer date is before 23rd July. Understood? Don't worry, all these points once again I'm going to discuss. Big topics were there. There we are going to discuss. Simple. What is the computation mechanism? Full value of consideration, how much? Minus transfer expenses reduce. Then what you get is called as net consideration. Then from that, cost of acquisition or indexed cost of acquisition. Note number 3, just now we saw. Cost of improvement or indexed cost of improvement, just now we saw. Then gross gain minus exemption minus, then balance, what you get is balance taxable capital gain, which is taxable at 12 112, 112A, 111A, as the case may be. Are you clear? Now this format, no, this particular discussion is ready. You strike off, or else we'll discuss at last. Okay, we will discuss at last if depending upon time. Okay, next. Now first one, now let us discuss computation. How to compute capital gains? How to compute capital gains? Let us discuss. First one is what? Full value of consideration. Full value of consideration means what? Actual consideration or deemed consideration, as the case may be. Deemed consideration applicable for what and all? Immovable property. 50C. What is 50C? 50C, full value of consideration in case of transfer of immovable property. Sir, I am transferring immovable property, sir. Now I should compute capital gain, sir. Okay. At what price you transferred, ma? 1 crore I transferred. I transferred at what price? 1 crore. You know what the department says, What the department says, Suppose I sold it for 1 crore. Okay. I will ask immediately the SSC first question. What is the stamp duty value of the immovable property? I will ask him the first question. Stamp duty value, how much I will ask? Stamp duty value. On which date, sir? On which date you are asking stamp duty value? Sir, immovable property, how sale happens, First me and seller meet, negotiate terms, everything over. First I will give advance, agreement to sell. First we will enter into something called agreement to sell. Agreement to sell is entered on 20th July 2024. Finally, settlement and all happened on 10th September 2024. This is the actual sale deed. Here this is date of agreement. On this date, stamp duty value is 90 lakh. Whereas on this date, stamp duty value is 110 lakh. 120 lakh. Government revised stamp duty value suddenly. We also don't know. We were also shocked. Okay. Already the stamp duty value is underpricing, like that government revised it. 120 lakh. Now, by the way, actual consideration, what we agreed, 1 crore. Are you getting it? Now, you know what happened? On the date of agreement, first of all, seller and all will enter into with me agreement with free of cost. No, I should pay advance. I paid 20 lakhs advance to seller. I paid 20 lakhs advance to seller. What is the proof? Sir, I paid in cash. I will not trust you. If you pay in cash, I will not trust you. Sir, I paid in other than cash. Banking mode I paid, sir. I paid through bank. Then I will consider this. Then I will consider you have paid advance. Okay. Suppose if at all there is an advance. There is an advance on or before the date of agreement. On the date of agreement or before the date? Advance must be paid on the date of agreement or before. Generally, only when I pay advance, only agreement will enter. After agreement, we will not pay advance generally. Only agreement first we will enter. If advance is there on or before the date of agreement, then stamp duty value means on the date of agreement. Sir, but registration happened later, sir. 120 lakhs that time. It doesn't matter. You both decided to sell on 20th July only. That time government also cooperating you. Later stamp duty value increased. We will not make it apply to you. Don't worry. Are you getting the point? So on or before the date of agreement, buyer paid advance to the seller by any mode other than cash. Then stamp duty value means date of agreement. Suppose, sir, buyer paid, sir, but he paid in cash, sir. Then stamp duty value will be date of registration, 120 lakh. Then the stamp duty value will be date of registration, which is 120 lakh. Why, sir? Why registration? I paid advance. You paid in cash. You did not pay in bank. Sir, partly I paid in cash, partly I paid in bank, sir. Then tell me, partly if you pay in bank, that's enough. Bank mode must be there, advance must be there. That's a proof that there is an agreement on the day. Otherwise you will buy some stamp paper later, you will put retrospective agreement. Amma, I can't leave it. Okay, if at all real payment is there, then I will consider that date. Otherwise I will not consider that date. Are you clear? Very tough if at all question they need to ask. They will give you on or before the date of agreement, cash consideration is there, advance, bank advance also there. Bank is there, that's enough. STV on the date of agreement will apply. Suppose advance itself is not there, or advance is there but cash it is there. In all other cases, stamp duty value means date of registration. Are you getting it? Fine, sir. In our example, no. Stamp duty value agreement is there, sir. Case number 1, advance and all paid in other than cash. Stamp duty value on the date of agreement only there, sir. So stamp duty value finalized how much? 90. Stamp duty value finalized how much? 90. Whereas actual consideration is 100 lakh. Whereas actual consideration is 100. 50C section will not apply. Are you getting it? Accordingly, 50C need not be applied. 50C need not be applied. Are you getting it? Like, okay, we can apply 50C also, nothing wrong here. What is 50C? If stamp duty value does not exceed 110% of consideration. Array, in our example, stamp duty value how much? 90. Already not exceeding actual only. Forget about 110%. Actual only already less. Then full value of consideration is actual. Then full value of consideration is actual. Actual in our example what? 100 lakh. 100 lakh into 110% is what? 110 lakh. Okay, stamp duty value just now we decided how much? 90 lakh. Is 90 lakhs not exceeding 110 lakh? Yes. Then actual. So in our example, how much will be the consideration? FVC 100. Sorry, 100 lakhs. Whatever, 100 crore, 100 lakhs, whatever. Understood? All of you? Now, suppose, sir, advance is not there, sir. Advance is not there. There is no advance. Our advance is there, it is in cash. Automatically STV becomes what? In our example, 120. Okay, 120. Is it not exceeding 110% of actual? Actual is how much? 100. Into 110% means what? Is equal to 110. Is 120 not exceeding 110? Array, 120 exceeding 110, sir. Sir, stamp duty value finalized. No, it is exceeding 110% of actual. Then stamp duty value. In that case, full value of consideration will be 120. That's it. 120. Are you clear? In our example, 120. Are you clear? Now, indirectly what the department is saying, you know, sometimes stamp duty value will be higher and lower. All that is fine. Stamp duty value higher. Actual consideration, stamp duty value is higher. Up to 10% I don't mind. But if stamp duty value is more than 110% of consideration, then I will not believe your consideration. I will take stamp duty value. Up to 10% fluctuation will be common. Market value, stamp duty value, fluctuations is common. How much deviation department is ready to accept? 10% they're ready to accept. That's it. Indirectly. Now, determination of stamp duty value. You see here, stamp duty value, what I gave here, mark I gave. Yes or no? What is stamp duty value? Circumstance. Advance received from buyer, on or before date of agreement, by other than cash, yes. STV on the date of agreement. Advance received in cash mode, sir, fully cash mode. Then date of transfer. No advance at all. Then date of transfer. Are you clear? Now, department what they said? Hello, mister. 120 lakh is what I will consider. You said 110. You said consider how much according to buyer consideration? 100 lakhs only. Department is saying no. What STV is 120, which is more than 110%. 120 I will take. Sir, 20 lakh. To the extent my profit will be higher. Moreover, transfer date is before 23rd July. The capital gain tax rate is 20%. 4 lakhs extra tax I'm paying. Sir, I already, if you don't know, you see that, sir, I already have a profit itself is very less. Are you getting it? Now you are considering 20 lakh. I purchased at 90 lakhs, sir. 95 lakh I purchased the property, sir. After 2 years, I'm selling it for 100 lakhs only. I made a profit of 10 lakh only. But you are showing, you are telling me indirectly 30 lakh profit totally. 10 my profit, 20 you are saying 30 lakhs profit, 30 into 20%, 7-8 lakhs, sir, I will be in loss. Yes, saying I will be in loss if you do like this. Then SSC requested assessing officer. Kindly please look into that much value not there, sir. Government record stamp value is wrong. That much value not there in reality, sir. SSC requested the department. Then if SSC requested, if the SSC requested assessing officer on the ground that stamp duty value higher than fair market value, sir. Market value 100 lakhs only. That's why I'm selling at 100. Stamp duty value is higher. Then assessing officer may refer stamp duty value to valuation officer, and in such a case, full value of consideration shall be value decided by valuation officer, provided it is beneficial to SSC. Provided it is beneficial to SSC. Suppose valuation officer, both of you are wrong, 150 lakh actual value. SSC will die. Yes or no? If valuation officer value, if valuation officer value is more than stamp duty value, sir, don't worry, I'll go with assessing officer happily, stamp duty value. If valuation officer value is less than stamp duty value, sir, I told na, market value low, FMV. Are you getting it? Market value, valuation officer will tell, sir, it's not 120, it's not 100 also, it's 110 only. Then 110 we will take. STV in revised appeal. First of all, okay, this point is not required, leave it. Okay, this is not required for you. Okay, are you clear? Now, here examples were given. Actual consideration 100 lakh ma. Stamp duty value on date of agreement 109. Stamp duty value on date of transfer 112. Is advance paid in other than cash on or before? If advance is paid in other than cash, stamp duty value on date of agreement 109. Is 109 more than 110% of the consideration or equal to? No. Then automatically actual consideration 100 lakh. Correct? If no advance is paid, then we will take 112. Is 112 exceeding 110%? Yes. Then automatically, that's it. Easy or not? 50C is over. Then generally any asset you sell, full value of consideration means what here? How much consideration I got. But for removable property, you are comparing with stamp duty value and finally deciding. For unlisted shares also, if the consideration received or accruing is less than market value of the share, then market value will be the consideration. Market value will be the consideration. Sir, it's an unlisted share, no? How market value will be there? It is not trading outside. Private company shares are. It is not trading. Don't worry, income tax department has a valuation rules. They will decide. 50D. Other assets. If the consideration received or accruing cannot be ascertained, sir, we can't decide how much consideration it is. Then market value of the asset given. You gave an asset, no? You transferred asset, that has a market value. How much you got, you don't know. But you gave, that has a market value. Generally, how much we receive? Whatever we give, that value only we receive. What we receive, we are unable to estimate. Then whatever we give only, we will consider. Correct? Sometimes no. Sometimes no. What happens is, okay, suppose demerger itself you take, or resulting company you take, or amalgamation you take. There is a new company came in the market, and that company is purchasing our company. All our shares we sold, and we are getting new shares. That new shares value under nobody can decide. Consideration nobody. I can't decide its market value, nothing. Then you gave existing old assets, no? That value is established, no? That you decide. Are you clear? All of you. For example, no? Best example, a cricketer is there. Okay, a cricketer is there. So I sold him one house. For that he agreed to visit my home 5 times and then do some promotion for me for my business. 5 times he will do business. 5 ads he will shoot for me. 5 ads he will shoot. For which I gave a big bangla. I transferred bangla and I'm getting brand ambassador post. He's going to become my brand ambassador. For that, what consideration I gave? A bangla I gave. You see, generally these incidents will happen many a times. A movie producer is there. To a particular big actor, instead of paying remuneration, no, he transferred bangla. He transferred a very big bangla, a very big flat, sea facing, very big flat, luxury flat he gave. For that, the hero has to come and act in the movie. Now, how much consideration I got? How much consideration I got? Arey, I'm bangla. I transferred a property, no? I transferred property. Transfer of capital, it happened. Now, for that, hero is coming and acting in a movie at free of cost. Is it really free of cost? Hero is getting bangla. Fine. That is consideration for him, perquisite for him, PGBP. For me, it's a transfer of capital asset. I should compute capital gains. What is full value of consideration? Hero is acting. How do I know what consideration? I'm unable to determine consideration. Market value of the asset transferred. I transferred Bangla. It has a market value 100 crore. That itself is consideration. Easy. All of you, I think this is best example. In reality, many will happen like this. Are you clear? Yes. Clear everyone? Sir, ESOP allotted, sir. ESOP, company allotting me ESOP. ESOP is transferred as gift, sir, up to 31st March 2024. Okay, last assessment year, up to 31st March 2024, it is taxable. That time, how much is consideration? You know, if security is issued by employee under ESOP or transferred by the employee as a gift or through irrevocable trust, market value on the date of transfer will be considered as full value. Market value on the date of market value on the date of transfer will be considered as full value. Company got, see, very simple here, no, company allotted the employee in 2022 year ESOP. That time market value 100 lakhs. That many shares allotted. Again in 2024 January month, I am gifting it to my friend, relative, or somebody. I am gifting it to somebody. That gift is treated as transfer. Yes or no? That is taxable. How much is consideration, sir? I gave gift to no. I did not get any consideration. How much is consideration, sir? I gifted it. I did not get anything. No consideration. How much? The section says what? I mean, the provision says what? Market value on the date of gift transfer. That time, no, when I'm gifting, no, that time market value is 250 lakh. That itself is consideration. Then what is cost, sir? Cost of acquisition, what, sir? You know, 100 lakhs is market value when it was allotted to me. But that time I paid only 50 lakhs to the company. Remaining 50 lakhs, company taxed me as perquisite. Company treated 50 lakhs as income. Yes or no? All of you? Company allotted me 100 lakhs worth of shares. I paid only 50 lakh. Remaining 50 lakhs is a benefit, perquisite. Now, I paid 50 lakh. In my hand, 50 lakh is treated as income. Indirectly, I only paid fully, no? Entire 100 lakhs is treated as cost of acquisition. Then balance 150 lakh will be capital gain. In case ESOP I gift. I didn't sell, I gifted. Gifting itself is taxable here. ESOP. This gifting of ESOP is taxable up to 31st March 2024. Sir, I gifted in 2024, 25 years, sir. No taxation. Are you clear? You gifted, yeah. Where is the income for you? That provision is wrong. That's why government deleted now. They realized their mistake and deleted now. Are you getting it? 24, 25 onwards, I'm transferring. Nothing is taxable because you're not getting any money. You're gifting to a wife, for example. You're not getting any money. Now you're not getting money, so exempted. My wife is selling the shares to somebody else. She's getting money. That is consideration. Cost. We will discuss later. Cost to previous owner. That's the concept is that we will discuss later. Until now, clear? All of you? Intense and clear? Yeah. So, you know, indirectly what segment we completed, you know, FVC concept is over. What is over? FVC concept is over. This is over. Therefore, this is completed. Okay. Transfer expense also completed. How to derive net consideration also completed. Yes or no? Now we need to complete what is acquisition cost, what is improvement cost. If you are able to understand acquisition cost, improvement cost, capital gains is over. Are you clear, everyone? Yes, we'll do it. 5 minutes gap. Yes, let's continue. Now, how to compute capital gain on non-depreciable asset? This is what we started. Full value of consideration over. Transfer expenditure over. Net consideration, how to arrive is over. Now, first thing that we need to understand, what is cost of acquisition? We already saw one point there. Cost of acquisition is actual cost or deemed cost, as the case maybe we saw. Now, let us look at in depth. Cost of acquisition refers to the cost at which the asset is acquired by the SSE, or most importantly, this is something new, previous owner. Generally, I bought the asset and I'm selling it. I bought it for 10 lakhs, I'm selling it for 20 lakhs, 20 lakhs minus 10 lakhs profit. Previous owner bought the asset. Previous owner. Who previous owner? Oh, from whom I purchased, that fellow. No, not that. You inherited, for example. You got it as a gift, for example. Are you getting it? There are some circumstances. Actually, it's not only previous owner, it's also include cost of asset, cost of previous owner, or cost of previous asset. Not only previous owner, the cost of acquisition can be sometimes cost of previous asset. For example, I purchased in company preference shares for 10 lakh rupee. Later the company converted them into equity shares. Equity shares I sold at 30 lakh rupee. Equity shares at what price I bought? I didn't buy equity shares. I bought preference shares because of which I got equity shares. Then the cost of acquisition of equity shares will be cost of acquisition of the previous asset before its conversion, that is 10 lakhs. Understood? Like that, some circumstances were given. Okay, first let us understand those circumstances. Okay, before I decide cost. No, again, wherever previous owner, wherever previous asset, that concept is there, right? Holding period also will be considered from them. You know what? Generally, whether an asset is a long term or short term, it is dependent upon holding period, period of holding, or holding period, both are same. Period of holding means what? From the date asset is acquired by me till the date asset I sell. Sir, I purchased preference shares 3 years ago. 3 years I'm holding it. Now company converted into equity shares. Just 2 days later after conversion, I sold equity shares. I sold equity shares after 2 days. 2 days only you are having equity shares, listed equity shares. Sir. So short-term capital asset. Can I say that? Sir, wait, sir. Equity shares I'm holding 2 days only. But this equity share I got because from past 3 years I'm holding preference shares. Now what is the holding period of equity share? More than 36 months. Okay, just because 2 days. So indirectly, the asset which you are selling, what is its holding period? It depends upon, if at all this asset is converted from previous asset, then previous asset holding period shall also be considered. Logical or not? Here nothing magical, everything is logical. Yes or no? Same way, my father purchased house property, sir. My father purchased house 10 years back. He paid lot of amount. If at all now he himself is selling the property, it's a long term, no? Yes or no? Long term tax rate is 12% only. And I'm already an SSE having higher slab rate. I'm in surcharge rate also. Now that property I inherit, now I am selling it. He paid cost, no? That should be reduced, no, from the profit. Tell me honestly, my father paid, saw a lot of amount in a lot of hard work he did and purchased this property for some 10 lakhs. Now I inherited the property, I got it as a gift from him. For example, now I'm selling this house. Should I reduce that cost or not? Whoever incurred, my father incurred, I incurred, our family incurred that money. We should claim that cost or not? Cost to previous owner. Now, when you're claiming cost to previous owner, cost of previous asset, indirectly, what am I telling to the department? Look, today this asset I'm selling, not because I'm owning it. My father is owning it. Not because I am having this equity share, because earlier I have preference share. So, is it a long term or short term? To decide that, previous asset holding period plus current new asset holding period, both I will combine and see. Same way, whether an asset is a long term or short term, current owner holding period, previous owner holding period, both we will combine and then see which is a genuine, yes or no. Suppose I bought house from some third party. Some third party I bought a house. Can he be called as a previous owner in the discussion, whatever the context I am discussing? No. Previous owner means what? From whom I succeeded this property. From whom I got this property by inheritance, will gift some reason, not an independent purchase. Are you getting the point? Hello? Yes or no? Yes. Now again coming back to subsection 42A, short term capital asset definition, you remember? Yes. Determination of period of holding. Look at page number 104. Determination of period of holding. Explanation 1 clause 1 to 2 subsection 42A. Okay, there is actually short term capital asset 2 clause 42A is there, right? That's a very big definition. That's very big definition. What is period of holding? From the date of acquiring the asset till the transfer, that's period of holding generally. However, in the following cases, period of holding has to be adjusted. What is it? Second case, you see, asset became property of the SSE by virtue of 49(1) modes. By virtue of 49 subsection 1 mode. 49. What is 49, sir? We have not yet discussed. Very simple. Will, gift, inheritance, amalgamated companies getting asset from amalgamating company, that is also covered. Conversion of equity shares into preference shares covered. Conversion of debentures to bonds into shares, that is covered. These are all covered. Are you getting it? Then include previous owner holding period. Then include previous owner. Remember, they didn't tell the word, they didn't use the word consider previous owner. They told include previous owner holding. Include means what? I am having 10 months already. Previous owner is holding it for 20 months. Total 32 months, 30 months. Understood? Like that. So include previous owner holding period. Understood? Next, conversion of inventory into capital asset. Inventory into capital asset. Furniture is there. I converted into capital asset inventory. Sorry, I converted that furniture inventory into normal, my depreciable asset furniture. Land is there. I bought long back that land for selling it purpose, real estate purpose, stock in trade. But now I want to construct my home on that. My home on that. You know, I converted on 20th July 2021. I converted. Then holding period shall be considered only from the date of conversion or treatment as capital asset. Tell me honestly. Holding period means holding the asset as capital asset. Holding period of a capital asset means I am having that asset in my control, just that asset controller having control on the asset as a capital asset. I am holding this land from 5 years, but last 4 years it is holding as stock in trade. So that's not a capital asset holding. From when you are holding it as a capital asset, after conversion onwards, I'm holding it as a capital asset. Only from that date you should consider. Only from that date. In this, no, there will be clear adjustment. Books of accounts of the real estate company, no, they will clearly tell transferred to owner. Date will be there. That journal entry is enough. Conversion date. To identify conversion date, that journal entry is enough. And if you remember, when inventory is converted into capital asset, it is indirectly a sale of that inventory. Yes or no? Yes or no? It's a sale of that inventory. It's a drawing. It's a drawing indirectly for me. Are you getting it? Under PGBP, in that year, you must show it as sale. Why? When you purchase that land, you debit it to P&L in purchase, no? Now you are taking out that inventory, right? Which means earlier you showed cost, right? Yes or no? Now it is in closing stock also. Are you getting it? Now how did you either reverse purchase or create sale? Generally market value. Income tax law says what? Market value on the date of conversion of inventory into on the date of conversion of stock in trade or inventory, nothing but stock in trade into capital asset. On the date market value, that itself is recorded as sale. Under PGBP you must show it as sale. Now converted, I got it. On the date of conversion of capital asset, no, the value is 100 lakh. After 5 years I sold this for 5 crore. 5 crore I sold, minus cost of acquisition, how much? Once again, 23, 24, 22, 23 year, my land which is part of my real estate company, I converted into my personal property. That time market value 1 crore. That time 1 crore income I showed in income tax also and then paid tax also. Now after 3-4 years I'm selling it for 5 crore. Now I need to compute capital gain. 5 crore minus cost is what? Exactly. Market value which is converted, right? That itself is cost. This land is purchased by me long back for 10 lakhs only. That is not cost because 10 lakhs up to 1 crore already showed under PGBP. Yes or no? 90 lakhs profit there taxed already. Beyond that 1 crore I need to show it as capital. I mean that 1 crore I will show it as cost of acquisition. Clear? That point will be there in the later. If inventory is converted into stock, if a stock in trade is converted into a capital asset, what is the cost of acquisition of that capital asset? Market value on the date of conversion. That point will be there. Later it will be there. You see, you see here. You see here. Wait, where is it? Yeah. You see here, conversion of inventory into stock in trade. Yeah, you see 49 subsection 9. What this section says? Cost of acquisition in case inventory is converted into capital asset. You see clearly I said not vice versa. Then what is cost of acquisition? Market value of the inventory on the date of conversion into capital asset. Why you need to consider that as a cost? Hey, that much I showed as sale, yaar. Yes or no? In exam they will give you what, if at all they need to test you tough. Okay, the SSE purchased a real estate company. They purchased a land at 10 lakh in books of accounts in 2019 and 20. Later in 21-22, that land is converted by owner into his capital asset when fair market value is 1 crore. Finally, this land is sold by him in 24-25, sold by him in 24-25, or else let us do one thing. Okay, 22-23. Okay, 22-23, let us assume 10th June 2022. Later, this land is sold by the owner on 9th June 2024. At what price? At 5 crore. Evaluate the tax consequences in the multiple years. Now, first financial year 22-23. When inventory which I bought at 10 lakhs, converted into capital asset at 1 crore, automatically 90 lakhs is taxable as business profit, correct? Fine. In 24-25, transfer is before 23rd July. Transfer is before 23rd July. Fine. Okay, 23rd July I transferred. At what price? 5 crore. By the way, before I compute capital gains, first thing I should always decide is what? Is it a long term or short term? 9th June I sold. When I purchased it, 1920 I purchased. Wrong. You should not consider 1920. 1920 when you purchase its inventory, it's stock in trade. When it became a capital asset, it became capital asset on 10th June 2022 onwards. 10th June 2022 to 9th June 2024, exactly 2 years, 24 months only, not more than 24 months. Therefore, it is a short-term capital asset. Are you clear? Okay, sir. Short-term capital asset, I decided. Full value of consideration is what? 5 crore. See, STV point is there or not? Check out simultaneously. STV information not given. Happy. 5 crore minus cost of acquisition. What is cost of acquisition? If I take 10 lakhs, this 90 will be taxed double time, no? So 1 crore. That's what the section 49 subsection 9 says, that only. Are you clear? Now balance is 4 crore short-term capital gain. At what rate short-term capital gain is taxable? 111A immediately. No, 111A applies to listed equity shares, units of equity oriented mutual funds, units of business trust. This is taxable at normal rates. That's it. Understood? All of you. Next. Now again, going back, you're able to understand how to do it. So look at next. Sir, right shares and bonus shares, sir. I purchased right shares. Right shares, bonus shares. Generally, when we use the word bonus share, right share, you directly bought, you directly got allotment from the company. If I purchase in secondary market, will I call it as a right share? First time when the share was allotted to me, it is called a right share, a bonus share. Next time onwards, if I sell that share to somebody, for him it is not bonus. For him it is not right. It's an open market share. Correct? Now tell me, shares come into existence only after allotment? Only after allotment? Before allotment share will be there. Share will be there only from allotment. So period of holding will be considered from the date of allotment, not from the date when you make application for shares. Share application date is there, that is not the date. Allotment date only considered for all securities. If at all you got allotment directly in the primary market. Sir, I bought in secondary market, then purchase date. Understood? Next. Specified equity, sweat equity shares allotted or transfer. Consider from date of allotment or transfer as the case may be. Suppose sir, specified equity, sweat equity, I was allotted, sir, then from allotment date. Or I got it in a transfer from somebody, sir, then transfer date. Clear? All of you? Next. Right renouncement. What is right renouncement? Very simple. Reliance company, I'm having shares in a Reliance company. Company want further capital. They can't go to outsider. First they should ask me, existing shareholder. He cannot go and raise money from outsider. They should ask me existing. I will give you. If I say I will not give you, you should take special permission from me. Only if I give special resolution, then only you can go from outsider. Otherwise you can't go. Correct? So right share, market value 1000 rupees. But since I'm existing shareholder, I am getting the shares at 700 rupees only. I am having 1000 rights. How many rights I have? 1000 rights. I can buy using this 1000 rates, 1000 shares at rupees 7 lakh. Immediately after 3-4 days, I can sell it for 10 lakhs easily. I can easily sell at 10 lakhs. I can make easily profit 3 lakh. But I don't have money. 7 lakhs money I don't have. Ayyo, 300 rupees benefit per share, yaar. If I have 7 lakhs in my bank account today morning, okay, I will buy right shares. Day after tomorrow, I will sell it and then get 3 lakhs profit. Lucky Bhaskar movie. Yes or no? Easily I can get it. But I don't have money. What should I do now? Company gave you one option also. Dear, since you are having 1000 rights, tell me each right has a value, right? Each right has a value, right? What is that value? 300 rupees has a value. 300 a value. 300, how did it arrive? Array, that right has a value 300 rupees here. That's a benefit you get because of that right. I will do one thing. I will tell my friend, look, 700 rupees only I'm getting. Tell me how much is Reliance share? Macha, it is 1000 rupees, 1100 it will be. What if I will give, I will get at 700 rupees only. How did you get? Because I'm an existing shareholder. Sir, buy it. I can't buy it. Getting it? Why? I don't have money. So he told me, do one thing. I will pay you 150 rupees per right. Per right, I will pay you 150 rupees. Renounce your right to me. Extinguishment of right. I renounced my right to my friend. He paid me 150 rupees. And he got the right renouncement. He purchased it from the company at 700 rupees. Later, he sold it for 1000 rupees. He made a profit. Now, I renounced the right, no. I got 100 rupees right. I got 100 rupees right. Sorry, 150 rupees I got right. Renouncement. This is full value of consideration, correct? I did not sell the share, man. I sold my right. Extinguishment of right in a capital asset. I sold my right. I sold 150 rupees I got. For this cost of acquisition is what? Did I incur anything to get this right? I'm an existing shareholder. That itself gave me this right. Cost of acquisition of shares is shares cost, not this right cost. So cost of acquisition of right share is treated as 0. 150 rupees is capital gain. Now I renounced the right, correct? For right, no. Period of holding will be considered from the date of announcement. Period of holding will be considered from the date of offer. From the date of offer by the company. Generally, right announcement is generally 2 months to 3 months only. It will be there. The validity 1 month only, maximum 30 days to 40 days only. So it's always a short-term capital asset. For right announcements, what is the criteria? Suppose they are asking 24 months. What is the criteria? 24 months. Whether it's a long-term asset or short-term asset, 24. Generally 30-40 days only right validity. So it's always short-term capital asset. Are you clear? It is always short-term capital asset. Confident, yes or no? Generally, right, who can renounce? Original shareholder. Original shareholder only can renounce. Are you getting it? Others cannot renounce. Clear, all of you? Next. Now, this is regarding right renouncement. Now again, here I will discuss tax consequences also. Now I'm an existing shareholder, right? I renounced it at 150 rupees. Full value of consideration 150. Minus what is the cost of acquisition? 0. For me, capital gain is 150. Now my friend purchased the share, right? He sold immediately at 1000 rupees. He sold immediately at 1000 rupees. And what is the price at which he purchased it? No, from the company 700. Not only that, he paid 150 rupees to me also, right? Totally 850. For him, the capital gain is 150. Now look at cost of acquisition. Come back to cost of acquisition. Look at this. You see here, cost of acquisition of various assets. Shares and all is financial asset, right? Shares and all financial assets, right? See, financial assets. Right announced. Cost of acquisition is nil. Whereas for right buyer, cost of acquisition of right shares for right buyer will be amount paid to the renouncer, amount paid to the company. Easy or not? Yes or no? That's it. Generally, no. Sir, I didn't renounce, sir. I only bought from the company, sir. Then what is the cost of acquisition? Amount paid by me to the company. Sir, original shares I bought from the company, sir. Directly, primary market, IPO, I got allotment. Amount paid to the company. Cost of acquisition is so simple. Understood? Next. Sir, bonus shares allotted, sir. Cost of acquisition is nil. Bonus shares allotted, cost of acquisition is nil. Okay, now remaining points I will come back to it later. Okay, until now this is enough. Remaining points I'll come back to it later. Slowly in a structured way I'm taking you. Okay, you're able to understand now? Yeah, next. Capital gains, no? Again, see, generally, I think by this time you must have understood the kind of clarity that you get here. Okay, now we think we know it, but only when we see this, we'll understand. There's so much in this. Now, are you clear until now? Now, shares held in amalgamated company acquired under amalgamation. Oh, amalgamated company shares I have. I have amalgamated company shares. I did not buy them. I got the shares because I have shares in amalgamating company. Now, amalgamated company shares I have. Look, I purchased Hero Honda company. I purchased WhatsApp shares long back. WhatsApp company is there. I purchased their shares some 10 years, some 1.5 2 years back I purchased. Now, Facebook acquired that WhatsApp. Now, WhatsApp shares cancelled for me. Facebook shares allotted to me. Are you getting it? Now, Facebook shares, no, today I am selling it. Today I am selling Facebook shares also. Now period of holding, Facebook shares, whether it's a long term or short term, from which date I will consider? From the date of allotment of Facebook shares or from the date I bought WhatsApp shares? Exactly. Include the period of shares. Include period of holding of shares held in amalgamating company. Logical. Same way, what is the Facebook shares? No, I sold at 1,000 rupees. Cost of acquisition I paid at the time of WhatsApp shares 500 rupees. So what is cost of acquisition of shares in amalgamated company? The cost of acquisition is cost of acquisition of shares held in amalgamating company. Cost of previous asset. Yes or no? Next. Sir, shares in demerged, shares in resulting company acquired under demerger, sir. Demerger, already I'm an existing shareholder of one very big company, sir. Tata Motors Limited. I'm already a shareholder. Tata Motors, what they did, 2 years back, passenger vehicle segment is there, right? They demerged and then created one separate company, Tata Motor Passenger Vehicle Limited. They created a new company called Tata Motor Passenger Vehicle Limited. Since I'm an existing shareholder, I have shares on the entire company, including the Tata Motor Passenger Vehicle division. Now the division is created as a different company. In the division, I need to get shares also, right? I need to get shares in the division also, right? The company gave me the shares in the division. Now Tata Motor Passenger Vehicle Company shares are there, right? What is its holding period? The holding period will be considered not from the date of allotment of passenger vehicles, not from the date when I acquire Tata Motor shares. Demerged company, that company is called demerged company. New company is a result of demerger, therefore it is called as a resulting company. Now shares held in resulting company, what is its holding period? The holding period will be considered from the date of acquisition of shares in demerged company. Include the period of shares held in demerged company. Sir, how to consider cost of acquisition here? Come back. Amalgamation, demerger, how to consider cost of acquisition? How to consider cost of acquisition? Now look at this, 49 subsection 2, 49 subsection 2C, entire series is this only. 49 subsection 2. Cost of acquisition of shares in amalgamated company. Facebook, what is the cost of acquisition? Shares, cost of acquisition shall be cost of acquisition of shares in WhatsApp, amalgamating company. Because of the share only I got the new shares. Easy. Cost of acquisition of shares in resulting company, how much? Sir, earlier I am a Tata Motor Limited share. Now I am Tata Motor Private Limited share. Sorry, Tata Motor Passenger Vehicle Limited share. Getting it? Earlier I purchased shares at 1,000 rupees, sir. That time company net worth is 10 lakhs, sir. Okay. Now what happened? 5 lakhs worth of net worth is transferred to 5 lakhs worth of net worth is transferred to new company. Inside that also they gave me shares, sir. Inside that they gave me shares. Look at this equation, very simple. I purchased 1,000 rupees worth of shares in Tata Motors company. Which company? Tata Motors Limited, original main company, demerged company. Okay, TC, demerged company. At the time, net worth is 10 crore. Now what happened, company? 5 crore worth of net worth of the company, they transferred it to new company called Tata Motor Passenger Vehicle Limited. Now because of which earlier I paid 1000, even after removing that company, will the market value of the share, will the share price be same 1000 only? Not at all. Yes or no? So it is transferred. Now here I got, actually this 1000 rupees worth of shares, I have 100 shares totally. Okay, 100 shares cost is 1000 rupees. Fine, remove number of shares. Cost of acquisition, I'm telling you, original cost is how much? 1000 rupees I paid and got Tata Motors share. Now what suddenly Tata Motors is doing? 5 crore worth of 50% of the company, they're transferring it to another company. They're creating a new company and transferring to another company. Are you getting it? They're transferring to another company. Now new company, what is the cost of acquisition? This new company shares I got, I got the new company shares. You know what? I got the shares. I sold it for 5000 rupees open market. I got it, I sold it also. What is the cost of acquisition of the new company shares? This is the question. What is the cost of acquisition of the new company shares? How much net worth transferred? 5 crore. How much is the net worth on the date of demerger? 10 crore. How much net worth transferred in the demerger? 5 crore. Indirectly, out of my total cost, 500 worth is gone to 500 worth is gone to new company. 500 is the cost of acquisition. Balance is, capital gain in the resulting company share. Hello, all of you, until now understood? Fine, I sold the shares. Later what happened? I have in Tata Motors also still some shares I have. I sold them for 3000 in the open market later on. At what price I purchased them originally? 1000 I purchased. But remember, out of 1000, 500 rupees worth of cost I allocated to resulting company shares. Remaining cost left is how much? 1000 rupees minus resulting company cost is equal to 500. This 500 I will claim here. 2500. Nothing but what are the terms involved here? What is the cost of acquisition before demerger? What is the cost of share before demerger? 1000. What is the net worth transferred in demerger? What is the net worth of the company before demerger? 10 crore. How to calculate resulting company? How to calculate resulting company share cost of acquisition is equal to original cost of acquisition before demerger multiplied by net worth transferred during demerger divided by net worth before demerger. Sorry, total net worth of the company before demerger. That's a cost. Now, okay, over. What is the cost of acquisition of shares in demerged company post demerger? Original cost minus resulting company cost is equal to 500 over that provision. You see, what is the cost of acquisition here? You see here, A into B minus C. Actually here it is actually the formula should be A into B by C. That should be the correct way. Of course, like this if you put also correct only you will get, but this is more correct way presentation. What is B? Net book value of the asset transferred in demerger. Net book value of the asset transferred. Net book value is nothing but net worth generally. C is what? Net worth of the demerged company before demerger. What is it? Before demerger. A is what? Cost of acquisition of my shares, cost of acquisition in demerged company before demerger. Are you getting it? Then I will get cost of acquisition of shares in resulting company. Here you see what is the cost of acquisition of shares in resulting company. Next, what is the cost of acquisition of original shares? Cost of acquisition of original shares in demerged company post demerger. Correct? Within bracket you write 49 subsection 2D post demerger. Cost of acquisition is equal to original cost minus cost of acquisition under 49 2C. 49 2C means resulting company cost eliminated. So balance 500 you will get. Easy or not? All of you? Yes. Now again going back to this. Now we are getting confidence. Yes or no? See, I am telling you so many illustrations which you will not find in ICU book, MTP, RTP, nowhere you will find all these numbers, all these concepts, everything I am telling you as a problem. Next. Sir, just 1 minute. Next, next. Conversion of bonds, debentures, debenture stock, deposit certificate into shares, debentures. I converted my debentures bonds old into shares. or I converted my bonds into debentures, like that. Old asset is there, that is converted into new asset. Period of holding of new asset will be not from the date of new asset allotment, but from the date of old asset. Include period for which asset was held prior to conversion. Correct or logical? Not a big deal, right? Next, conversion of preference shares into equity shares. Now, right now, after conversion, what asset you have? Equity. What is equity share holding period? Equity share holding period, date of allotment to sale date plus preference share holding period also you should consider. Include period of holding of preference shares to determine equity share holding period. See, new asset holding period anyhow you will consider, plus previous asset holding period also you will consider. That's what the meaning. Are you clear? Next, electronic gold receipt, EGR. Conversion of gold into EGR. Now I am selling EGR. First I have gold. 10 years back I purchased gold. Okay, that I converted into digital gold. Okay, EGR. Now I am selling that EGR after 5 days only. Now holding period is only 5 days, huh? No. Before conversion you are holding the gold, right? That entire gold holding period which is converted into EGR shall also be considered. Include the period for which such gold was held prior to conversion into EGR. Understood? Plus EGR holding period. Now I sold EGR to another buyer, right? He bought EGR, right? What he did, he kept it for 2-3 years. Then he converted into gold. Conversion is exempted. 47 we saw. You see, all these conversions and all exempted. Remember? Hello. First class itself we can discuss. All these conversions are exempted. No, technically conversion is a transfer. Yes or no? Because one asset is going, new asset is coming. Or one person is going, new person is coming. Transfers. But they are exempted. No. EGR into gold to EGR, that is exempted. We saw that. Are you getting it? Fine. Now I purchased EGR from another person. I waited for 2 years. Then I converted into gold. Very good. After converting gold, what you did? After converting gold, 1 year I kept it and then sold it. Gold 1 year, less than 24 months, short term. No. Gold I am holding 1 year. Before that, I have EGR. 2 years. Total 3 years. It's a long term. Understood? So gold, when you are calculating holding period for gold, right, which is acquired in conversion of EGR into gold, then include the period for which EGR was held prior to conversion into gold. Understood or not? Yes or no? That's it. So conversion of EGR into gold. By the way, you see, conversion of preference shares into equity, conversion of EGRs into gold to EGR, conversion of bonds debentures into shares and debentures, conversion of, shares acquired in resulting company because of demerger, shares held in amalgamated company because of amalgamation. In all these cases, these are all exempted transfers. Subsequently, when you are selling, no, that time period of holding, how to consider, only this section is saying. Then 49 section is saying what is cost of acquisition for them. They are saying what is cost of acquisition of EGR, cost of acquisition of gold. See, simple, sir. EGR, I bought EGR, sir. Then cost of acquisition is EGR. Sir, I bought gold, I converted into EGR. Now I sold EGR. What is the cost of acquisition? Cost of gold. Sir, I have EGR. I converted it to gold. Gold I sold. What is the cost of the gold? Cost of EGR. That's it. Simple logic. Easy or not? Then finally, shares held in a company under liquidation. Shares held in a company under liquidation. Company will announce some date called date of liquidation. Court will give a stamp. Yes, date of liquidation is this. After court order is given, yes, this is the date of liquidation, then only liquidation proceeding will start. Liquidation procedure will take some 6 months to 1 year time. I have a shares in a company. That company is going for liquidation now. I purchased these shares for 10,000 rupees just 6 months back. 6 months back only I purchased. Exactly 6 months over, the company going into liquidation. Date of announcement is date of liquidation. But finally all the assets were sold, company. Liquidation process and all entirely took some 2 years. 2 years time it took. Finally they cancelled my shares after 2 years. After 6 months, after 2 years. 2.5 years. Finally they cancelled my shares and I got some money. Profit is there. Finally I got 20,000 rupees. My cost of acquisition is 5,000 rupees only. Okay, 20,000 minus 5,000 is equal to capital gain. I understand. Is it long term or short term? 2.5 years will you consider? 6 months you will consider? 6 months only. Exclude. What period you should exclude? Exclude the period subsequent to date of liquidation. Once date of liquidation time is freezed. Once the date is freezed, after the 2 years happen, no, don't consider that in period of holding for the shares. That's it. Clear? All of you? That's it. Period of holding, one of the major concept is over. Now still we need to discuss cost of acquisition. Cost of acquisition we need to discuss. Until now clear? All of you? Now this point I'll come back. Indexation point I'll come back. Okay, first still we have so much cost of acquisition discussion. Now, so what is the cost of acquisition of shares, debentures which I received under conversion of debentures previously? See, I am selling shares. Okay, how did you got the share? I didn't buy the share, ma. I bought debenture. That is converted into share. Now I am selling it. What is its cost of acquisition? Cost of acquisition of the bond and debenture before the conversion. Period of holding also that shall be included. Summary is what you know. If a previous asset you have converted into another asset and then selling another asset, what is its holding period? Previous asset holding period will be considered. What is its cost? Previous asset cost only you will consider. That's it. Okay, everywhere the same uniform logic. Names alone will change. Cost of acquisition of specified equity, specified security. Okay, fine. This point I'll come back to it later. Then 49 2A, cost of acquisition of equity shares received under conversion of preference shares. The cost will be preference shares cost. Originally preference shares I'm having, now converted into equity. Equity shares I sold. What is the cost of equity shares? Preference shares cost. Understood? Then cost of acquisition of EGR sold, which was obtained through conversion. Sir, gold I converted into EGR and EGR I sold, sir. Cost of the gold. Sir, EGR is there, right? EGR I bought, sir. I bought EGR only I bought. Later I converted into gold. Gold I sold. What is the cost of the gold? EGR. Cost of acquisition of EGR. Cost of acquisition of gold transferred by a person who purchased EGR. Then cost of acquisition of EGR. Period of holding will also be considered from the date of purchase of EGR. Yes or no? That's it. Simple. Previous asset holding period also will be considered. Easy or not? All of you. Then what is cost of acquisition? Generally, what is cost of acquisition? Generally, you see here, any other capital assets. Generally, what is the cost? Cost is nothing but I always, normally, you see here, normally, second case, you see here, normally, cost will be actual purchase price only. How much I paid, that only. However, if I purchase the asset before 1st April 2001, most important observation, one more date. If I purchase the asset before 1st April 2001, okay, the cost of acquisition shall be higher of actual cost or market value as on 1/4/2001. One more benefit. Sir, in 1990, I purchased some shares. That time cost is some 50 rupees. I'm not selling it. 25 years now. 30 years almost now. Now I am selling this share, sir. 1 lakh rupee each share. Each share is how much? 1 lakh rupee I am selling. When I purchased them 1995, like that I purchased. So you purchased it what? When you purchased it? Before 1 April 2001. Before 1st April 2001 you purchased indirectly. Now you are selling at what price? Full value of consideration 1 lakh. At what price you are selling? 1 lakh. What is its cost of acquisition? This is the question. What the section says? If shares were purchased, nothing, sorry, if the capital asset is purchased on or before before 1/4/2001, market value on 1/4/2001, what is it? Market value on 1/4/2001 shall be taken, or cost of acquisition, whichever is higher. Actually, that provision, if at all I purchased asset in 1995, okay, at what price I purchased? 50. Now I am selling it at 1 lakh. What is its cost of acquisition? 50 or market value on 1st April 2001, whichever is higher. That's what the provision says. If market value on 1st April 2001 generally will be higher, okay, 2000 onwards inflation started like anything, okay, that time 200 rupees is the market value. That 200 rupees I will take. Sir, after 2001 onwards, no, that became 10 rupees only, sir. Then original cost you take. Clear all of you? All of you? Fine. Sir, suppose no, land I purchased. Land I purchased in 1980s. Okay, 100 rupees I purchased. 100 rupees I purchased 1 acre land. Now I am selling it for 100 crore. After 30 years, the land price went up to 100 crore. Are you getting it? 100 crore is the land price. So now I am selling it at 100 crore. Fine. What is its cost of acquisition? Same principle. What principle? If the capital asset is purchased before 1/4/2001, then cost of acquisition is equal to cost of acquisition or fair market value on 1 April 2001. That time market value 10 lakh is there, whichever is higher. However, stamp duty value on 1st April 2001, how much you know? 5 lakh only. Stamp duty value on 1st April 2001 is 5 lakh. First principle is whichever is higher, 10 lakhs. But restricted to stamp duty value. This is just like a standard rent in house property. Just like that we should restrict. Sir, market value 3 lakhs only, sir. Stamp duty value 10 lakhs. Then market value 3 lakhs only will be the cost of acquisition. Understood? This provision is applicable for immovable property. STV concept itself is applicable for immovable. Sir, this is not immovable property, sir. Something else. Then actual cost, market value on 1/4/2001, whichever is higher. Are you clear? Now look at this. Look at this. Special rule for immovable property. Look at this. Special rule for immovable property. Yes or no? Land, building, or both. Acquired when? Before 2001. Immovable property acquired before 2001. Cost of acquisition shall be fair market value on 1/4/2001, subject to maximum of stamp duty value on 1/4/2001. Easy or not? If actual cost is higher, the actual cost you will take. That is one more logic. Are you getting it? Actual cost you will take. Getting it? Then able to understand. But actual cost of market value, whatever it is, it should not be more than stamp duty value on 1/4/2001. Remember that. Clear? Sir, some other land and building, sir. What is other land and building? I purchased it after 1st April. I purchased it after 1st April 2001. Actual cost only. Cost of acquisition is actual cost only. Easy or not? Suppose no. When cost of the property in the hands of the previous owner cannot be determined. Oh, previous owner logic we will discuss later. Okay. If in the hands of previous owner cannot be determined, market value we should take. Fine. This point I have not yet covered. Cost to previous owner concept I have not yet covered. Okay. Cost of previous assets concepts we covered. All that we covered. Cost to previous owner is not yet covered. Okay. Now, so understood this point, everyone? Fine. I'll come back to remaining slowly. I will come back to remaining slowly. Now, intangible assets. What is it? Intangible assets. For intangible assets, the rule is different. What are intangibles? Goodwill, trademark, intangible assets, business assets, tenancy rights, stage carriage permits, all that. Cost of acquisition is simple. Purchase price. Cost of acquisition is purchase price. What about purchased goodwill? Cost of acquisition is purchase price minus depreciation under section 32 up to previous year 1920 only, because from 1st April 2020 onwards depreciation on goodwill is stopped. Are you getting it? Sir, I purchased one company, sir. I purchased one company, purchased another company. Purchase consideration is more than net asset value. 100 crore goodwill is there. We created goodwill 100 crore. Every year we are calculating depreciation under income tax law up to 1920 year on the block. On the block we are computing depreciation up to 1920. Getting it? Whatever up to 100 crore is goodwill minus depreciation you claim some 30-40 crore. What is the cost of acquisition of the goodwill? 60 crore now. What is its cost now? 60. Now this company I'm selling it to another company. I am receiving goodwill 500 crore. 500 crore minus cost of acquisition of my purchased goodwill, because this goodwill is not generated by me. I also purchased and selling it. So cost of acquisition of goodwill is what? Cost of acquisition minus depreciation allowed is equal to balance cost is called as cost of acquisition. Understood or not? For goodwill alone you must calculate like this. Okay, that's it. Actually goodwill depreciable asset, no, it will forming part of depreciable, but from 2021 onwards it is not depreciable asset. 32 will not apply. That's the reason it is taxable here. Are you clear? It's okay. Enough. This clarity is enough. Don't think too much. Okay, this is sufficient. Self-generated asset, sir. It's a self-generated intangible, sir. Cost of acquisition is always nil. Sir, if asset is acquired under section 49 modes, 49, then cost of acquisition will be cost to previous owner. Remember I told you father example, inheritance. Yeah. Next. If cost to previous owner cannot be ascertained. If cost to previous owner cannot be ascertained, sir, I don't know, sir, how much price he purchased, I don't know. When he purchased, you know, I know, sir. That time market value you take. At what price he purchased, you also don't know. Yes or no? My great grandfather, he died long back. So I don't know at what price he purchased. This land I'm selling now. When he purchased, you have land deeds, no? That time market value information will be there, na? That information you take. So if cost to previous owner cannot be ascertained, then cost of acquisition will be fair market value of the asset on the date of acquisition by previous owner only. When he purchased, identify that day fair market value how much, that itself you take. Easy. All of you. This is for intangibles. Okay. The same point is what at last I have given. When cost of property in the hands of previous owner cannot be determined. Market value on the date when the capital asset became property of the previous owner. When the previous owner got the property, that time what is the market value? That only you should decide. That only you should consider. Are you clear until now? All of you? Now, bonus shares. Sir, bonus shares, no, I got company bonus shares. Generally, bonus shares I will get at zero cost. But loophole is there here. Sir, if bonus shares are allotted before 1/4/2001, the cost is zero. But market value on 1/4/2001 I can take, right, as per general provision. Any asset you acquire before 1st April 2001, any asset you acquire before 1st April 2001, generally what is the cost of acquisition? Actual cost or market value on 1/4/2001, whichever is higher. Sir, bonus shares I got in 1995, sir. What is its cost of acquisition? Zero, or market value on 1/4/2001, whichever is higher. Accordingly, cost of acquisition will be market value on 1/4/2001. Are you clear? All of you? Everybody? Now. Okay, I will come back to this bonus shares point again. Pending, there is one more point. I will come back to it later. Now, 49 subsection 1. Remember, cost of acquisition is discussed under 49 and 55. Both the sections are talking about cost of acquisitions only. Okay, 55 is the main section. 49 is talking about different methods in which you got the asset. That time how to decide cost of acquisition. 55 talks about directly you bought the asset, how to decide cost of acquisition. That's what 55 mainly talks about. So if at all you want to understand what is cost of acquisition, 55 you should read, 49 also you should read. Both you should read. Understood? Now, what is cost of acquisition? Cost of acquisition, if capital asset became the property of the SSE under exempted transfers. Earlier owner transferred to you, right? That time it was exempted for him. Like distribution of assets on partition, gift will by individual up to 31st March 2024. Gift will individual is there na? This is only for ESOP, man. This is only for ESOP. Are you getting it? Gift will by individual or inheritance. Are you getting it? Fine. Succession, inheritance or devolution. Distribution of an asset under liquidation. Distribution of asset under liquidation. Okay. Transfer to a revocable or irrevocable trust. Transfer in a revocable or irrevocable trust. Transfer of asset by holding company to its wholly owned subsidiary company. Transfer of assets during amalgamation. Transfer of assets during demerger. conversion of individual property into HUF, all this is irrelevant. In this, remember only these things, distribution of assets on liquidation, okay, transfer under trust, gift or will by individual or HUF up to 31st March 2024. From 1st April 2024, for this, no, better we will see once the law, you will get a better idea. What is the section we are discussing? 49. Oh, yeah, you see, where the capital asset became the property of the SSE on any distribution of asset on total partition or under a gift, will or inheritance. You see third one, by succession, inheritance, devolution, distribution of asset on a liquidation, okay, like that it is there, clear? Okay, that 31st March 2024, remove it. That is only for ESOP it is applicable. Please remove it. Remove it, directly remove it, simple. Nothing to be done. 31st March 2024, remove it, please. That's actually printing mistake. I think I will rectify this. Okay, can some of you just message me on Telegram this point? I will forget. I will remove this. Okay, send me the photo, sir, please remove this, like that you put enough. Okay, yeah, don't forget. I'll be missing. Is there any other place where there is any mistake in this now? Capital gains? No, nowhere. I think significantly nothing is there much. Okay, fine. 31st March 2024, remove it. It will confuse. In ICA book also it is there. That's wrong. Okay, clear? Yeah. Just 1 minute. This 31st March 2024 point is there only in 47. That time, no, ESOP shares gifting is earlier taxable. Now it is exempted. There only 31st March is there. By mistake it was there here also in ICA book also, probably that would have been the reason here. So that's why immediately I get a doubt. That's why whenever I have a doubt, I immediately refer the act. It will be clear. Okay, yeah, just 2 minutes. Yes, so you know what is the cost of acquisition of the asset which became my property, okay, through these modes. First of all, why am I looking for cost of acquisition? The asset which I got, I'm selling now. This entire capital gains topic, when do we discuss? When we are selling. So which means the moment we are seeing this provision means we already sold. That is the reason we want to know cost of acquisition, sale value, period of holding, all that, correct? Remember that. Okay, so context is we sold the asset now. How to compute capital gains? That's what we are going to learn. So what is the cost of acquisition? If capital asset became property of the SSE under these modes, the cost of acquisition will be cost of acquisition to previous owner. I got it as a gift, inheritance, will, sir. Cost to previous owner. What amount he paid? That much, sir. Same way, sir, previous owner also spent improvement, sir. That also can I take? Absolutely. Cost of improvement to previous owner which is incurred on or after 1/4/2001 can be taken. If improvement is incurred before 1/4/2001, we will not consider that. Why? You know, entire property market value on 1/4/2001 we are taking na. That time improvement, why? So improvement expenditure incurred before 2001, 0. Any amount it could be, but you will treat it as 0. That's it. Period of holding. From when period of holding will be considered? The period of holding of previous owner will also be considered. Indexation. The indexed cost of acquisition is available from the year. Indexed cost of acquisition is available from the year the asset was first held by. This indexation point I have not yet covered. Let's do one thing. I'll keep it pending. I'll keep this indexation point pending. I'll come back to it at last. Okay. That's it. Okay. This indexation point also I'll keep it pending. Clear all of you? Yes. So major provision we completed. Now look at 49(2)AA. One more provision. Cost of acquisition of specified securities or specified equity shares received as referred under 17 subsection 2 clause number 6. Nothing but I got specified equity shares from employment. In employment, my company allotted me. What is its cost of acquisition? Market value used for perquisite valuation. At the time when you were allotted, no, market value is there, right? That itself is cost of acquisition. Why? You know, that market value is taxed for you as a perquisite. That's the reason Since it is taxed, it's already treated as income. Since it is treated as income, it means you only purchased indirectly. Yes or no? So that itself is treated as cost of acquisition. Period of holding will be considered from the date of allotment of the specified equity or sweat equity share. Correct? That's it. Next. This is gift. This is what, gift. Tell me, this provision, no. Very, very, very confusing. Now, actually it's not confusing. Suppose, no, in the 49 subsection 1, just now I showed you gift. When I got an asset as a gift, you see there are two sections, 49 subsection 1, 49 subsection 4. 49 subsection 1, I got an asset as a gift. There is a section called 56 in other sources. There is a section called 56 in other sources, 56 subsection 2, clause number 10. There is a clause called 10. Inside this clause, there are two types of gifts, taxable gift, non-taxable gift. There are two types of gifts, taxable gift and non-taxable gift. How did I got the asset? This is a question. I got the asset. I got a land as a gift. Earlier I got the land as a gift. Now I am selling it. Now I am selling that land for 5 crore. Remember this. Now I sold the land for 5 crore. Right? Now I need to compute the capital gain. When I need to compute the capital, my auditor is asking me, sir, at what price you purchased? I told him, sir, I didn't buy, sir. I got it as a gift. Oh, you got it as a gift. When, sir? I asked him. 2-3 years back I got, sir. 3 years back I got this as a gift, sir. Okay. Who gave you the gift, sir? I asked. Sir, my friend gave me. Oh, when your friend gave me, that time it is taxed, no, sir? I asked. Yes, sir, it was taxed. I don't know gift taxation, sir. That time I have another CEO who is auditor. He told me it is taxable. Sir, can I know how much is taxed? I asked. Can I know how much is taxed? Okay, since it's a removable property, right? Okay, it's a taxable gift. Some stamp duty value is taxed. Stamp duty value got taxed. The stamp duty value may be registration date, agreement date, anything it could be. Okay, that date, some date, same logic we already covered in 50C. Similar logic only, they are also there. So stamp duty value got taxed. Sir, how much is the stamp duty value? Please tell me. 1 crore, sir. Cost of acquisition is 1 crore here, which means the gift which you got is taxable earlier for you. If it is taxed earlier for you, no, cost of acquisition is how much amount is assessed, how much amount is considered for assessing gift provision. Taxable gift purpose, how much amount you considered. Sometimes it is stamp duty value, for some assets it is market value. That amount will be considered as cost. That's it. How much you paid, I will not ask you. I told another answer. Sir, I got a gift from my life partner. Okay, from my wife I got a gift. Sir, from your wife you got gift means it's exempted, no, sir? Sir, exempted, sir. That time I didn't show any income also, I didn't pay any income tax also. Exempted, sir. Now I am selling it for 5 crores, sir. Now what is its cost of acquisition? 49(1) is applicable. What is applicable? 49(1) is applicable. What is cost here? Cost to previous owner. Exactly. Cost to previous owner. At what price your wife purchased? Sir, she purchased at 10 lakh long back, sir. Sir, actually she didn't purchase, sir. She got it as a gift from her father. Previous owner means what, Original previous owner. His father purchased. At what price? 10 lakhs. Then 10 lakhs will be the cost. 10 lakhs will be the cost. That's it. Are you clear? If at all the asset which I am selling is obtained by me through gift, at the time when I got this gift, it is exempted. Then cost of acquisition is cost to previous owner. At the time when I got this gift, no, it was taxed for me. Cost of acquisition is equal to how much stamp duty value or market value considered for determining taxable amount. For deciding taxable amount, what market value or stamp duty value considered, that value is cost of acquisition. Understood? That's it. Cost of acquisition of any property which was taxed under 56 subsection 2, the value considered under 56(2) for taxation purpose. Note, if gift is received from a relative, cost of acquisition, if gift received from a relative is exempted. That time cost of acquisition is cost to previous owner. That is what already we covered here. Cost to previous owner. Here it is covered gift. Correct? Everybody? All of you? That's it. Now, if at all we discuss this one provision and two provisions, that's enough. Now, let me discuss about liquidation. No, liquidation I'll keep it hold, because liquidation we have another section called 46. There I will discuss in depth, test all put together. So that will be over there. Okay, now again coming back to shares. Coming back to bonus shares, you see long-term capital asset 112A, remember? 112A, listed equity shares, units of equity oriented mutual funds, units of business trust. Okay, listed equity shares, units of business trust, equity oriented, EOMF means equity oriented mutual funds which are acquired before 1st February 2018, which is acquired before 1st February 2018. What is this 1st February 2018 is all about? Fine, I will do one thing. This particular part I will record it separately right now. Okay, I'll just stop this video. This I will record it and save it as a separate file. Clear? Yes, let's continue. Now I'm going to discuss about one landmark amendment. This is also one landmark amendment. 1st February 2018, Finance Act 2018. Okay, what happened? You know, right now I told you, right, there is a section called 112A. This section is not there that time. That time there is a section called 10 subsection 38. You know what that section says? Listed equity shares, equity oriented mutual funds, units of business trust. If you are selling this, long term capital gains is exempt. Capital gains is exempt. That time what is the consequence? Capital gains are exempt. Long term listed equity shares, listed equity oriented mutual funds, units of business trust, if at all they are long term, capital gain is exempt. Short term 111A is there that time, 15% tax rate, but long term is exempt. This section is removed and brought a new section saying it is taxable at 10%. Later 1 lakh limit they set, and then it is taxable at 10%. That's what the amendment landmark. That's a very big amendment. Stock market like went down like anything, because suddenly you pour capital gains tax. All these as long term shares are exempted. Everybody 12 months, more than 12 months they hold shares, they held shares, sell it, whatever profit fully exempt. Foreign companies, many foreign institutional investors, all they used to invest in India because capital gains is exempted long term. When this amendment came, just like that it happened. Now what happened, you know, with effect from 1st February 2018, it is fully taxable. If you transfer on or after 1st February 2018, the capital gains are taxable. Now tell me, sir, I purchased before 1st February 2018, thinking that tomorrow if at all I get a capital gain, anyhow exempted, I'm holding it from so long ago. Now suddenly you're bringing tax on me. Investor sentiment hurt or not? Foreign institutional investors, will they come and invest in India if you're preaching like this suddenly? Because one of the investment decision for anybody is taxation is also one of the investment decision. Tax is also considered as part of investment decisions. We all invested in Indian stock markets because you have given exemption all these days. Suddenly you are bringing new law and saying it is taxable. What is it? You are saying 1st February onwards, you should have given 2 months time, 3 months time, and then first we would have sold, then you might have implemented the section, but you didn't do like that. Suddenly you implemented. What is this? Then department said, don't worry. What is the market value on 1st February 2018? Identify, you people identify what is market value. See, I purchased at 100 rupees pa. Okay, already right now on 1st February market value 1000 rupees. Tomorrow or day after tomorrow the sale price will be 1200, 1300. I thought I can easily make a profit. Okay, if at all I know that you are going to tax, on this day itself I would have sold 1000 rupees and 900 rupees profit would have been exempted. Now suddenly you are bringing and taxing it. So what department said, you know, don't worry, your cost is what, 100 rupees, right? Market value is what, 1000 rupees on amendment date, right? Whichever is higher, I will give you as a cost of acquisition. Are you happy now? I will give you as cost of acquisition now. Whichever is higher, I will give you as cost of acquisition. Okay, what is the benefit I will get? Array, full value of consideration. You sell the share right now, 1000 rupees. What is the cost of acquisition? 1000 rupees I'm giving you no benefit. Sir, I purchased it 100, but market value on 1st February 2008 is 1000 rupees. What is the capital gain tax? 0. I promised you exemption, right? You got exemption indirectly. Now why are you questioning me? That's it. That's the provision. Are you getting the point? This is the background for this. Higher, lower, that and all, everybody remember. This is the logic behind it. Are you getting it? Now look at the provision. Sir, bonus shares, so listed shares, original shares, so whatever it is, they were allotted or they were purchased by me when? Before 1st February 2018. What is its cost of acquisition? Higher of 1 or 2. Here no nil word I have used, please strike it off. Okay, actually no bonus shares point, no, I copy pasted here. That time I forgot to remove nil, that word. Bonus shares nil, generally cost of acquisition for bonus shares nil. For normal purchased shares some cost will be there. So what is the, look at the provision, what is the cost of acquisition of listed equity shares, equity oriented mutual funds, units of business trust, which I am selling after 1st February 2018 but purchased by me before 1st February 2000. Before 1st February 2018 I bought, sir. 1st February onwards you are taxing me. What is its cost of acquisition? Higher of, you see, higher of, look at this word, higher of cost of acquisition. Cost of acquisition, that you keep it. Or higher of 1 or 2, you see, higher of, look at this carefully, first line, cost is higher of 1 or 2. Only look at the screen or me, this book screen, you look at everybody, don't look at it in your book. Once again I'll repeat, that time you mark your words in the book. Okay, higher of 1 or 2. One is what? Cost of acquisition, nothing but actual cost. Or second one you see, lower of, lower word you ignore. Lower word you ignore for the time being. Higher of cost of acquisition means actual cost, market value as on 31st January 2018. Market value as on 31st January 2018. Understood? Everybody? Hello? Yes or no? You understood, right? Now, fair market value on 31st January 2018. Sir, cost of acquisition, actual cost you told, but you know what? I purchased it before 2001 also. Before 2018 February means 2001 before also will come. That time no. Cost of acquisition, market value, you know, whichever is higher, this one you take. So accordingly, sir, I purchased, cost of acquisition 100 rupees, sir. Market value on 1 for 2001, 1000 rupees, sir. Whichever is higher is equal to 1000 rupees, sir. Compare that with market value on 31st January, 10,000 rupees, sir. You sold now, right? Now you sold, right? At what price you sold? Sir, now I sold it for 50,000 rupees. Now I sold it for 50,000 rupees. Now this is the amount. Now apply this formula. Cost of acquisition 100 or market value on 1 for 2001, whichever is higher, 1000. Compare with amendment date market value. Amendment date market value 10,000. 1 or 2, whichever is higher. But actual consideration is 50,000. Actual consideration is 50. No. Actual, let us take 5,000 only. Let us take actual 5,000 only. Let us take actual 5,000 only. Why, you know? I'll tell you, if actual 5,000 is there, actual consideration is how much right now? I sold it for 5,000. Minus what is cost of acquisition? What is cost of acquisition? 1,000 rupees, which is market value on 1 for 2001, actual cost of whatever. Or market value on 1st February 2018, how much? 10,000 rupees. If I give you whichever is higher, you are claiming happily 10,000 rupees and having 5,000 loss, which you are setting off with another capital asset, you are carry forwarding. Array, that is cheating. Now you are selling at 5,000. Your cost of acquisition cannot be more than 5. Not normally every time. Not normally. Here sale consideration. Why, you know? See, you are asking me 10,000 cost now. Why you are asking? That time market value 10,000, you are asking me 10,000. Earlier, no. Look at this word very carefully. Tell me, if it's a listed share, if I have a profit as per old provisions, it is exempted. What if I have a loss? Ignore. Hello? Profit is there, department is not touching. When loss is there, they will also not touch it. Loss is to be ignored, right? Now that value, if you are considering loss, you are getting, no? This section should not be advantageous for the SSE again here. This section is for compensatory. Because we are taxing, it should compensate your loss, but not you getting undue advantage. So what the department said, you know, Accordingly, what is the cost of acquisition if at all any listed shares, listed equity oriented mutual fund, units of business trust, if at all you are buying them before 1st February, now you are selling 2024 you are selling, or 2025 you are selling, March 2025 you are selling, for example, what is its cost? First identify sale 5,000. Okay, what is its cost? I purchased it at 1,000 rupees. Market value on, when the amendment came, no, capital gain exemption is withdrawn, no, that time market value 10,000 rupees. If I claim this 10,000, it will come into loss. Array, that I am giving you because you lost exemption, this cost. Now you are actually selling it 5,000 only. Why will I give you that much exemption for you? I will not. I will restrict it to 5,000. Therefore, higher of 1, 2, whichever is higher. In the second one, market value on 1st February 2018, you take this. Or sale consideration, if it is lower, no, then take whichever is lower. Sale consideration, you are selling it 50,000, then market value will give you. By giving you market value benefit, what am I telling you indirectly? Look, on the day I bought amendment, you are all scolding. Okay, so that day when I bought amendment, market value I am giving you as a cost benefit. Indirectly I am giving exemption. Yes or no? That's it. Understood? All of you, everybody. So that's the logic behind this. That's the logic behind this. Are you clear? So now this you strike off ma nil. This also, can you please somebody remind me both the adjustments? Okay, somebody please remind me 31st March 49 subsection 1 gift, this nil I should remove. Okay, fine. The cost is higher of 1 and 2. 1 is what? Actual cost, or market value on 1/4/2001 if at all allotment is before 1/4/2001. That is first one. Second one, lower of market value on 31st January 2018. It's not February, by mistake I told February. 31st January 2018, 1st February onwards it is taxable. Or actual consideration, lower. Among these two, higher. Understood the logic now? There is a clear cut logic. If my actual cost is 20,000, then 20,000 you take. If my actual cost is 1,000, exemption, when you withdraw that time 10,000 is their market value, that whichever is higher. I sold ultimately for 5,000 only, then 5,000 only cost. Clear? All of you? That's it. That's it. Normally, sir, I purchased after 1st February 2018, sir. After 1st February, I purchased it, sir. 10,000 rupees I purchased it, sir. Now 5,000 rupees only, sir. Sale price 5,000 minus cost 10. Balance will be loss. That will be carry forwarded. Are you clear? That's it. This entire section is applicable when the shares were allotted to me before 1st February 2018, but now I am selling it. That time this conflict. Clear, all of you? Same way, bonus shares allotted before 1st February 2018, where STT is paid. Which bonus shares? Equity shares, listed equity shares. Are you clear? Generally bonus shares cost is nil. Here it is nil, na? Nil or market value on 1/4/2001 if the allotment is before 2001, lower of FMB actual consideration, higher of 1 and 2. Understood? That's it. That's it. Clear? Which means you need to see even 1 or 2, this is also having importance. When you're reading the book, every word, every letter is important. Be careful. Clear? That's it. Now almost entire cost of acquisition is over, technically speaking. Only few other points are there. Indexation point if I cover, cost of acquisition is over. Literally capital gains major portion over. Understood? Major portion over. Then apart from cost of acquisition, no, there is something called cost of improvement immediately next to this. That also I will discuss, it will be over. By the way, market value is there, right? Fair market value. Fair market value on 31st January, I told, right? Market value. What do you mean by market value? Sir, yes, it is listed on stock exchange on 31st January 2018. You know what? This was asked in September attempt, Jan attempt, MTP, or I don't know, I'm not sure exactly. In one of the attempt it is asked. Okay, capital asset is listed on stock exchange on 31st January. Market value means what? It is trading. 31st January trading, check out. Trading, sir. Highest price quoted on the day. That is market value. No trading happened. Then preceding day you check, that day highest price. Sir, it's a unit, sir. Not listed in the stock exchange as on 31st January, sir. Later it got listed. Not listed on 31st January. Later it got listed, sir. That time net asset value of the unit on the date you take. Okay, on 31st January, unit, if it is units of mutual fund, NAV you take. For units, it is called as NAV, not market value. Okay, that's it. Sir, it's a share only, sir, but not listed on 31st January, but later listed, sir. Okay, not listed on 31st January, sir, but we got it through some other. Simple. It is not, it is listed on date of transfer. It is listed only on the date of transfer. Technically speaking, when I was allotted, no, that time it is not listed. That time cost of acquisition will be index number, indexation for 1718 number. Okay, cost of acquisition, simple, cost of acquisition multiplied by 1718 index number divided by CII of the first year of holding. Why, you know, on these assets capital gains is applicable from 112A, right? Under 112A, indexation facility is not there. So that's why up to 1718 I'll give indexation. Up to 1718 I'll give indexation. That's the logic. Because no, on 31st January they were unlisted. On unlisted shares you generally get listed indexation. Now later they were listed at the time of sale. 112A applied. For example, indexation you will get up to only 1718 only. 99% they will not test this at all. 99.99% this point they will not test. But unit, you remember, capital asset fair market value determination, you remember. This third point you ignore it, ma. Okay, even in the regular class also I tell them to ignore, because there is a background logic. Just now I told 1st February 2018 amendment. If at all we don't know that amendment, we will never understand why that logic. People will be mugging up trying to remember. Even if you forget, no, that formula, later if you remember this story, no, if you remember this particular amendment, no, thought process, you can derive it. Understood? That's it. Now, cost of improvement. What is cost of improvement? Very simple. I purchased a land. What I purchased is land. Empty vacant land. 2005-06. Later I constructed building. You know, I purchased what? Land. Land is purchased by me. When, you know, 2005-2006. Later in 2009 and 10, no, I constructed building. Are you getting it? By the way, this is completely non-depreciable. Why? It's my personal property, not business property. If it is business property, block of asset approach. It's my personal property. Finally, 2024-25 year, I sold it for 10 crore. Land cost is called as acquisition cost, because what I acquired is land only. Building I didn't acquire. I constructed. That is improvement. Building cost is treated as improvement. Sometimes, no, I didn't buy and I didn't improve. My previous owner bought the land and he did improvement. I just inherited. That I am selling at 10 crore. Even then cost of acquisition is cost to previous owner. Cost of improvement is cost to previous owner. Agreed? Suppose if improvement is spent before 1/4/2001, if improvement is incurred before 1/4/2001, ignore. Look at, you know, normally any other capital asset improvement cost incurred before 1/4/2001, nil. Whether SSE incurred, previous owner incurred, irrelevant. 2001 before improvement, ignore. Why are we ignoring? Because no, cost of acquisition is what we are taking for the asset actual cost or market value of the total asset on 1st April 2001 we are taking. Improvement is also considered in market value. Improvement cost incurred by previous owner on or after 2001, then cost of improvement is cost to previous owner, provided asset is acquired under 49 subsection 1 modes. 49 1 mode means what? Gift, will, inheritance, distribution on HUF, amalgamating to amalgamated, all that, yes or no? Improvement cost incurred by SSC on or after, actual cost I spent. That's it. Improvement section over. 55 subsection 1 over. Remaining sections were there above 55. They are all 55 subsection 2. These are all 55 subsection 2. Cost of acquisition of various assets. I hope you are clear now. All of you, except liquidation point, every other circumstance I covered. You know, there is a small theory question here. A share or stock of a company may become property of the SSE as below. Generally, a share of a company, how it will become property for you? Smaller shares can be combined into larger shares. Conversion to stock, you know, shares can be converted into stock. Stock concept is very old. Now it is not there. Now it is only shares concept. Okay. Once upon a time, stock used to be stock. We call it a stock. Okay. Reconversion of shares, subdivision, all this, exam point of view not required. Okay, that's it. Except this liquidation point, rest everything is completed. So what is the story in a simplest way if I have to tell? What is cost of acquisition? Actual cost generally. What if the asset is purchased by me before 1/4/2001? Actual cost or 1/4/2001, whichever is higher generally. What if it is immovable property restricted to stamp duty value on 1/4/2001? What is cost of acquisition of shares allotted in primary market? Actual cost. What is cost of acquisition of right shares? Actual cost. What is the cost of acquisition of right renouncement? Zero. What is the cost of acquisition of a new asset which I got because of conversion from old asset? Cost of old asset. What is the cost of acquisition if I inherited from previous owner? 49 one modes. Cost to previous owner. What if previous owner purchased the asset before 1/4/2001? Cost of acquisition is equal to cost to previous owner or 1/4/2000 market value, whichever is higher. What is cost of acquisition of listed equity share, equity oriented mutual fund, units of Unit Trust of India, which I purchased before 1st February 2018? Cost of acquisition will be higher of actual cost or first market value on 31st January 2018. Right now you sold, right, sale consideration, whichever is lower, compare that with actual cost, whichever is higher. That's it. What if the share is purchased before 2001? Then compare that with market value on 1/4/2001, whichever is again higher. Easy or not? Over. Resulting company, demerged company, I hope you know it. You understood it. Entire cost of acquisition is over. That's it. You see how simplest now? Okay. First you need to discuss one by one. Then you consolidate like this. Nothing is there. Are you getting it? That's it. Now, from previous owner to current, I got it, right? From previous asset to current asset, I got it, right? In all these cases, which are exempted under 47 conversions, transfers, in all these cases, period of holding will be considered from previous asset purchase date, previous owner purchase date, period of holding, to determine whether it's a long term or short term. That's it. Now we need to understand further computation. Now remember, cost of acquisition means we understood. But if you remember format, no, net consideration minus cost of acquisition slash indexed cost of. What is indexation concept? If you understand that, cost of acquisition topic over, cost of improvement just now over, indexation part only we need to understand. If we understand that, capital gains entire problems we can start computing. Clear all of you? Apart from that, there are 4 more circumstances over there. That also we will understand. 45 subsection 2, 45 1A, 45 5. Like the 3 more sections were there. That also we will understand. Immediately we will start computation. After break, we will discuss indexation concept. 45 section has few more subsections. Charging section has few more subsections. That also we will discuss. Then we will start directly computing the problems. Easy? Typically, 70% of the capital gain concept is over. 70% is over. 70. Why 70%? It's not the pages, it's the complexity. Out of 100, 70% of the major topic is over. Then 54 series is there, which is very simple. That's not a big deal at all. Clear? That's it. Okay, we'll take a break and get back. Yes, let's continue the discussion. We need to discuss now indexed cost of acquisition, right? Once that is over, the pending points I will cover, then immediately we can go ahead solving the problems. Okay, now, as I already told, cost of acquisition refers to what? Cost at which asset is acquired by the SSC, or cost to previous owner or previous asset, especially if the asset is acquired under specified modes under 49 subsection 1, 49 subsection 2, all those modes. 49 you can write, need not be 1. 49 you can write, because previous owner, previous asset, conversion of EGRs, gold, all that, yes or no? Conversions. Now, for example, now cost of acquisition we understood. If at all we are transferring capital asset, long term, that too, before 23rd July, remember the moment when I say in the problem before 23rd July, immediately numbers should change in your mind. 12 months, 24 months, 36 months. Yes or no? So accordingly, the asset is a long term or short term will be decided. Understood? I mean, see, land and building, unlisted shares, 24 months. Remaining all other assets except highly volatile assets, Remaining all other 36 months. If at all date of transfer is before 23rd July. If the date of transfer is on or after 23rd July, 12 or 24. 12 is for highly volatile assets, listed securities other than units, units of equity oriented mutual funds, units of Unit Trust of India, zero coupon bonds. That's it. Only 4 assets. Understood? Yeah. So long-term capital asset transferred before 23rd July, right? This is eligible for indexation facility. What is indexation? Very simple. You might have bought at some cost, right? That will be adjusted to inflation now. You might have bought at 10 lakhs. Now inflation factor, they will give you benefit. Inflation advantage they're giving you. That's it. On long-term assets, the department is giving inflation advantage. Okay, market value might be different of the asset, but inflation rate they're giving you proportionately. Indirectly, inflation advantage means what? I purchased at 10 lakhs. Inflated cost means what? It might be some 20-25 lakhs it will become. Naturally, because of indexation, what is happening? My tax rate is, sorry, my cost of acquisition is improving, increasing. Because of that, what is happening? Gain is reducing, so that overall tax is reduced. But now what the department did, they removed indexation. And what they're saying, they reduce the tax rate also. Earlier long-term capital gain tax rate is what generally, other than listed equity shares, all that, okay? Normally what? 20%, where you will have indexation facility. Now indexation removed, tax rate also reduced. So they're compensating like that. Are you clear? Now, indexed cost of acquisition is equal to cost of acquisition identify. Sir, what is cost of acquisition? That's what we discussed so much. Actual cost to fair market value and 1/4/2001, fair market value on 31st January 2018, depends as the case may be, yes or no, multiplied by, you see the numerator, cost inflation index for the year of transfer, denominator CII for the year first held by SSE, CII for the year, of capital asset, cost inflation index for the year of capital asset first held by the SSE, of capital asset first held by the SSE. First, when you are holding that capital asset, identify. Sir, 2005-6 only capital asset came into my hand, sir. Then index number of 2005-6. Sir, I have capital asset in 1985 itself, sir. 1985, there is no index. 2001 to onwards only index number is given. So then 2001 to whichever is later. So denominator index number can be either 2001 to will come, or first case 1 2 or later date. First, when you held, that is most important. If at all you are holding it before 2001, 2002, then 2001 to index number you will get. Like, what are index numbers, sir? Below it is given, you see index numbers. Okay, 2001 to base year is what? 100. 2024-25, what is the number? 365. All these index number you must remember. Don't worry, not just joking. You don't have to remember. In exam they'll give you. Okay, even the latest number also they will give you. You don't have to remember even the latest number also. Even the base number also they will give you, 100 also. You don't have to remember that. Okay, so index numbers they will give you, but they will give you in the question so many index numbers they'll give you. You should pick the right index number. Are you getting it? They'll give you 3-4 to confuse you. You should pick the right index number. Confident? Now that is cost of acquisition, indexed cost. Same way, improvement will also be indexed, right? What is cost of improvement? Cost of improvement multiplied by, same numerator is always same, year of transfer. Until which year I am transferring, until that year you are eligible for indexation. Until year of transfer, denominator year in which improvement is incurred. CII of the year of improvement, CII of the year of improvement, CII of the year of improvement. Here it is what? CII of the year of capital asset first held by SSC. First when you held, that one. They are not saying when you acquired. Cost of acquisition year they are not saying. First when in your asset came, that year we should take. For example, look at this. Suppose my father purchased a property in 2001-2. I inherited in 2014-15. I inherited in 2014-15. I sold it in 2024-25 finally. Period of holding, from when I should count? From my previous owner when he purchased, correct? 1-2 onwards I will have to count, correct? When I sold 2024-25, the gap is more than 24 months, therefore it is a long-term capital asset. Now let us assume I sold it before 23rd July I sold. 23rd July I sold, which means I'm eligible for indexation. I'm eligible for indexation. Now cost of acquisition into numerator 24-25 related index number, correct? Denominator, first in my hands when the asset came 14-15, so 2014-15 index number I should put. Sir, but for holding period we are considering from 1 to onwards, right? Holding period section says it is assumed that you are holding from 1 to onwards, which means index number should be 1 to, right? Denominator, why 14-15? See, index number, denominator if it is small, numerator if it is big, index cost will be bigger. If index number is late 2014-15, automatically index cost will reduce, correct? One SS, you know what he did, sir, you are counting from 2001 to, sir, for holding period. I will take index number 1 to onwards because you are counting from 1 to, right? You are treating that I am holding the asset from 1 to, right? I will also count from 1 to onwards. I will take indexation from 1 to year onwards. I will take SSC, claim it like that. The case went to Bombay High Court. Income Tax Department officer said, sir, look at the section. First held 14-15 number you should put, sir, not 1-2 number. The case went to Bombay High Court. Bombay High Court gave a judgment saying, hello department, you are treating for holding purpose, whether it's a long term or short term, you are treating from 2001 to onwards. Means previous owner when he purchased from that year you are charging for holding purpose. Something beneficial to you are charging there. Index also you should give from that only. Bombay High Court pronounced this judgment. Then after there is no judgment on this against in anywhere else. Therefore now the point is what, the case law is Manjula Jesha. Okay, there is a case in Bombay High Court. As per that case, indexation will be given from previous owner acquisition year onwards. Are you getting it? Whereas as per the act, first year in which you have the asset in your hand. Now in our entire ICA problem, first year in which held by the SSE only solved. Alternative answer you can give this also. Both are right only. But when you're writing this, alternative answer also you should write in the note point below. Both. Are you clear? This is not wrong. This is also not wrong. Technically speaking, Banjula Jesha case, previous one, this is not wrong. Whereas as per ICA, whatever the act one is right. That is right. Indexation from previous owner point of view, can I take from that year? You can take. Is that right? It's not wrong. You see, between these two, which is more accurate? As per formula, it is more accurate. That is right. Manjula Jesha case wrong? No, it's not wrong. That is in Bombay High Court. How can you apply that judgment in some other state? Department can apply this logic. But anyhow, they are giving it. From previous owner holding period is there, right? When previous year acquired the asset, no, from that year itself we are getting indexation. Able to understand? Whereas if you see improvement, no. Year of improvement, they say. Year of improvement means what? Suppose, same example you take 2001-2, my previous owner acquired. 2004-5, he did spend improvement. 2014 and 15, I got inherited. Cost of acquisition, denominator 14-15 number I will put. But for cost of improvement, previous owner only spent this. Denominator 4-5 only I will mention. Because for improvement, denominator formula you see, first held by SSE, they didn't say. Year of improvement, they say. If you remember, if I got asset from previous owner under 49 section, cost of acquisition to him I can take, cost of improvement to previous owner also I can take, right? When cost of improvement is previous owner cost, denominator when he incurred, that number you should put. If I spent improvement, denominator will be in which year I spent, that number I will put. Numerator in both the cases transfer year index number. Are you clear? Everybody? Next. So that's about indexed cost. I hope you are confident on this now. Now you see, there are some indexation benefit on various capital assets which are transferred before 23rd July. There is no indexation on bonds and debentures from the day one itself. Long back itself, no indexation at all on bonds and debentures. However, capital indexed bonds, sovereign gold bonds. These two bonds alone is eligible for indexation. But that remember, that to what? If the sale of them is happened before 23rd July. If at all you are selling on or after 23rd July, no indexation at all. Indexation is removed from 23rd July fully. If you are selling before 23rd July of any asset which you purchased long back, indexation is available. On those assets, bonds and debentures, no indexation. Are you getting it? But capital indexed bonds and sovereign gold bonds, indexation is available. Clear all of you? Next. Highly volatile assets which are covered under 112A, no indexation. For them, no indexation. Sir, before 23rd July, after 23rd, that and all doesn't matter. No indexation. Are you clear? Depreciable assets, specified mutual funds, market linked debentures, unlisted bonds, unlisted debentures, on or after. You here, right here, right. Unlisted bonds, unlisted debentures. Sorry. Already bonds and debentures above there, na? Why? Bonds and debentures by default, you don't no indexation at all. That's why. Okay. Sovereign, depreciable assets, all this, no. First of all, computation format is not this. For them, no, it's always treated as short-term capital is or short-term capital gain or short-term capital loss. So when it is short-term, always treated as short-term, indexation facility itself is gone. Clear all of you? What about sovereign gold bonds? Yeah, indexation is available. What about other capital assets, jewelry, archaeological collection, equity-oriented mutual funds, all that, provided 112A does not apply. For 112A assets, no indexation. Yes or no? So remaining all other capital asset, land, building, all of them are eligible for indexation. Remember one more fundamental point. Indexation concept itself will come into picture if the transfer of the asset in the current year happened before 23rd July 2024. Clear? Understood? Now look at previously. Sir, what if I am transferring on or after? What if I am transferring on or after 23rd July 2024? If any asset is transferred on or after 23rd July, any asset, no indexation benefit at all. Exception. Actually, it is not exception. I can call it as a clarification. I don't call it as exception. Better you name it as clarification. Suppose no. Now suddenly department came and removed indexation. Sir, like, the department argument is what, just a minute. The department argument is what, SSC argument. Sir, I purchased 20 years back land, sir. I just holding it because I have indexed cost of acquisition. All that is there. My capital gain will be exempted. I thought I will pay lower tax, all that. Even though 20% tax rate is there, capital gain amount is so small because of indexation. Cost of acquisition is so big. For example, no? Sir, I purchased a land at 20 lakhs long back. Now I am selling at 1 crore, sir. Indexed cost of acquisition is actually how much, sir? 70 lakh. Hardly I have a capital gain of 30 lakh. Earlier I used to pay 20%, 6 lakhs tax. That's it. But now what department is saying? Indexation is removed. 1 crore minus 20 lakh is equal to 80 lakh. Into 12%, 9.6 lakhs I am paying because of this. If you remove indexation, I am paying 9.5. If indexation is there, the indexed cost is becoming 70 because of some benefit I have. So 6 lakhs only used to pay. Many individuals in HUF suffered like anything. So what department said that time, big issues happened across India. Okay, many started shouting at the government. Then immediately government what they did, no, wait, don't worry. When you are computing capital gain, 1 crore capital gain, 1 crore sale value, yes sir. How much is cost of acquisition, sir? 20 lakhs, sir. 80 lakhs only capital gain. You do one thing. While computing tax, no. While computing tax, computation is same. Computation format, no indexation. Hello, no indexation. When you purchased the land before 23rd July, I purchased it, sir. When are you selling it? After 23rd July, after you brought amendment, I'm selling, sir. Do one thing. You compute capital gain without indexation. Okay, wait. Don't think it is taxing. Compute capital gain without indexation. Now at the bottom, no, working note, no, you compute tax liability, right? That time, no, do one thing. Two options you check. You computed capital gain without indexation, right? On that, apply 12.5% and identify tax. How much? Check it out. Freshly once again compute capital gain with indexation. Freshly compute. Okay, sir, 1 crore. Indexed cost 70 lakh, it is coming, sir, now. 30 lakhs only, sir. Into 20% is equal to 6 lakhs. Here it is 9 lakhs coming. Oh, at the time of tax computation, you found out that with indexation, it is beneficial for you. Okay, do one thing, pay tax 6 lakhs only. Don't pay me 9 lakhs. But remember, when computing capital gain, no indexation. When you're filing IT return, no, capital gain computation you will show, right? There you will not show indexation facility. Without indexation only you will show. But tax sheet will be there. Inside that, you will put without indexation how much tax liability you're getting on capital gain. With indexation, how much tax you're getting. That option you have. This option is given only for individual and HUF who purchased immovable property. Only for immovable property. If immovable property is purchased before 23rd July but sold is on or after 23rd July. I purchased it long back immovable property, but I'm selling after amendment came. Suppose if I'm purchasing immovable property directly on or after 23rd July, after 2-3 years I'm selling it straight away without indexation, capital gain into straight away 12.5% tax. No option like this. Are you clear? All of you. Now in the very first chapter basic concepts, when I'm discussing tax rates, I kept one point, special rates of tax. There one point I kept saying that I will discuss in capital gains. That is this only. What is this? You see here. If at all you are transferring any capital asset on or after 23rd July 2024, no indexation at all. However, residents, only for residents this option is there. By the way, remember, resident individual HF, no. They are transferring long-term capital asset. What asset? Being land or building, which is acquired by them. Which is acquired by them before 23rd July. When they acquired? Before 23rd July 2024 they acquired, but when they are selling after 23rd July, since you are selling after 23rd, no indexation, department is saying, okay now, then they can pay tax at his option as below. You pay tax at the following options. Compute capital gains, first one, without indexation. On that apply tax at 12.5%, identify the amount tax. Compute capital gains with indexation benefit, identify the tax 20%. Okay, identify the capital, compute capital gains with indexation and compute the tax at 20%. Whichever option is beneficial, that much only your basic tax will be. That much only your basic tax will be. But you know what? For example, no, look at this amount. Look at this amount. Very careful, okay? I have a sale value 2 crore. Full value of consideration 2 crore. My cost of acquisition is 80 lakhs. My capital gain is 1.2 crore. Clear all of you? Without indexation. That's it. I am an individual. You know, when I purchased this land, 2005-6 in year I purchased. But I'm selling it after 23rd July year. That's why this problem. See, if I'm selling this on 23rd July before, no, I obviously will get indexed cost. You know what is indexed cost? Indexed cost is 1.9 crore. Only 10 lakhs is capital gain. You're getting it. 10 lakhs only my income. 10 lakhs only capital gain. Able to understand everybody? Yeah. Now look at the adjustment here. Now 1.2 crore. Hello. Show your income as 1.2 crore only. Show your income as 1.2 crore only. Yes sir, I showed sir. Now should I pay tax on that 1.2? No. Wait. You purchased land and building before 23rd July, right? Now you are selling after 23rd July. You got a capital gain 1.2 as per the latest provisions of the law. I understand. Wait. When you're computing tax, no. When you're computing tax, no. Do one thing. Compute tax on 1.2 crore at 12% is equal to 14 lakh approximately coming. Do one thing. Without indexation, you got capital gain 10 lakhs. On that old rate apply, 2 lakhs is coming. Whichever is lower, apply 2 lakhs. Now your basic tax is how much? 2 lakhs. Plus surcharge is applicable at 15%. Sir, surcharge applicable. Capital gain 10 lakh. No. Your income is only... as per original computation format, your income is 1 crore only. 1 crore crossed. Automatically what will happen? Surcharge will apply 15%, 30,000, 2.3 lakh plus 4% pay tax. That's it. Are you clear? So that's why you see cleverly how they see. The SSC chooses the option where the tax amount is lower. Okay, and you see total income computation purpose. When you are computing total income, the capital gains shall be computed without indexation. Remember, for income computation purpose, no indexation. For tax computation purpose, indexation option will be checked. to pay tax in a beneficial manner. Understood? So when you're solving the problem on capital gain, indexation will never come if at all the sale is on or after 23rd July. But when you're computing tax liability, no. If the land is sold, land and building is purchased before 23rd July, no. Before 23rd July, they purchase, sold after 23rd July. At the time of tax computation, indexed cost of acquisition, you compute, revised capital gain, you compute, revised tax liability, you compute. That is only to be done at the time of tax computation stage, not at the time of income computation stage. Understood? That's it. This is one of the major provision. Understood, everybody? Now again, coming back to cost of acquisition. Now, you remember previous owner concept? Previous owner concept. What is this previous owner concept? You see here, cost of acquisition, if the asset become property of the asset under 49 section, SR 49(1), what is the cost of acquisition? Cost of acquisition is cost to the previous owner, improvement it is cost to the previous owner, indexation. The indexed cost of acquisition is available from which year? From the year asset was first held by previous owner, as per Manjula Jesha case. As per Income Tax Act, first held by SSC. Clear? Yes. Note, indexation applies only to assets transferred before 23rd July. If at all asset is transferred on or after 23rd July, no indexation facility. Correct? Almost entire cost of acquisition, cost of improvement concept is over completely. Confident or not? Everybody. Okay? Now, there is one more topic relating to index, cost of acquisition. Forfeiture of advance. What is it? Forfeiture of advance. What is this forfeiture of advance is all about? Generally, forfeiture of advance and all is very popular in immovable property transactions. First let me tell you one small story, simple story. My father purchased a land in 1995. I got inherited in 2006 and my father originally decided to sell that land in 2004-2005. Originally he decided to sell in 2004-5. He even entered into agreement with one buyer and took 1 lakh advance. Later buyer, he could not fulfill the promise and the sale was terminated. But we refund advance? Generally some advance, actual advance and all 5 lakhs he took, but 4 lakhs he returned, 1 lakh he forfeited because you breached the contract. Buyer breached the contract, seller, my father, he forfeited 1 lakh. Fine, good. What is the tax treatment for 1 lakh? No tax treatment because the asset is not yet sold. I just forfeited. I got a benefit, but no tax treatment that time. Okay. Later, 2016-17, I inherited. 2016-17, I inherited. Son inherited. Okay. Again, after inherited, our new generation want to sell the land immediately. Okay. So 18-19, the son decided to sell the land. He took an advance of 2 lakhs. Again, here also that land, buyer, again some breach of contract happened. The son decided, last time my father also same happened, this time no, universe is telling me not to sell the land. So he decided, okay, I will not sell the land. He forfeited 2 lakhs, means son got the benefit, right? Yes. Finally, 2024 and 25, son ultimately sold the land. Son ultimately sold the land for 5 crore. Okay. Now, this is the story. Look at the answer computation. Okay. Full value of consideration is how much? 5 crore. Okay. Minus cost of acquisition is what? How the son has got this land? Inheritance. Cost to previous owner. My father purchased in 1995. Cost, that time 1 lakh only. 1 lakh or market value on 1/4/2001, whichever is higher. Market value on 1/4/2001 is 5 lakh. Market value on 1/4/2001 is 5 lakh. Fine. Advance forfeit, here my father forfeited 1 lakh. Benefit he got in the asset. Son also forfeited some amount, right? That is also benefit, right? The section says, advance forfeited before 1st April 2014, another date again. 1st April 2014. You see the dates, 23rd July 2024, 31st January 2018, 1st April 2001, 4th date, 1st April 2014. That's it, 4 dates only mainly. Okay, so there is another date actually, 31st March 2024, ESOP, 5th date that is, but that's not a significant thing, not an issue. Okay, so that's it. So if at all any advance is forfeited, what you need to do, you know, advance forfeited shall be reduced from, this is how unit tax. Advance shall be reduced from capital cost of acquisition while computing capital gain. You write the word, while computing capital gain on ultimate transfer of that asset. Correct? Ultimately, when you're transferring the asset, no, that time you compute capital gain, right? When you're computing capital gain, cost of acquisition you will reduce, right? From the cost, advance forfeited, reduce it. From the cost, reduce advance forfeited. Indirectly, cost is reduced means advance forfeited is taxed, na? Exactly. So how much my father forfeited? 1 lakh. Wait, don't worry, I will tell one point here. Reduce it. How much is the balance cost? 4 lakh. Are you getting it? Here no, I should not directly come 4 lakhs outside directly. I should see when the land is sold, 23rd July before or after 23rd July. Sir, before 23rd July, sir. Then this index it and then outside put the amount. Indexation shall be done on this and then put the amount. Hello? 5 lakhs is the cost minus, as per section 51, advance forfeited I am reducing. And balance cost is there, right? That I need to index it. If at all transfer is on or before 23rd July. Suppose if the sale is on or after 23rd July, I will not index it. I will directly put 4 lakhs. Balance capital gain is what? Balance capital gain is what? 46 lakhs. Wrong. Sir, there is another advance forfeited by son. How much he forfeited? 2 lakhs. When he forfeited? 16-17. You see here, advance forfeited on or after 2014 1st April. Tell me, advance forfeited is a benefit, right? Technically, that benefit should be taxed in the year in which it is forfeited, no? Department realized their mistake once again. They amended it. The advance forfeited is taxable under IFOS directly in the year of transfer. Why? See, capital gains, when it will apply? Only when there is a transfer. Advance forfeited means transfer did not happen. Therefore, the advance forfeited is a other sources income. 56 subsection to clause number 9 with effect from 1st April 2014. So the son forfeited advance, right? 2 lakh. That is straight away taxable for son in which year? 16-17 itself, in the year of forfeiture. And one important point here. Okay, this 1 lakh is forfeited by previous owner, right? If previous owner forfeited the advance, we will not reduce like this. If SSE forfeited only, we will reduce. This most important point. Sir, my father forfeited 1 lakh, he expired. Now I forfeited, you are taxing it. What about that 1 lakh? No tax treatment for it. Because section 51 only talks about forfeiture of advance by SSE before 31st March 2014. Section talks only about SSE, not previous owner. So there is no section that talks about previous owner forfeited advance. These kinds of loopholes there, na? That's why what they did ultimately in 2014 onwards, when you forfeited, taxable in your hands only in the year of forfeiture. Once upon a time, what is happening? You forfeited long back. That will never be taxable. You are selling the land ultimately. That time only it should be reduced from the cost. Tax is deferred, you know. All these issues were there. That's why they amended it. But in exam, they may give you before forfeited amount before 31st March 2014, before 1st April 2014. That forfeiture they will give you. Forfeiture on or after 1st April 2014. Forfeited by the SSE only should be considered. Forfeited by previous owner, ignore. Understood the story? Everybody? That's it. So, no tax treatment if the advance is forfeited by previous owner. By the way, advance forfeited, no, by current owner before 2014 1st April should be reduced from cost, right? Before indexation you should reduce. After reducing, if any cost available, then that only you have to index it. Understood? That's it. Major provision is over. Capital gains discussion, major provision is over. Now again coming back. Now we understood how to compute full value of consideration. Correct? Then we understood transfer expenses. Then net consideration we know how to compute. Cost of acquisition, indexed cost of acquisition we understood. Correct? Then cost of improvement, indexed cost of improvement also we understood. When indexation apply, when it will not apply. Indexation itself will come into picture if the transfer date is before 23rd July 2024. If at all transfer is on or after 23rd July 2024, no indexation at all. However, resident individual and HUF at the time of tax computation itself, if at all they are selling land and building on or after 23rd July, which the land and building is purchased by them before 23rd July and sold after 23rd July, for them at the time of tax computation stage, indexed cost of acquisition and capital gain compute 20% tax rate apply. Without indexation, compute capital gain and apply 12.5%. Wherever lower tax is there, that is the basic tax for capital gain. Clear all of you? That's it. Next, now you will get capital gain gross. Now we need to discuss what exemptions, and then whatever the final answer will be capital gain. But what we will do, how we will do, first computation of main capital gain only, big issue. If that is right, this and all is right only, easy only. So now we will start computing problems. But before that, I want to discuss 3 more provisions. Okay, tell me, generally capital gains are taxable in which year? Option number 1, year of transfer, year of receiving consideration. Exactly, very good, year of transfer, which means indirectly capital gains is taxable on accrual basis. Can I say like that? When you accrue means what? I sold, I accrued income, taxable. Sir, he is not paying consideration, I am not bothered. You transferred, sale deed is over, you are liable to pay tax. Compute profit, pay tax. Why you sold on credit? Who asked you to sell on credit? Yes or no? So pay tax. But there are 3 sections. 45 subsection 1A, 45 subsection 2, 45 subsection 5. There are 3 sections, 3 occasions, 3 different scenarios where transfer date is different, year of transfer is different, but in that year capital gains will not tax. When you collect money, right, at that time capital gains will be taxable. When you collect money, that time capital gains is taxable. What are they? Case, one, you see, conversion of capital asset into stock in trade. Remember guys, it is capital asset into stock in trade, not stock in trade into capital asset. Be careful. Conversion of stock in trade into capital asset, that is not transfer. 2 subsection 47, transfer definition, you open and see now. Initial first page of the capital gains chapter, you open and see what is transfer include. Second point, 2 subsection 47, first page, capital gain. What is transfer includes? Conversion of capital asset into stock in trade, not vice versa. Conversion of inventory into capital asset. Sorry, conversion of stock in trade into capital asset. That's business profit. Inventory you are converting into capital asset, PGBP applicable. Capital asset you are converting into inventory, capital gain is applicable. Logic clear na? You are transferring capital asset, so capital gain is applicable. You are transferring inventory, so PGBP applicable. Clear? All of you? Now look at this. What is the tax consequence? Very logical. Sir, SSA converting stock in trade or inventory, stock in trade into capital asset, sir. What he is selling? What he is transferring? Stock in trade, sir. That's PGBP, no? Fair market value on date of conversion. Fair market value on date of conversion is treated as sale proceeds. Yes or no? In PGBP. Further, stock in trade is converted into capital asset means business asset only na. Suppose if it is personally withdrawn, then that's a different story. Suppose if it is added to the block, then how much value to be added in block? How much value is added in block? Explanation, some explanation is there, you see. Explanation 10 na. In our PGBP we have seen one table is there na, actual cost explanations. There you see added to block, explanation 9, not 9, 10 or 11 or something is there. Hello, just actual cost 43 subsection 1. Inventory into capital asset ma. 1A, first initial only is there. Yeah, 1A you see. Explanation 1A, what that section says. In stock in trade you are converting into capital asset, na? Add into block. When you are adding into block, no, add same sale proceeds. Same sale proceed, how much you are considering? Fair market value. The same add to block of asset. This is the tax treatment. Are you clear? All of you? Next, Sir, now SS is converting capital asset into stock in trade, sir. I have a land, sir, my own land. I started real estate business, sir. I am converting this capital into real estate, sir. That itself is capital in the company, sir. Oh, you are converting, so stock in trade you are bringing into the company now. What is its purchase cost? Market value on conversion, 1 crore. Market value on conversion, this is purchase cost. Oh, market value at the time of conversion, you're showing it as purchase cost in books of accounts. Good, very good. What about capital gains? You converted, no, that's a transfer. No, sir, yes, a transfer, sir. Full value of consideration is equal to same 1 crore. Under capital gains, the 1 crore is shown as revenue minus cost of acquisition. You compute when the land was purchased by me long back, capital asset is when I purchased long back 50 lakh only I purchased. Then what is the capital gain? 50 lakh. Don't tax it. Compute capital gain and keep it. Don't tax it. It will not be taxable in the year of conversion. Capital gain is not taxable in the year of conversion. See, conversion is a transfer. You can compute profit. Okay, but that is not taxable in the year of conversion. On this, you compute tax at the time when the land is sold. This land is sold at 2 crore ultimately. Now you realized money. Now you realized money. Now you will be in a position to pay capital gain tax. Now it is taxable. Tell me, very simple. You know what happened? 2009-10, I purchased a land for 1 crore ma. Another example. 2019-20, I converted it into, this is actually capital asset. I converted it into business asset, stock in trade. I treated it as a stock in trade. The moment I treated it as stock in trade, I need to record in my books of accounts as purchase of land. Hello. So how much I will record? In 1920, what is the fair market value? 5 crore, sir, market value. In 1920, it is 5 crore. Remember, original cost is 1 crore only. When I converted it is 5 crore. I will show purchase cost in my real estate company P&L account 5 crore. Yes or no? This is in 1920. But I didn't sell that land in 1920. Department, no, what department said, you converted, that's a capital gain, it's a capital asset. So department, what they said, full value of consideration is equal to fair market value on conversion, they said 5 crore minus cost of acquisition, you bought it 1 crore, 4 crore, they are coming and asking, SSC, please pay tax. Sir, wait, I just converted, sir. I didn't sell to anybody. How can I pay tax? I didn't sell to anybody, sir, I just converted. How can I pay tax on it? On just conversion, you'll come and ask me tax, Then do one thing. You converted, your profit is 4 crore, multiplied by tax rate is 20% that time. Conversion 1920 here, tax rate is 20%, approximately 80 lakhs tax is there. Okay, hold it SSC. Don't pay me 80 lakhs now. Keep it with you. Don't pay me. This land finally SSC sold in 2023, 2024. He sold it in, or else let us assume, he sold that land in 2024, 2025. By the way, what he sold in 24, 25, did he sell stock in trade or capital asset? Exactly, he sold stock in trade. Conversion is in 1920. That is transfer of capital asset. What he sold is in stock in trade. What he sold is stock in trade. When what he sold is stock in trade in 24, 25. 23rd July 24 date, is it relevant? Conversion happened before 23rd July. That is transfer date. Transfer means sale, exchange, relinquishment, extinguishment, conversion of capital asset into stock in trade. Everything is a transfer. Transfer happened in 1920. Yes or no? 1920 is only transfer date. Now 2024, 25, I sold it, sir. At what price? 10 crore. This 10 crore you will show it in business, ma. The 10 crore what you collect is a sale proceeds of stock in trade, which will be credited to P&L. Profit from business is how much? Now you sold, right? Now department came to you. Hello, you sold right now, na? Now you pay earlier 80 lakhs tax, which I asked. Okay, sir, I sold now, I have money now. I'll pay tax. Over. Game over. Are you clear? So I will compute capital gains in 1920 itself, but I will not show to the department in 1920. I will directly show that computation in 24-25 to the department. I will pay tax to the department in 24-25, capital gains tax. But that gain tax, everything I will compute and keep it ready in 1920 only. Now tell me, this is purchased in 1910, no? Sold it in 19, converted into 1920, no? Sold it in 24-25, right? Indexation is available, right? Up to which year indexation you will get? 24-25 you will get indexation, 19-20 yeah. ECII, hello, indexation is there pa land pa. Fine, wait. Okay, I'll come back. Fine. Indexation, indexed cost of acquisition. I'm talking about indexation on cost. You are talking about fair market value consideration. Fair market value is what here? Consideration. It's not cost of acquisition. I'm talking about indexation on. Understood? Fine. Fine. Okay. So indexation is available up to which year? 1920. Because the year of transfer is 1920. So indexation is available up to 1920. Are you clear? Cost of acquisition is 1 crore. Are you clear? Indexation, if is there, indexation. Indexation is dependent upon date of transfer. Here date of transfer 1920. So cost of acquisition is indexed. Sale value is how much? Market value on the date of conversion. When a capital asset is converted into a stock in trade, I don't know what is the sale value that time. Market, if at all I sell market value only I would have got. That only they said. So sale value is market value for capital asset computation, capital gain computation purpose. The same market value only in PGBP is purchase cost. In ultimately later if you are selling stock in trade, you are getting some profit or loss. That effect is profit or loss. Suppose no, you see again 2019-20 I converted. At that time market value is 5 crore. For capital gain purpose, full value of consideration is 5 crore minus cost of acquisition 1 crore. Capital gain is 4 crore. Everybody. Later, no, in 24-25, I sold it. For 2 crore only I sold it. Real estate down. Now I have a loss, right? How much is the loss? 3 crore. That's business loss only. The moment it is converted, purchase cost 5 crore. Later, if you sell at higher price, that's a business profit. If you sell at a lower price, it's a business loss. Logic is simple. It's accounting only. It's not tax also. It's there in accounting. Are you getting it? From capital gains point of view, market value 5 crore as it is constant. Hey, sale price, yeah, that's a 5 crore. Later, at what price you are selling, I don't bother. I convert it into stock in trade. From the moment it is converted into stock in trade, I'm not bothered about that asset anymore. 5 crore is at the time of conversion market value minus cost. Indexation up to year of conversion. Suppose if conversion of capital asset into stock in trade is on or after 23rd July. Conversion itself is on or after 23rd July. Then indexation is not available. And ultimately it is sold within 31st March 2025. Capital gain tax is also in the same year. That's it. Confident? That is 45 subsection 2. That is 45 subsection 2. Understood? That's it. That is 45 subsection 2. Now look at here. Where is 45? Yeah, here itself it is coming. Yes. Conversion of capital asset into stock in trade. Applicability. When this section is applicable, if capital asset is converted into stock in trade by the owner for the business purpose, then the same is treated as transfer in the year of conversion. Taxability when year of sale of such stock in trade. Taxability when year of sale. When you are selling stock in trade, ultimately, both capital gains has to be computed, PGBP income has to be computed, and both are taxable. Full value of consideration is what then? Market value of the asset on date of conversion. Indexation is available up to year of conversion. Business income is computed like sale value how much? Market value and date of conversion is equal to either profit or loss. That is accessible under PGBP. That's it. Easy. All of you. That's it. Next. 45 1A. 45 subsection 1A. What is this talking about? Very simple. Destruction of capital asset. What happened? Destruction. Capital asset damaged, destroyed. Compensation is received. Destruction is also treated as capital transfer. You open transfer definition and see destruction point is not there. But transfer definition is inclusive definition. You see, transfer says includes. Means they gave only few items. Transfer can be anything. Destruction is a deemed transfer. Why? Sir, my building, no, my machinery is there or my building is there, got destroyed. But insurance company paid me 5 crore money. I purchased this machine for 2 crore only. The company paid me 5 crore because market value is 5 crore now. That's the reason they paid me 5 crore. Even on destruction, you made a profit, na? Tax it. So capital is destroyed, but you know what happened actually? It is destroyed in 2023-24. But I got compensation only in 24-25. Tell me, when will I pay tax? So destruction happened. Department can pay me tax. Arey, hello, destruction happened here. How would I pay tax? Insurance company has to give me money first. When insurance company is giving, next year they're giving, and the next year they'll come and collect the tax. 24-25. Insurance company paid me compensation 5 crore minus cost of acquisition 2 crore. I purchased this so and so item. Okay, so and so asset I purchased 2 crore is equal to 3 crore capital gain. This entire computation I will do and compute tax, and when I'm liable to pay tax on this in 23-24 destruction era, 24-25 24-25 consideration received era, consideration received, compensation received. But indexation is available up to compensation receiving data, destruction data. Arey, the moment asset destroyed, how can you index it later on? So indexation is available up to year of destruction only. Year of transfer is destruction here. In conversion case, year of transfer is year of conversion. So applicability, money or asset ma, you are receiving some money or asset ma, okay, under insurance due to damage of a existing capital asset due to various reasons. It is treated as transfer of capital asset. Taxability, when it is taxable? Year of receiving the consideration from insurance company. What is full value of consideration? The amount received. Sir, insurance company gave me asset details for, then market value of the asset received on the date of receiving. Indexation available up to year of destruction only. That's it. Easy or not? All of you? Then last one, compulsory acquisition. If this is over, we will start computing problems. Okay. Compulsory acquisition of capital asset. 45 subsection 5. Compulsory acquisition of capital asset. What is it? 45 subsection 5. Compulsory acquisition. Who can acquire compulsorily? Government. Government, no, compulsorily acquiring my capital asset. What happened? Again, I'll tell you a story. Okay. 2005-6 I purchased a house. Okay, very big mansion, bungalow I purchased. That time itself it is 1 crore. For example, I purchased a house in 2005-6. 2022-2023 a national highway has been sanctioned where my bungalow is in trouble. That is on the way of the plan. Government offered me 10 crore money. I felt it is good also, market value. Good amount only they offered. Almost market value, or in fact 10% higher, 20% higher only they offered actually. Okay, 10 crore they offered me. Getting it? So 10 crore they offered me. 20-23 they offered me 10 crore. Getting it? Now. But compensation they didn't pay me now. They didn't pay me compensation now. 20-23 they didn't pay me. When they paid me, 20-24-25 only they paid me. But income tax department is coming 20-23. They got to know about this. Hey, hello, you are getting 10 crore, no? Pay me tax. 10 crore minus 9 crore into 20% tax is equal to 1.8 crore. Pay me first. They're asking, hello, wait. You're asking me 1.8 crore. Okay. I didn't get money yet from government. You only have to pay. You only have to tell. Your department only, na? Government only, na? First you convince them and tell them to pay my money. Are you getting it? Department also understood. So what they're saying now? Okay, fine. I will not tax you now. But remember, 20-23 itself year of transfer. Correct? You transferred in 20-23. I will wait until you receive the compensation. 24-25 SSC got 2 crore only compensation received. Even if part of it is released, that's enough. Income tax department will come and collect the tax. Full amount, whether government released or not, they don't bother. 10 crore full amount, whether you receive full amount or not, don't bother. You will get it, man. Don't worry, you will get it 2-3 years. Along with interest, you will get it. Government will not pay. I know government pay late, but along with interest, they'll pay you. Along with compensation, they're paying interest also, right? That interest is taxable under income from other sources. Interest on compensation, interest on enhanced compensation. Fine. Interest on compensation, they will pay in, that is taxable in other sources. For example, no, 2024-25 compensation part of it released 2 crore. Along with the 20 lakhs interest also they released me. Sorry sir for the delay. 20 lakhs interest also you take. This 2 crore. Now I will compute capital gains. What is full value of consideration? 10 crore. Consideration how much is decided? 10. It's not 2. 2 crore is only you receiving in installment. 10 crore minus cost of acquisition 1 crore. What is the capital gain? 9 crore. Compute the tax at 20%. Why tax at 20%? Sale is happened. Transfer happened before 23rd July. So technically indexation also available. Indexation available, right? Up to which year you will index? 22, 23 only in this example, because that is year of transfer. Fine. So I will pay. I'll compute capital gains. I think you understood, right, that story. Now 20 lakhs extra interest also I received, sir. What about this? This is taxable under income from other sources. 20 lakhs, tax it. You know what? Under other sources, flat 50% deduction available. Flat 50. Just like in house property, flat 30. Flat 50. No questions. 10 lakhs only taxable. Are you clear? Again, no, you computed tax, you paid everything. Again in 2026, 27, finally 8 crore is paid. Plus 1 crore interest amount they paid. Now 8 crore taxable, huh? Already we taxed. I just collected money now. This 1 crore interest is IFOS. How much is taxable? 1 crore. Again minus 50%. 50 lakh. That's it. You know, interest on compensation received from government is taxable on cash basis only. That too under which head of income it is taxable? Income from other sources. When you are taxing it, how much is taxable? After flat 50% only it is taxable. Balance only taxable. Are you confident? Confident? Yes. Just 1 minute. Fine. So you understood, right? So 1 crore if I receive compensation, 50% benefit, all that. No, just once again. So what is this compulsory acquisition? If my capital asset is government compulsorily acquired, they decided compensation so and so amount. I know cost of acquisition, I can compute capital gains, I know all that is fine, but I will pay tax only when I realize the compensation in my hands. Need not be full realization. Even if part of it you collected also, in that year you have to pay tax. But remember, indexation is available only up to year of compulsory acquisition, because that is what year of transfer. Easy or not? All of you? Now it is not yet over still. Suppose no, government compulsorily acquired 2022, 23 they acquired, but they didn't tell you what is the compensation. They didn't tell you what is the compensation, but they release 10 crore money to you immediately. The compensation is very big. Through an interim order, they released money to you 10 crore. Tell me, how much is my compensation, full value of consideration? Do I know? Even though they released part of it, since I don't know what is my consideration, I cannot compute capital gains. Correct? This is not a case of unable to determine consideration. This is not that case also. If you are you unable to determine consideration here? No. We are able to determine. Government will determine and tell in 1-2 years. In 24-25 they determined, sir, 100 crore will give, sir, finally. Now they determined. By the time they determine compensation, you already collected part of it. In 24-25, full value of consideration 100 crore minus cost of acquisition. I purchased it for 5 crore long back. Okay, and acquisition is in 22-23. I will index it up to 22-23 year divided by 2004-2005 I purchased that number. Then I will put indexed cost, balance capital gain 80 crore multiplied by 20% tax I will pay. So did I receive full consideration? Did I receive full consideration? No. Part of it you already received when? Part of it you already received in the year of compulsory acquisition by interim order. Sir, we received, no. Why are we not taxing it? That time, full consideration, how much government also don't know how much they are going to pay. Finally, government decided a final order when? 24-25. So in 24-25, once final order came 100 crore. Now I can compute capital gain. Computed 80 crore is capital gain. Did I already receive compensation part of it? Yes, I already received. Therefore, I will pay tax on it now. Understood? Everybody? Previous example, what I told, compensation fixed 10 crore, but they didn't pay you single rupee. 24-25, they pay you some small amount or full amount. Doesn't matter which amount, how much paid. They paid you. 24-25, it is taxable. Why are we taxing in 24-25? Because I received compensation in 24-25 only. But compensation is decided already in 22-23. In this case, 22-23 itself, compensation I received. But full amount I don't know. Consideration we don't know. Compensation I received, interim order, part of it first they acquired. No, sir, keep it with you temporary. No, they gave me balance 90 crore. When they will receive also, first of all, how much I will get also I don't know. How much I will get, when do I got to know? 24, 25, 100 crore final order they released. They will pay me later on. That's okay. By the time final order release, did I already collected compensation little bit? Yes. Since you already collected consideration little bit and already order also released in 24-25, you can compute capital gains only in 24-25, but indexation is available only up to 22-23. Over. Third scenario. Okay, sir, 24-25, 100 crore compensation decided. No, fine, compensation decided. This is original compensation. I agree. 100 crore I will show full value minus 20 crore cost of acquisition, indexed cost, 80 crore capital gain. I compute tax. I paid also, sir, because 10 crore advance they paid me. Remaining 90 crore also next year, that next year they'll pay, sir. I'm not worried about it. Okay. What 100 crore? That property value 200 crore. I went to High Court. I filed a case on the government. Sir, my property is 200 crore value. Government paid me 100 crore. High Court investigated thoroughly, and in 2026 and 27 year, they decided 180 crore is the final compensation. How much they decided? 180 crore they decided. Already 100 crore decided. That time I already computed capital gains. Everything is over. Now extra how much they decided? 80 crore. Now this 80 crore is also capital receipt only, na, capital gain related only, na, correct? 80 crore is full value of consideration in 26-27. 80 crore is full value of consideration in 26-27. Additional compensation is taxable under capital gains in the year in which that is received. High Court decided in 26-27, but government paid only in 28-29 year. Then in 28-29 only 80 crore is taxable for capital gains. Now when you are taxing this, cost of acquisition 5 crore, indexed cost 20 crore, once again will you claim? No. Why? Already original compensation when it is decided, I claimed, sir. This I didn't have any. I incurred 1 crore legal expenditure, by the way. That you can claim. Transfer expenses, they were called as here. Legal expenditure I incurred na, to get this 80 crore, that you can claim. How much is taxable? 79. Along with 100 crore, along with 80 crore, original 10 crore they released. These remaining 170 crore slowly government releasing. No, along with that they are giving you interest also. Whenever interest is coming on original compensation, interest on enhanced compensation, whatever interest amount you are getting on compensation, enhanced compensation, this is called as additional compensation or enhanced compensation. The interest is taxable under other sources. When you are taxing interest under other sources, flat 50% deduction available. You understood the story? Now come back. Compulsory acquisition of capital asset. This provision is there. No? This is also many will not have clarity. They just read mug up. They don't understand if at all entire this problem is given. Now, applicability. If a capital asset is acquired by central government under compulsory acquisition, the same is treated as transfer. Central government compulsory acquisition only, postponement is there. If state government is compulsory acquired, no. Whenever they acquired, that year only it is taxable. That year only it is taxable. But in reality, if at all compensation is delayed, no, we take this section guidance and then we apply normally in reality also favorable to the SSC. Okay, department office also will not tell anything. Okay, that's it. Taxability. Original compensation is taxable in the year of receipt of compensation. The compensation may be received in full or maybe in part, doesn't matter. Enhanced. If the court awards enhanced compensation which is higher than original, such enhanced compensation is taxable in the year in which it is received. All of you, what is cost of acquisition for enhanced compensation? Nil. Because original compensation time, when you are computing cost of acquisition, you will claim improvement and all, you will claim there. Interim compensation, sir, for example, interim compensation means they acquired asset, first they paid me compensation little bit, final compensation we don't know. Not taxable in the year of receiving it, but taxable in the year of determining final compensation. Sometimes what happens, you got additional compensation every time. Later, that department went to Supreme Court. Sir, yes, this fellow claimed extra compensation, sir, 180. Supreme Court said 150 only. Are you getting it? If the compensation is later reduced by court tribunal, the capital gains of that year will be recomputed again. Okay. If the transfer dies before receiving enhanced compensation, the amount is taxable in the hands of the recipient. If your legal heir is receiving that compensation, no enhancement, he is taxable in his hands. That's it. Easy or not? All of you? Yes, that's it. So date of destruction, all that. Yes, some of you are asking something, you're asking a doubt. When a capital asset is destroyed, we are getting consider compensation from insurance company, and government is taxing us at the time of receiving compensation. The question is how it is moral. I purchased asset for 2 crore. Asset got destroyed and I got 5 crore money. Profit is there, right? Even though it is a destruction, profit is there, right? Profit they are taxing. That's the reason they are taxing. Are you clear? That's it. So 45 subsection 1 here, 45 subsection 2, 45 subsection 5 completed. Literally major capital gain computation provision mechanism we discussed. We have few more discussions, 46 here. Okay, some liquidation, buyback, then 50B slump sale. If at all these three is also over, major computation part is over, then 54 series, something like that we have. So fine, but with this knowledge we can start computing major problems of the capital gains. Okay. So major problem means what? Every problem will have full length, but we will be solving up to gross capital gain computation stage. You see format, once again, if you visualize format, full value minus transfer expense, net consideration minus cost of acquisition, cost of improvement, then capital gain. Below 54 series exemption. That exemption part we will ignore. When we are solving problem, exemption related discussion if it is there, we will ignore. Are you clear? 2 minutes gap, we will start. Okay. Yeah, okay, shall we? Whenever you're feeling tired, no, do deep breaths, deep breathing exercise, intense breathing, inhale, exhale 10 times. Generally, you will be energized again. Generally, we feel tired because of the oxygen issues. Okay, that's it. That when we are continuously talking, we sometimes breathe very less. So that is major reason for us like fatigue and all. We feel like fatigue, all that. So that's why at times I need to breathe. Fine. Shall we compute the problems? And those of you who directly see the problems video and coming into this, no, don't watch it. First watch all the theory questions and then come to the problems. Students are smart, you know what they do? They directly come to problems and then see, they just, sir, can I only solve question bank and then go to exam? You go, you'll not pass. New question will come. How do you interpret? Twists and all will be there. Okay, so don't do that. Next. How will you calculate the period of holding? How will you calculate the period of holding in case of the following assets? Liquidation, shares held in a company in liquidation. This point we saw. Till the date of liquidation only. Exclude the period after the date of liquidation. Correct? Thereafter, the period of holding commences from acquisition and ends with the date the company goes into liquidation. Bonus shares, allotment date. Yes or no? Flat in corporate society. Purchase of members, purchase of shares in that society. Actually, in a society, flat how I will get? I will buy shares in the society. That's how I get flat. So the period of holding shall be counted from the date of allotment of shares in the society and will end the date on which it is transferred. Good. Okay, please read this once. Okay. Later on, A is the owner of a car. On 1st April 2024, he started a business of purchase and sale of motor cars. He treats the above car as part of stock in trade of his new business. He sells the same on 31st March 2025 and gets a profit of 1 lakh. So conversion of car into stock in trade. First of all, car is not a capital asset. It's a personal asset. Remember I told you? Yes or no? That's it. Now you see, X, he is converting capital asset. X is converting capital asset into stock in trade. Converting capital asset into stock in trade. When he acquired on June 10, 2006 for 60,000. Cost of acquisition 60. Conversion happened on when? March 10, 2024, which means conversion happened in 23-24. Year of transfer 23-24. Date of transfer is before 23rd July. If it is a non-depreciable item, indexation is available up to the year of conversion. 23-24 year indexation is available. Agreed or not? The fair market value on the date of above conversion was 5,50,000. This itself is treated as full value of consideration. Now I will straight away compute the capital gains. You see, okay, full value of consideration is equal to market value on the date of conversion. Correct, Amma? 5,50,000 minus indexed cost of acquisition, because conversion is before 23rd July, therefore transfer date is before 23rd July. Cost of acquisition is 60,000. By the way, market value on the date on 1st April 2001, if at all they gave, that is relevant, no, because SSE itself purchased in 2006. So 60,000 multiplied by denominator. When the SSE purchased this 2006-7, so 67 index number is what? It's 2006-7. Actually here they didn't give that. They didn't give index details and all. It's actually capital gains they're not asking to compute. They're only asking tax consequence. But we are computing capital gain for understanding purpose. 2006-7. Denominator year in which first held by the SSE. SSE purchased in 6-7 year. First held how much ma? 122. Numerator 348. 348 index number for 23-24 financial year. Yes or no? What is indexed cost? 1,71,000? 148. What is the answer? Long term capital gain. No. Here what is the answer? 4,852. This is long term capital gain. Are you clear? Further, remember this long term capital gain. This long term capital gain is to be computed. When this entirely is computed, this computation will be done in 24-25 year. This computation will be done in 24-25. Correct? No. Look at this. When the stock entry is ultimately sold, that is important. He subsequently sells in 2024. Oh, 24-25 he sold. So capital gains and all taxable in 24-25. But indexation is available only up to 23-24. Ultimately sold at what? 6 lakhs ma. What is sold is not capital asset. Remember guys, what is sold is business asset. Stock into 6 lakhs. What is its purchase cost? 5.5 lakh. 50,000 is business profit. Easy or not? Yes or no? That's it. Next, illustration 4. Just 1 minute. Yes, look at the continuation. Look at this. M held 2000 shares in a company ABC Limited, okay? An Indian company. The company amalgamated with another company during the year 31st March 25. 24-25 amalgamation happened. Under the scheme of amalgamation, M was allotted 1000 shares in the new company. The market value of the shares is 50,000 higher than the original company. Assessing officer want to tax it. No. Conversion of, receiving shares in amalgamated company by the shareholder of amalgamating company in lieu of amalgamation of, in a scheme of amalgamation, that is exempted. 47. Yes or no? So assessing officer cannot tax. Then, in which of the following situation capital gain tax does not arise? Mr. A, okay, does not arise. In which of the following situations does not arise? They're asking. Mr. A purchased gold in 1970 for 25,000 ma. In the 24-25, he gifted it to the son at the time of marriage. Market value at the time of gift 1 lakh. Gift to son 47. Capital gain will not arise. Yeah. A house property is purchased by HUF in 1945 for 20,000. It is given to one of the family member in 24-25 at the time of partition. FMV. That is also not taxable. Partition distribution on account of partition. 47. Mr. B purchased 50 debentures of 40,000 in 1995, which are converted into 500 shares worth of 85,000 in November 2024. That is also conversion, not taxable. Yes or no? Next. This is regarding reverse mortgage ma. What is this reverse mortgage point? Mr. Abhishek, a senior citizen, mortgage, reverse mortgage theory only. Can you see that on your own? Theory question only, no problem in that. Examine with respect to whether the following statement is true or false. They are asking, are they true or false? Alienation of residential house in a transaction of reverse mortgage notified by the government is treated nothing but reverse mortgage. You are attaching the property to bank. That is not a transfer. Zero coupon bonds of eligible corporation held for 14 months will be treated as long term. Yes, zero coupon bonds 12 months is the criteria. 14 months if you are holding, it's a long term capital. Zero coupon bond means a bond where no repayment and benefits are received or receivable before maturity or redemption. Correct? We don't receive any maturity. Yes. Correct? Next. Now onwards you see problem started. Mr. A, don't look at the answer please. Okay. Mr. A converted his capital asset acquired for an amount of 50,000 in 2004, which means acquisition date is 2004-5. Yes or no? Into stock in trade in the month of November 2023, means conversion is 23-24. The fair market value on the date of conversion is 4,50,000. First to know when it will taxable, that I will see later. I can compute capital gains now, right, with this information. Full value of consideration is what? 4,50,000 minus indexed cost of acquisition. I'm using indexation. Why? Conversion is before 23rd July 2024. Transfer is before 23rd July 2024. Therefore, indexation is available. Cost of acquisition is what? He purchased for 50,000 in 2004, not 2001 before. Okay, so 50,000 multiplied by 45 index number denominator. 113. 23, 24, 348. How much is the cost of acquisition indexed? 1,53,982. Therefore, long-term capital gain is equal to, by the way, long-term capital gain, right, from purchase 2004 to November 2023 only period of holding. Correct? You should write that also in exam. Period of holding will be from 2004 to November 2023. Year of conversion is year of transfer, but taxability will be in the year of sale of stock in trade. First time computing. How much is the capital gain? Correct? Roughly. Okay, that's it. Now, but we only computed. We are not telling when it is taxable. Taxability depends on the stock in trade was sold for 6,50,000 in September 24. Ultimately, in September 24-25, 6,50,000 stock in trade is sold. In business, no. 4,50,000 is cost, right? The 2 lakhs is business profit, and that time only this 2,96,000 capital gain is also taxable in 24-25 previous year only. Taxability is 24-25, but computation and all we can do in 23-24 in this case. Easy. Got the answer? Easy or not? Now you see, you understood now why I didn't solve the problem till now. Period of holding concept is tested, cost of acquisition concept, indexation cost, yes or no, conversion, all this you can't understand with one point. If I discuss blindly and you can't understand. Now you see, fatafat you will do problems. Singhania and Co., a sole proprietorship, owns 6 missions. Depreciable asset. Puts to use in business in March 2023. He started using them in 2023, March 22-23. The depreciation on these machines is charged at 15%. Okay, block of asset is 15%. Plant and machinery block 15. The opening balance of these machines after providing depreciation for 23-24 was 8,50,000. Opening balance after 23-24 depreciation means indirectly opening balance on 1st April 2024 is 8,50,000. Correct? I will directly go to my version. Opening WDV, how much it is, ma? Okay, then 3 of old missions were sold on 10th June for 11 lakh. Okay, sale they gave before 23rd July. No, it's a depreciable asset. It's a depreciable asset. For a depreciable asset, 23rd July concept does not apply. Why? 23rd July and all will apply for which assets? Non-depreciable assets. Hello, cost of acquisition concept itself is applicable for additions. Fine. It's okay. I will do that. I'm not adding it. Okay, fine. So, a second-hand machinery was bought on 8,50,000. First purchase we need to add. Okay, second-hand machinery when it is purchased, ma? 30th November. Less than 180. Yes or no? Less than 180 days. How much it is? Oh, that to 8,50,000. Is there any other purchase? Gross block value how much? 17 lakh. Okay. Then sale of 3 missions only. Part of a block is sold. Part of a block amount received how much, ma? 11 lakhs. Okay. So based on this is what information till now given. Now you are required to determine claim for depreciation for assessment year 25-26. They are asking depreciation. So already now I need to see first how much is the value now? 6 lakhs. Value there as on 31st block also there. Can I compute depreciation? Very much. Now working note 6 lakhs. First less than 180. How much is less than 180? 850. Oh, entire 6 is allocated here only. Balancing figure is 0. 7.5% is equal to 45,000. Correct? Total depreciation is 45,000. Closing WDV after depreciation is 5,55,000. Agreed? Everybody? Yes. Look at. So how much is depreciation? 45,000. Compute capital gains liable for the year. No capital gains. Depreciation is applicable. Therefore, section 50 will not apply. If Singhania & Co sold 3 missions in June 24 for 21 lakhs. Here, sale value is not 11, ma. Sale value is not 11, 21 lakh. Block will become negative. Block cannot be made negative, 0 only. But what about extra 4 lakhs? Short-term capital gain. That's it. Yes or no? When you are computing short-term capital gain, presentation must be shown in a different way. You know, sale value, sale amount received how much? 21 lakh. Correct? Minus gross block value, opening plus addition, 8.5, 8.5 is equal to 17. Not only this, you should also reduce transfer expenses. Of course, in this problem, nothing is given. Therefore, 4 lakh is short-term capital gain. So when you are computing capital gains on depreciation, when you read the problem itself, you will understand whether depreciation applicable or capital gain. If capital gain is applicable, first sale value you put and then compute. If depreciation is applicable, first opening value additions, that format you follow. Easy or not? Yes or no? Next. Illustration 10, let's keep it pending. That's a slump sale related one. We will discuss this in the next class, okay? Next. Illustration 11. You see how easily you are getting the answers? Yes or no? You are able to follow? Mr. C purchased a residential house on July 20, 2022. Okay? Oh, 22 year, yeah. 22, 23 he purchased. Okay, fine. We'll see. July 20th ma. How much? 10 lakh. Made some additions to the house incurring 2 lakhs in August 2022. Acquisition cost 10 lakh. Improvement cost 2 lakh. He sold the house in April 2024. Array, July you purchased. Sold in April, less than 24 months. Less than 24 months means what? Short-term capital asset. Moreover, the house is sold before July 23rd. But generally, since it's a short-term asset, indexation concept anyhow not there. This point is irrelevant here. Suppose if it's a long-term, then that impact will be different. Yes or no? How much at what price he sold? 20 lakh. Okay, fine. First, up to that, whatever information is given, I will see. Full value of consideration, how much? 20 lakh. STV value, nothing is given. Therefore, can I take the 20 lakhs as it is? All of you, minus transfer expenses 0. Net consideration, 20 lakh. Yes or no? Minus indexation not available at all. Cost of acquisition, how much it is? 10 lakh. What is cost of improvement? 2 lakhs. Yes or no? So how much is the amount? Short-term capital gain. Now here they got short-term capital gain. What they did out of sale proceeds, he spent 5 lakhs to purchase another house. Actually, right now we are not solving. We have not yet covered 54 series. Okay. But I will tell you one point. Suppose if I have a long-term capital gain on sale of house, long-term gain, and that amount I invested in another house, I can claim the deduction. Here what gain I got? Short-term. I will not be eligible for the deduction. The entire point is mentioned under section 54, which we will discuss later. Technically, the provision explained you. Little bit is there, little more complexity is there in the provision. It is not that simple like that. You are clear now? Okay, September 24, all that fine. So right now, what is the short-term capital gain? 8 lakhs. That's it. Here, since it's a short-term capital asset, SSE cannot claim 54 benefit. 54 is available only for long-term. For short-term, he cannot claim. Able to understand? Sir, that last point, 54 section point, we have not yet covered in the class. After this, we will be discussing that only. Don't worry. Are you clear? Next. Can I proceed further? This is regarding illustration 11 is also regarding 54 series. This we will discuss later. Okay. Illustration 13 is regarding compute tax liability. Oh, tax liability. Tax liability. Can I? Or else we'll do one thing. We'll do at last this one. Because no, they're asking default tax regime. They're asking optional tax regime. All that. Okay. You can only compute this. Actually speaking. Remember, unutilized basic exemption concept. You remember? Rebate 87 year, remember, and rebate 87 year not available for 112 year, remember. These 3 points you remember in mind when you are computing. Yes or no? For example, Mr. A is their total income other than long-term capital gain 2,40,000, long-term capital gain 2,40,000 on sale of vacant land. Total income is how much? Age 45, total income is this one. Only normal income 2,40,000, special income 85. But Mr. A aged 45, non-resident, Unutilized basic exemption 10 is there, but for non-resident, unutilized basic exemption logic will not apply. So here 0 tax on 85,000 into transfer took place before 23rd July, 20%, 20%. Okay, 17,000 plus 4% cess. That's it. For non-resident, no, rebate 87 is also not eligible because 87 year rebate is only for resident. So for this answer will be 17,000 plus cess. Are you clear? Roughly I am only solving now itself with y. Okay, again this is also non-resident. 62 years age, still basic exemption is 2.5 lakh only for non-resident. By the way, I'm doing it under optional tax regime. I'm doing it under optional tax regime. Okay, 3 lakh 10, 3 lakhs only, sorry, 3 lakhs, sorry. Non-resident 2 lakh 50 only basic exemption. Correct? Remaining 60,000 is taxable at 5% is equal to 3,000. Capital gain from sale of listed equity shares STT paid on sale. Transfer took place before. Before means what? 10% discount. Sorry, 10% only tax rate. Array 112A yaar. STT paid on sale at the time of purchase. Sale of listed equity shares. 112A gain it is. This is 112A capital gain. 112A capital gain up to 1 lakh no tax. Therefore 3,000 plus 4%, 3,120. Hello. Yes or no? Where is it? 3,120. Understood optional tax regime. Default tax regime you do it. You're able to understand this? Okay. Now see 81 years. Senior citizen. 5 lakh 90. 5 lakhs basic exemption. Remaining 90,000 is taxable at 20% is equal to 18,000. Correct? 60,000 from sale of land in rural area. 0. Yes or no? And if you observe, no, aggregation concept. Aggregation concept. Agriculture income 60,000. No. But aggregation will not apply. Will apply. Aggregation will apply here. Because both are 20% will knock off. Aggregation, whether you do it or not, doesn't matter. 18,000 plus 4%, how much it is? 18,720. Correct? See the answer? Yeah, correct. Hello, tax computation I did first chapter itself. What? So many we did. Okay, very simple here. Tax computation and all. Mr. D 82 non-resident 2.5 lakh only basic exemption, 2.5 lakh exempted, balance 2.3 lakh into 5%, 11,500 plus 4%. That's it. Over. OTR over. DTR you do it. Are you clear? All of you? That's it. By the way, if you remember it here, for resident, no, since optional tax regime, total income crossed 5 lakhs, we are not giving rebate. Whereas in default tax regime, total income put together, agriculture income you leave it. Normal income is 5 lakh 90. Total income 5 lakh 90. Agriculture income is exempted. Total income not exceeding 7 lakhs in default tax regime. Therefore, up to 25,000 rebate is there. Remember that. Clear? That's it. So briefly, I told you please once again solve it. You will understand all the points. We thoroughly solved it. Clear all of you? That's it. Now, TYK. Can I do it? Everyone, TYK, just 1 minute. I will save this file separately. TYK and all big questions, complex. Okay, so that we will solve separately right now itself. So now TYK questions. Okay, be careful here onwards. Okay, TYK. Midun, he purchased 100 equity shares of Good Money Company Limited on 1st April 2007. Equity shares at the rate of 1,000 per share in public issue of the company by paying STT. Oh, IPO itself he purchased in public issue by paying STT. Through stock exchange he would have applied. Okay, so STT paid at the time of purchase, which means it's a listed equity share. Remember, listed equity share means immediately 1128 it should strike for you, or 111 should strike. Company allotted bonus shares in the ratio of 1:1 on 1st December 2023. Thank God it is not before 2018. Okay, little complexity reduce the problem. When bonus shares are allotted on 1st December 2023, what is the cost of acquisition of bonus shares? 0. He has also received a dividend of 10 per share on 1st May 2024. 24-25 company declared dividend. Dividend is taxable under other sources. Okay, He has sold all the shares on 1st October 2024 at 4,000 per share. Immediately our students, what they do, 1,100 shares, so again 100 shares, so 200 shares, they will compute. Wrong. 100 shares originally allotted in 2007, you are selling in 1st October, more than gap is more than 12 months, it's a long term. Yes or no? But anyhow, even though it's a long term, 112A section says indexation is not there because it's a 112A listed equity, no indexation. Whereas bonus shares were allotted on 1st December 2023, whereas the bonus shares are all sold on 1st October 2024, which means less than 12 months. Bonus shares are short term. 111A section will apply. Which section will apply? 111A. Understood or not? Yes or no? Now look at original shares, bonus shares. Original shares is long term capital asset. Bonus shares are short term capital asset. Original asset 112A, this is 111A. Original asset, the tax rate, again the shares are sold on which date? 1st October, means on or after 23rd July. They are asking tax also. They are asking total income and tax also, which means since the shares are sold on or after 23rd July, 12.5% after reducing 1.25 lakh. Yes or no? Yeah. Now look at. So what is the full value of consideration? 4,000 rupees per share. Hello everybody. How many shares? Original shares 100, bonus shares also 100. So 4 lakh, correct? Always follow the format. Minus transfer expenses. Is there anything given? Yes. You see here, paid a brokerage of 1%. You see 1%. One brokerage is paid on selling price. STT also 0.02. No deduction for STT paid. Remember? Yes or no? Yes. 1% on this one. 1% means what? 4,000. 4,000. Agreed. Net consideration how much? 3,96,000. Here also 3,96,000. Correct? Minus cost of acquisition. 112A asset is not eligible for indexation. If you remember, indexation, one box I gave, inside that I clearly mentioned 112A assets, no indexation. Yes or no? Now cost of acquisition. Original shares I acquired. At what price I acquired original shares? In 2007-8, I acquired at 1,000 rupees per share. So 1 lakh is the original shares. Correct? Whereas bonus shares cost is 0 because bonus shares are allotted after 1/4/2001. 0. If at all bonus shares are allotted before 2018 1st February, market value on 31st January, or consideration which is 4,000 rupees, whichever is lower. Yes or no? Cost of acquisition nil, whichever is higher means that only will come. Bonus share. Yes or no? See, every time whenever I'm solving from the day one of the problem, I'm telling you alternative methods also. If at all like this, like that, yes or no, be careful. Now long-term capital gain and short-term capital gain, because bonus shares is a short-term capital gain, this is long-term capital gain. Correct? Long-term capital gain 2,96,000, short-term capital gain 3,96,000. And now you see here, compute his income and tax liability if Mithun pays under default tax regime, assuming he is having other income 8 lakhs. Fair market value on 31st January 2018 is 2,000. We missed this point. This point we missed here. Yeah. 2007. Original shares were allotted before February 2008. 18. See. But when I read this, I recollected. Okay, fine. Okay, but actually I should have not done this mistake. Okay, fine. Anyhow, original shares are allotted in 2017 before 31st before 1st February 2018. Now look at this answer, how it will be changing. Cost of acquisition, I can't do like that. Okay, cost of acquisition of original shares. For bonus shares, it is allotted in 2023, so no problem. Original shares are allotted before 1st February 2018. Higher of 1 or 2. Correct? I'm recollecting. 1 is what? Actual cost, 1,000 rupees. Market value on 2001? No. It is purchased in 2007 or 8 or something. Yes or no? Second, lower of market value on 31st January 2018, which is equal to 2,000, or share consideration 4,000, whichever is lower 2,000, 1 or 2, whichever is higher. Amma, very good. Yes or no? 2,000 into 100 shares means what? 2 lakh. Therefore, capital gain is 1,96,000. Bonus share answer is right. You see how a single date changed the answer. Understood the capital gains impact now? Understanding and remembering both the dates, accuracy. This is how students will do mistakes. Able to understand? So, capital gain problem alone, read full question and then only solve. Okay, because twist will be there at the last. Okay, that's it. So capital gain alone, the method is read full question slowly, one by one logic imagine and then solve it. Okay, fine. Now, by the way, what is his capital gains? Long term capital gain how much ma? 1,96,000. Short term capital gain how much ma? 3,96,000. His other incomes how much? 8 lakhs. Yes or no? Total income is 8,02,000 other income. Hey, no. Wait a minute. I don't think dividend will be considered. He also received a dividend. Directly he said, assuming that he's having other income 8 lakhs. I don't know whether should I consider dividend or not. I don't know. I am thinking his other income. Okay, fine. Let us do one thing. 10 rupees per share into bonus shares were also there. 200 into 10, how much ma? 2,000. Let us consider dividend income is other sources, right? How much it is? 2,000 rupees. Other income also let's consider like that. Okay, assuming here one assumption is 8 lakhs do not include this 2,000 on that assumption, because the question is not clear. Yes or no? How much is the total income? Gross total income how much ma? Okay, fine. Minus chapter 6 deduction, nothing is given. Therefore, total income is also this only. Correct? Total income how much? 13,94,000. Now again, 111A how much? 3,96,000. 112A 1,96,000. Balancing figure 8,02,000. At what rate? Slab rates. This is 111A is taxable at no. Date of transfer is October 2024. The date of transfer is since on or after 23rd July. 111A tax rate is 20%. If the date of transfer is before before 23rd July, 15%. See how complex, no? Small problem. But see how much complexity is there? Yes or no? Now this is minus 1,25,000. Since the date of transfer is after 23rd July, 12.5% tax. If the date of transfer is before 23rd July, how much is the balance gain? 71,000 at the rate of 12.5% is equal to how much? 71,000 into 12.5? 8,875. 3,96 into 20% how much? 79,200. Okay. At slab rate, by the way, before again I am computing which regime? Default tax regime. Default tax regime means, I will divide this. First 3 lakhs 0. Next 4 lakhs is taxable at 5% is equal to 20,000. 7 lakhs to 10 lakh. 1 lakh 2,000 is taxable at 10% is equal to 10,200. So total basic tax here is 30,200 plus 8,875 plus 79,200. What is the total basic tax? 1 lakh 275. Add surcharge. Total income is less than 50 lakh. Therefore, no surcharge. Basic tax, add surcharge 0, subtotal. Plus education cess. Rebate also will not come. Why? Total income is 13,94,000. Therefore, rebate will not come. Suppose if at all agriculture income is also there, then that is one more complexity. Okay. 1,18,275. What is the answer? Same only. That assumption is right. That means dividend point is additionally to be considered. See this problem. 8 marks it will ask. Student will see, hey, what is there in this? Very silly question. He will write, happily, confidently write answer and come back. Suggest answer wrong. Understood all of you? So sensitive. Next. Can I proceed? Next one, ma. Can I, ma? Arav converted his plot of land purchased in July 2004. Means the land is purchased in 4-5 years. which is purchased for 80,000 into stock in trade on 31st March. Conversion is 2324. Market value on conversion was 3 lakh. First I will compute. Okay. Full value of consideration 3 lakh. Minus, is there any transfer expense? No. Conversion only. No, conversion transfer expense won't be there. Okay. So directly indexed cost of acquisition. Why indexation? Conversion is before 23rd July 2024. So transfer date is before 23rd July. Therefore indexation is available. How much it is? 80,000 into denominator 113 I guess. And numerator 348. Indexed cost is how much? 2,46,000. Capital gain, long term capital gain 628. Correct? Fine. I am not talking about taxability. I just computed. Okay. The stock in trade was sold in Jan 25, which means 24-25. Now it is taxable. Capital gain is taxable in 24-25. 3,25,000. Conversion value 3 lakh. So 25,000 is business income. Find out tax liability if any. If so, under which head of income? All that over. Easy or not? You see, long term capital gain 53, PGBP 25, total income 78. Correct? We got the same answer. No? Yes or no? Oh, big again. This is challenging question. We'll see. We'll see. What happened, ma? Okay, you're able to? Fine. Next, question number 3. Mrs. Harshita purchased a land at a cost of 35 lakhs in 4-5 year. Okay? And held the same as her capital asset till 20th March 2024. Okay? She purchased a land at 35 lakhs and held the same up to 2024 March. Okay, what later? What she did? She started her real estate business on 21st March 2024 and converted the said land into stock in trade on the said date. Year of conversion is 23-24. Land is purchased in 4-5. Fine. Let us see. Converted the said stock in trade into. Okay, fine. That's it. When fair market value of the land was 210 lakh. Okay, 210 lakh. Fine. I will do one thing. I'll compute capital gains. No problem. Let me go. Okay. Even the remaining part of the question is that let me compute. Full value of consideration is what? 210 lakh. Minus indexed cost of acquisition, because conversion is before 23rd July. Transfer is before 23rd July. 35 lakh into. Some of you, I think, might, if whoever have solved this problem earlier, might think this is wrong. Wait, I will tell you. Don't worry. At the last, there is a twist. Okay, fine. 35 lakh into numerator 348, denominator 113. What is the indexed cost? Hello? 35 into 348 by 113. 10. Hey, do. That's okay. Okay, we'll do one thing. 210 lakh, 2 crore 10 lakh. Okay, 35 lakh divided by 113. First divided by you put always. Multiplied later you put. Sometimes if you put multiply, calculator will not work. That's why first always, whenever divided by numerator is there, first to put divided by. Some bigger numbers will be there. That time calculator will not be working. That's why put always denominator first, then numerator. Getting it? You must know what kind of problems you face. Okay, for everything you must have a solution. So 35 lakh divided by 113 into 348. How much? Okay. What is the long term capital gain? 1 crore 2 lakh 21,000 22 21,000 238 240 I will keep. Okay, 102 1 crore 2 lakh 21,000 102.21 is also called as 102.2 lakh. Correct? That's it. Fine. Keep it hold. I'm not talking about taxability. I just only computed capital gain and then kept. Now let us read the remaining part of the problem. She constructed 15 flats of equal size, quality, dimension. 15 flats she constructed on the said land. Okay. See, the moment tell me it's a PGBP, right? First of all, in PGBP, 210 lakhs is purchase cost, right? Land. Yes or no? No. She constructed 15 flats of equal size. Cost of construction of each flat is 10. So in P&L account, flat construction cost 10 into 15. Yes or no, how much it is? 150. P&L, I'm just now computing business point of view. Hello, 210 here, you understood everybody? Yes or no? Next. Construction was completed in February 2025. Okay. She sold 10 flats at 30 lakhs per flat. Okay. 10 lakhs, 10 flats she sold at 30 lakhs is equal to 300 lakh. Correct a sale? No. Hello, this is accounting. P&L account, if you don't understand, I can't do anything. Okay. 300 lakhs is sale value. Correct? Next. Remaining 5 flats were held as stock in trade. Okay. Remaining 5 flats, no? Closing stock. Closing stock is how much here? Closing stock is how much here? Closing stock value I should do first. Land cost 210 into 5 by 15. Because no, 210 lakh is the land cost of 15 flats. 10 already sold. 5 flats proportionate cost of the land how much? 170. Okay. Okay, 70. Okay. These 5 flats proportionate cost of building how much? Cost of building for each one is 10 lakh. 5 flats proportionate cost of building is, so closing stock value, what is the profit? 420 minus 360 is equal to profit. That's it. This is taxable under PGBP. You didn't understand, right? This is a different method I solved. This is different method I solved. Now let me look at, I will tell you which method they also solved. I will tell you. Okay. Now capital gain, what I thought, 1 lakh, 2,000, 1 lakh, sorry, 1 crore, 2 lakh. Okay, we'll do one thing. 1 or 2, 102.21 lakh is what we thought, right? Capital gain. But remember, entire land is not sold. Only 10 by 15th portion only sold. When a capital asset is converted into stock in trade, capital gains are taxable only when the stock in trade is sold. Here it is not fully sold. 10 by 15th portion of the land only sold. Accordingly, capital gains taxability will be 10 by 15th. I computed and kept, remember. Computed gain is 1 or 2, no change at all. But in 24-25, how much capital gain is taxable? 10 by 15. Hello? How much is the answer? 68.14. That's the answer. I think they would have done in a different way. Business income 60. Here you see proportionate capital gains arising. How much it is? 68 point. Hello? Yes or no? Correct? But how I told normally provision, this is, see, this and all is, this is integration of accounts, everything, that knowledge. Okay, simple only, nothing is there in this. Okay, but now how I told indirectly, full value of consideration, sir, since all entire land is divided into 15 parts, all the 15 parts is not sold, therefore computation also we will do only for 10 parts. Yes or no? Fair market value 210 lakh into 10 by 15, that only you should tax it, right? Correct? How much is 210 into 10 by 15? 140 minus indexed cost of acquisition. First I will take proportionate cost, 35 lakh into 10 by 15 is equal to original cost how much? Because remember, capital gains taxability is only 10 by 15th portion, correct? Because that much only sold ultimately. So 10 by 15, what is the cost, revised cost? 23.33 multiplied by denominator 113,348. How much is the indexed cost? 71.86. So 68.14 long-term capital gain, correct? That's it. How I did differently, I multiplied at last proportion. They solved like this. You are getting it? Same when now building. Stock in trade is also how much is taxable? Only to the extent sold. How many I sold? 10 flats I sold at 30 lakh. How much is the sale value? 300 lakh. Correct? 210 lakh is the land cost, 10 by 15. So sale related cost of goods sold I need to say reduce from sale value to calculate profit. 210 into 10 by 15 how much? 140. Correct? Minus construction cost is 10 lakhs into 10. Sorry, construction cost 10 only. Yeah. 10 lakhs into 10. 100 lakh. Automatically profit is 60. See how I computed in different ways. Able to understand? That's it. Okay. I hope you understood. Now understood why I said capital gains is toughest. It's actually easy only. Presence of mind, accuracy is required. Okay, that's it. Question number 4. I'm proceeding, ma. Question number 4. How many were there, yaar? 7 only, then we'll finish and go. Okay. Hey, remember everywhere I'm only computing up to gross level, ma. These points we have not yet covered. So this 1 second after covering 54 sets, we'll come and just check 1 second, it will be over. Okay. Now, question number 4. Mr. A is an individual carrying on business. His stock and machinery were damaged and destroyed in a fire accident which occurred in December 2024. Destruction is in 24-25. Date of destruction is in December 24. Date of transfer is December 24. Date of transfer is after 23rd July. Therefore, indexation will not be available. Yes or no? Hi, hello. December 2024 after July 2024. So, destruction date is only transfer date, right? Date of transfer is after 23rd July, right? Yes or no? Which means indexation facility not available, right? Yes or no? That's what I'm telling you. Clear? Destruction means 45 1A. Fine. Now what are all destroyed, ma? Stock, machinery were destroyed. Stock is stock in trade. Machinery is a depreciable asset. If you remember block of asset format, opening WDV, add additions, gross block value, less amount received on sale, transfer, comma, destruction, demolition, that wordings. I told you, remember? So block of asset destruction also has to be reduced, amount received. Careful. Yeah, next. The value of the stock total damage was 650. Okay. Certain portion of machinery could be salvaged. The opening balance of the block as on 1st April 2024. Opening balance they said means WDV after providing depreciation of last year. Indirectly it is how much? 10 lakh 80. Okay. Some, indirectly certain portion of machinery could be salvaged, means part of a block is existing. Remember, suppose if at all here they say, no, none of the machinery could be salvaged. Entire block is over, destroyed. Entire block got destroyed as on 31st March. That could be the meaning. Okay. But here their salvaged means as on 31st March block could have been there. When a block is there, fine. Let us look at. Okay, fine. Let us look at. During the process of safeguarding machinery and in the firefighting operations, Mr. A lost his gold chain and diamond ring which he purchased in 2005 April. Oh, this is non-depreciable. 2005-6 at what price? 1,20,000. The market value of these two items on the date of fire accident. Market value on fire accident date, is it relevant? Irrelevant. But that is considered by insurance company so that they can give you compensation accordingly. Finally, Mr. A received the following amounts from insurance company towards stock 4,80,000. Now you see, stock, how much value got damaged? 6,50,000. How much insurance company paid me? 4,80,000. How much is the loss? 1 lakh. 1,70,000. This is the loss, no? Hello, you totaling calculator and all. If you're not okay, what? 4,80,000 sale amount insurance company paid me. Stock value, how much I lost? 6,50,000. What is the loss? This is business loss or capital loss? Business loss only. Correct? Next. That towards damage of machinery, 6 lakhs I received. But remember, opening WDV how much? 10 lakh 80. Additions and all, nothing is there. Amount received on part of a block only, no? Because amount is salvaged. Yes or no? How much it is? By the way, wait a minute. Okay. Value of salvage is not. Certain portion of machinery could be salvaged. It means probably they are meaning to say They're meaning to say some salvage value they could have been saying. Which means here one interpretation I can take. One, machinery block is there. That is one interpretation. Another one, block itself is not there. Let us go with block not there. Entire block is over. Salvage only found. Yeah, correct one. Salvage means entirely gone here. Salvage means what? Residual value. Machinery. Yeah, I misinterpreted correctly. Salvage means what? Actually, machinery destroyed. That proceeds, some iron and all parts, scrap is there na? That one. Scrap, ignore it. Block is seized. Block is seized. 10,80,000 worth of block is seized. Insurance company paid me only 6 lakhs. 4,80,000 short term capital loss. Agreed or not? Apart from this, towards gold chain and diamond ring, 1,80,000 we received. Okay, full value of consideration, because no gold chain and all is a non-depreciable assets, minus indexed cost. No, because gold chain and damage and all, damage happened in 2024 December 24 means after 23rd July 24, date of transfer, no indexation. Cost of acquisition is what? 1,20,000. So long term capital gain is what? That's it. But at the time of tax computation, should I do indexation and then check tax liability, all that? No, that is for land and building. Exactly. This is gold chain. No indexation at all. Easy or not? That's it. Answer over. Check out the answers once. Your compensation towards loss, I know that is business loss. Toward machinery, 4,80,000 is the excess written down value, will be assessable as short term capital loss. Compensation on gold receipt, no, the capital gains has to be computed. They only said computed. We computed actually. Okay, that's it. Can I proceed? Just another 10-15 minutes we will be winding up. Okay, just 1 minute. Take breathing. Okay, focus on the question. Focus on the question. Okay, I know, that's why read carefully question. You should never think when you're reading. The moment when you're reading, one line completed, one stop, then you should think immediately, you should retrieve, and then you should proceed. Understood? Yeah, shall we? Yeah, look at question number 5. Mr. Sarthak entered into an agreement with Jay Kumar to sell his residential house located at Kanpur on 16th August 2024 for 1 crore 50 lakhs. 16th August 2024 means after 23rd July. Lucky, no problem. But when he purchased this house, you see here, Sarthak has acquired this house in Kanpur in 2001 for 30 lakh. Acquisition is before 23rd July, but sale is after 23rd July, but still no indexation, compute capital gain. But at the time of tax computation, options you need to check. Resident individual, indexation, capital gain, 20% tax. Without indexation, already you computed capital gain, 12.5% tax. Wherever the basic tax is low, that option you will choose at the time of tax computation. Yes or no? Next, anyhow they didn't ask tax liability, but if they ask tax also, this point you remember. Next, the sale proceeds were paid in the below manner. 20% through account paycheck on date of agreement. On date of agreement, sale proceed is paid, advance is there. Therefore, if SDV is there, agreement date only we should consider. Agreement date SDV should be considered, but we should compare it with actual consideration, 110% logic, then decide full value of consideration how much. Yes or no? Remaining on possession, balance after registration, that leave it, not that important. Mr. Jay Kumar hand over the possession of the property on 15th December 2024 and the registration was completed on 14th January. Possession is given on 15th December, registration was completed on 14th January. For example, registration is completed in April 2025. Still it is taxable in 24-25. Why? Possession is given already. Part of the consideration already received. 53 of Transfer of Property Act, part performance of contract, it is also treated as transfer. Yeah, okay. So here registration when completed is irrelevant here, because already we decided SDV is agreement date relevant. Yes or no? Next, he paid the sale proceeds as per sale agreement. Okay, fine. The value determined by stamp value authority. 16th August, agreement date 1.7 crore. 15th December, sorry, agreement date is 16th August. 15th December, possession date 1.7. 14th January, the registration date. For us, what is the date important? 1 crore 70 lakh. First now what I will decide is, full value of consideration. Yes or no? SDV how much we decided? 1 crore 70. Is 170 more than 110% of 150? Yes. 110% of 150 is coming 165. Stamp duty value is more than that. 10% more than deviation is there. Therefore, stamp duty value 1 crore 70 lakh minus cost of acquisition only, my dear, because the transfer date is after 23rd July. In August 2024 it happened. Therefore, no indexation. What is the cost of acquisition? That information we have not yet seen. Mr. Sarthak acquired the residence house on 2001 exactly. On the same day. Before 2001 only market value, all that is important. Yes or no? After recovering sale proceeds from Jaykur. Oh, this is up to here one point, ma. Then sale proceeds came, no, he purchased 2 properties. Oh, it is about investment. Investment point we are not relevant right now. So what is the cost of acquisition? 30 lakh. Therefore, what is the capital gain? 1.4 crore. That's it. Gross capital gain. Look at the answer. That's it. Investments we have not yet seen. This we will keep it pending. Good or not? Next. So big. This is how questions will come in exam. Okay. Now it's okay. Don't get disappointed. What I request you to watch is capital gains. Once again, watch if possible video, or watch at least my marathon. Okay. You already were. I gave you already crystal clear clarity on each and every point. Technically. Okay. That's it. Fine. We'll see. Next. You're ready? You should not see the answer. Okay, don't, no cheating. Okay, yeah. Mrs. Yuvika bought a vacant land for 80 lakhs in 2005. 5-6 year, correct? Registration and other expenses were 10% of the actual cost. Purchase time registration also she incurred. 80 plus 8 lakhs. Total cost of acquisition is 88 lakhs. Total cost of acquisition is 88. Cost of acquisition includes asset cost plus any asset cost, bring it to the present location and usage in our name, registration. That is also cost of acquisition. Be careful. She constructed a residential house on the said land at 100 lakhs in 7-8. This is cost of improvement, 100 lakhs. She entered into an agreement to sell the above house with Mr. Johar, not a relative. Okay, fine. In April 2015, 15-16 years, she entered into agreement to sell. Okay. The sale consideration fixed was 700 lakhs on 23rd April 2015. 2015 means mostly that time agreement would have been cancelled. That's the reason. Mrs. Yuvika received 20 lakhs advance in cash by executing agreement. Okay. However, due to failure on the part of Johar, negotiation could not materialize and the said amount is forfeited. 15 lakhs is forfeited in 2015-16 on or after 1st April 2014. That income is taxable in the same year under other sources. For the current year 24-25, this information is irrelevant, but in note point you should tell this. Clear? Then finally, once again, what happened? Mrs. Yuvika again entered into agreement on 1st May 2024, means right now current year, for sale of this house at 8-10 lakhs. Okay. She received 80 lakhs in advance by RTGS on the date of agreement. Advance is received by other than cash. Stamp duty value on date of agreement will apply. By the way, consideration fixed at what price? 8-10 lakhs is the actual consideration. Let's look at that. Full value of consideration. Actual is how much? 8-10 lakh. Okay, keep it. Next. The stamp value on the date of agreement was 890 lakh. Stamp duty value is what? 890 lakh on the date of agreement. In this example, agreement stamp duty value only relevant, yes or no? We'll keep it. Wait, we'll sue it. The sale deed was executed on 14th July. Date of transfer. Date of transfer before 23rd July 2024. Therefore, computation itself, indexation should apply. Yes or no? Next. For agreed consideration. Okay. The stamp duty value authority has revised the values, hence the value of stamp duty is now 900 lakhs. On registration it is 900 lakhs, but for us already agreement is there, advance is there other than cash, therefore 890 lakhs only applicable. Uvica paid 1% brokerage on the sale consideration. Okay, we'll see. Clear? Fantastic question. Okay, compulsorily solve this again. Now let us look at carefully. Actual consideration agreed 810 lakhs. SDV applicable 890. Is it more than 110%? No. 810 into 110% is equal to 891 exactly. If at all by mistake you took 900 value and compare, your answer could have been 900, you would have gone. Yes or no? Wrong. So the full value of consideration is 810 only. Since stamp duty value is not exceeding 110% of actual consideration is stamp duty value. Yes or no? Sorry, actual consideration is, sorry, full value of consideration is actual minus transfer expenses 1% of sale. Remember, for example, here 900 value applied. For example in an exception scenario, 900 value applied, stamp duty value, but brokerage is always calculated on exactly. In this example, sale consideration is also 810, therefore 8.1. What is the net consideration? 801.9. That's it. Now when she purchased this, where is it given? Oh, above itself it is given. By the time you read question, you forgot above. Okay, what is the cost of acquisition? 88 lakh minus, remember the sale happened before 23rd July registration date, therefore indexation is eligible. 88 lakhs is cost of acquisition multiplied by numerator 363, because current year only it is transfer, denominator 17117. What is it? Indexed cost how much? 273.02, correct? Minus, again improvement is there, building 100 lakhs, denominator improvement is in which year? 7-8 year denominator ma, 7-8 year index number. Array here itself they gave here 7-8 number 129. Yes or no? Next page it is there, you see 363 is equal to 281.4. Okay, fine. Therefore long term capital gain is equal to 801.9 minus 273 minus 281.4. That's it. Gross long term capital gain. Now what is the answer, by the way? Yeah, 247.47 we got. That's okay. That minor difference is okay. Okay, now I want to change one small adjustment in the problem. What? Suppose here she forfeited 15 lakhs, right? She forfeited how much? 20 lakhs, right? Original. When she forfeited April 2015. If it is 2013, what will happen, you know? Here 88 lakh, no, minus 10 we will do, minus 20 we will do. On 68 only we will index it, and then indexed cost will be different. Be careful. Clear all of you? That's it. Balance part of the answer is linked with other provisions that we are yet to discuss. Okay, there we will discuss. Then the last problem, last one only nama, this one. In this what? Tax also they are asking. It's okay, we'll see. Are you ready? 8:30, it's okay. Another 10 minutes hardly. You're able to understand now? Tell me, will anybody understand the capital gains without discussing that entire 3-4 hours what we discussed? Impossible. 4.5 to 5 hours we discussed the concept in order to compute all this. Now you're able to visualize everything, you're able to connect everything. Yes or no? That's it. Some students know, they first read little bit and start solving the problem. Their learning is wrong. This is how the questions will be in exam also. Okay, now Mr. Shiva purchased a house on 1979 for 3,24,000. In addition, he has also paid a stamp duty at 3 lakh, stamp duty value at 10% on 3,50,000. 10% means what? 35,000. Actual cost is what? 3,59,000. Correct? Actual cost 3,59,000. But since the house is purchased before 1/4/2001, cost of acquisition is actual cost or market value on 1/4/2001, whichever is higher, but restricted to. Stamp duty value on 1/4/2001. Yes or no? Yeah. In April 2008, Amma gave per feature point, gave that to 2008 point they gave. In April 2008, Mr. Shiva entered into an agreement with Mohan for sale of the property for 14,35,000 and received an amount of 1,11,000 as an advance. Before 2014, advance is received. However, the sale consideration did not materialize and Mr. Shiva forfeited the advance. Advance forfeited before. Therefore, it has to be reduced from cost of acquisition at the time when the asset is ultimately sold. When we are computing capital gains, until then nothing is taxable. Fine. Then again, in May 2015, one more time he tried. He again entered into an agreement for sale for the said house for 20,25,000 to Deepshika, received 1,51,000 as advance. However, she did not pay the balance amount, so Shiva forfeited the advance. Lucky guy, no? Yes or no? Another time he forfeited. But the forfeiture is in May 2015. Therefore, that amount is taxable under IFOS. If this question comes in exam, pakka 8 marks to 12 marks. Okay? If at all 54 exemption, tax liability is also there. Pakka 12 marks question. If this comes, no, minimum 8 up to 12. Possible or 10 marks question also they can ask. As a 10 marks question also they can ask. In August 2015, Mr. Shiva constructed the first floor by incurring a cost of, in 2015, cost of improvement. Okay. There is only cost of acquisition. Now cost of improvement is also there. When 2015, remember. Okay. Next. On November 2024, finally 24-25, November 2000 means after 23rd July. But the property is purchased by individual before 23rd July. Computation will be without indexation, but at the time of tax computation, with indexation we should do, without indexation we should do, whichever is beneficial, that option. Mr. Shiva entered into an agreement with Mr. Manish for sale of such house for 30,50,000. Okay. Received an advance amount of 1,50,000 as advance through account pay check. Account pay check advance. Stamp duty value on date of agreement will apply. Manish paid balance entire sum and transferred the house to Manish in February 2025. It's okay. Means sale is after 23rd July. Mr. Shiva paid the brokerage at 1% of the sale consideration to the broker. Brokerage is a transfer expenditure which we apply always on the sale consideration, real consideration. Real consideration is 30,50,000. Remember, yeah. Okay. Now they have given on 1st April 2001. On 1st April 2001, fair market value of the property 11,85,000. This is what we consider. 3,69,000 or 59. Cost 3,59,000. Fair market value on 1/4/2001, whichever is higher, 11,85,000. Now I will compute. Okay. Okay. Stamp duty value question is there, na? Forgot. And stamp duty value was 10,70,000. Further, the stamp duty value of the South house on 15th November was 39 lakh, whereas on 20th, stamp duty value on 2001 also given here. So, cost of acquisition is 3,59,000 or 11,85,000, whichever is here, restricted to. Remember that provision? Cost of acquisition on land immovable property? Yes. Further, valuation of stamp value of the same house on 15th November, agreement date 39 lakhs, registration date 41. For us, we already decided agreement date because consideration paid, advance is paid in other than cash. Now, shall I compute? Full value of consideration. Now, actual consideration 30,50,000. I hope everyone are able to see. Stamp duty value 39 lakh. No doubt more than 110%. Therefore, exactly 39 lakh. Agreed? Minus transfer expenses 1% of 30,50,000, which is 30,500. Yes. Net consideration 38 lakh 69,500. Able to understand? Minus, since the sale is on or after 23rd July, no indexation. Cost of acquisition. Cost of acquisition is what? Actual cost 3,59,000 or fair market value 11,85,000, whichever is higher, restricted to 10 lakh. Therefore, no wait. Correct. Cost of acquisition is 10,70,000. minus forfeiture before 1st April 2014. Yes or no? How much is that forfeiture before 1st April 2014? 1 lakh something. 99% students will forget this when they're writing. Remember the checkpoints every time when you're solving checkpoint. Next, balance cost is how much? 9,59,000. This is cost of acquisition. Then we have cost of improvement also, some 3,90,000. Okay, 3,90,000. Therefore, long-term capital gain is how much? See, 38,69 minus 959 minus 390. How much, ma? 25 lakh 20,500. Correct? Fine. Compute cap. Oh, thank God, 54 series is not there. We can compute final answer also. Now, 25 lakh 20,500, ma. Yes or no? Long-term capital gain is 25 lakh 20,500. Okay. Compute capital gains in the hands of SS. Also compute tax liability, assuming the basic exemption limit is fully exhausted against other income. So other income is exactly equal to basic exemption limit. That's what they mean to say. Indirectly, other income is his age is what? They have not given. That's okay. Under which regime? If no regime is given, yeah, default tax regime I will apply. Okay, fine. Now we will compute. So 25 lakh 20,000, right? Okay. Basic exemption anyhow set off each other. So 25 lakh 20,500, correct? At the rate of 12.5%. What is the tax? 12.5%. Tell me first. 3,15,660. 063. Now I need to once again compute capital gains here. What I need to compute? Nothing to worry. Cost of acquisition will be indexed. Both will be indexed. This one has to be indexed. This one has to be indexed. Correct? What is the cost of acquisition? See, simply I'll solve. 38 lakh 69,500. Correct? You apply here into denominator 100 because it is purchased in 2001-2. I mean before. Numerator 363. Correct? Everybody. Why are we doing indexation? Tell me. For tax related purpose. That too, why are we doing? Land and building purchased before 23rd July, sold after 23rd July. Option scheme is eligible at the time of tax. So how much is the indexed cost? 34 lakh. Oh my God. He's not getting capital gain itself. Improvement indexation. Denominator 100 into improvement year is which year? 89. Denominator is 1560 na? 254. Oh, in 1560 na improvement done. Then numerator 363. How much is that? 5,57,000. It is turning into loss. There is no tax coming. Therefore, SSE will choose this option. By the way, here there is a loss coming. No, that loss can I carry forward? This is only tax computation checkpoint only. Tax itself is not coming. This loss has to be ignored. This is only a checkpoint at the time of loss computation. This loss has to be ignored. So since it's a loss, since it's a loss where the tax is coming 0, if at all that option is available, this option I will take. See the answer. 3,15,000 plus 4%, obviously, okay? 3,27,000. Here it is coming loss. Yeah, correct. Long term capital is how much? 1,60,000. Therefore, which would be better? Since computation is long term capital, if indexation benefit is given, the tax would be nil. However, this computation is only for determining tax liability. The said loss neither carry forward all that. Yes or no? Therefore, the option is this one. Correct? That's it. Clear, all of you? Capital gains is over. Technically, all the problems we completed. Yes or no? No problem we left. One, I think, slump sale only we kept pending. That too, in all the problems, 54 series adjustment we kept pending. That we will discuss in the next session. Clear, all of you? That's it. So, let's continue the discussion on capital gains. All the questions we have completed, TYK illustrations, except some 2 or 3 related topics we will discuss and then finish it off. Okay. Okay. Now we are at the last stage in the capital gains chapter, where we need to discuss about exemptions. If you look at the computation format, we have already understood and we learned how to compute gross capital gain. Now we need to understand exemptions. But before that, there is one more concept called slump sale, 50B. Okay, that we will finish and then we'll go further. Where is that page number, slump sale? 46, 46. I'll come back at last. And 112, one more section that is left for us is 112, tax rates section, correct? Huh? So slump sale, you see 120, yeah, got it. Okay, slump sale. Now if you recollect, what is the period of holding for normally after amendment 23rd July onwards? What is the period of holding? Either 12 months or 24 months. Before 23rd July, what is the period of holding? For immovable property and unlisted shares only 24 months. Remaining all other assets comes under 36. Of course, highly volatile assets 12 months only, common that is. Whereas after amendment 12 or 24, that's it. But remember, under slump sale, first of all, slump sale means what, you know? Selling a division. Selling a division in the sense, you remember discontinuing operations in a company. Suppose a company, you know, that's a different demerger, you know, for example, demerger, or demerger is also, I mean, this is not demerger also, very simple. Suppose I have something called commercial vehicle. I have something called commercial, mine is a automobile company where I manufacture cars, vehicles I manufacture. Passenger vehicles we manufacture, commercial also we manufacture. Somehow we want to focus on the passenger vehicles more. Commercial vehicles we don't want to focus more. That entire commercial vehicles related one, separate factory, separate go downs, everything is there. That entire business itself I am selling. The transfer of the business itself is treated as capital asset. Here this section itself is a charging section. This section itself defines what is a capital asset separately. This section itself decides what is a computation mechanism. This section itself tells what is period of holding also. 50B is the only section in the capital gains topic which has its own charging section, which has its own definition of capital asset, which has its own period of holding determination, which has its own computation format, rules and regulations, separate from all other. In 50B, no other section will apply. That's why you see slump sale is defined under 242, 2 subsection 42C. Technically, you know what? One point I'll tell you, slump sale means what, you know? What income tax department is taxing here, you know? They are taxing goodwill. This section is nothing but they are taxing goodwill. Like, suppose, you know, as I told, one of my business segment, one division, one undertaking, I am selling it to another business, another company, somebody. Okay, I may be anybody, individual, HF, company, or whatever. My business, my division, I am selling it to somebody. As it is, I'm selling. My liabilities, my assets, everything I'm selling. But that is not something like amalgamation or demerger. No, they don't come within the definition of amalgamation or demerger. No, they don't come there. One of my division I am selling to another entity. Operations I am selling to another entity, where the division related assets will be sold, liabilities, everything will be transferred. I get something called purchase consideration. They will pay me purchase consideration. Here it is called as purchase consideration only. In accounting point of view, seller will pay, buyer will pay me, right, to the seller. That's purchase consideration only for the buyer. Whatever the purchase consideration that I receive over and above net worth, or net worth or net asset value, that extra amount is capital gains here. In accounting language, beyond net worth, if I get something else, we call it as what? Goodwill. This section is taxing goodwill only indirectly. If at all you are selling your business, you are getting consideration more than your net worth. That extra consideration is taxable as, you know, long term or short term, depending upon holding period. We'll come back to it later. Clear? This is the slump sale exactly. See, everybody will read slump sale. You know, many students, they read slump sale, they mug up all that. But they don't understand that this is taxation of goodwill. This is what real contextual learning. You need to understand the true learning. You're getting it. So the slum sale is one example where you can see a different dimension. It's not different dimension. That's what actually the intention of the law. Tax goodwill. You see, what is the consideration? You see, full value of consideration, how much? Look at the format. Separate format is given. Full value of consideration, how much? Separate format is given. Minus cost of acquisition, cost of improvement together one time only. But what is cost of acquisition improvement? Net worth only. Tell me, in amalgamation you might have done net asset value or net worth. Consideration minus net worth. Purchase consideration minus net asset value or net worth is called as what? Exactly. Are you getting the point? So it's nothing but 50B section is nothing but taxation of goodwill on sale of an undertaking, sale of a division. Are you clear? Okay, next. Have you heard like this earlier, any of you? Have you understood this? Goodwill taxation. This is nothing but a goodwill taxation. Fine. Now look at what is a slum sale. I don't sell one machinery, one building. No, I'm not selling like that. One business itself I'm selling. Look at this. Transfer of one or more undertakings. I'm selling undertaking, division for a lump sum consideration without assigning values to individual assets and liabilities in transfer. Here no, here I'm getting for the division as a whole money. Each and every asset, how much I'm getting? No. But technically, when we are valuing a business, each and every asset also we will value, correct? Even in slump sale also, each and every asset value will be done. But that valuation is done not to sell each and every asset separately, but to sell undertaking as a whole. Understood? So each and every asset value will be there here also. Individual values will be there. But that is to determine market value. That is to determine value of the division. But when I'm getting consideration, no, I get consideration for my commercial vehicle division. That's it. I will not get consideration for plant and machinery this much, for amalgam, for so and so machineries this much, for so and so building this much. Remember, if I am selling all the assets separately at a separate prices to one company only, that's not slum sale. You will have to apply capital gains as per our section 5048 as usual. But I'm valuing all each and every one, each and every asset and all I'm valuing. But like that I'm not selling. Either buy all of it or don't buy. Division itself you must buy. Liabilities also you must buy. So assets minus liabilities, everything you should take care. That is called a slum sale. Are you clear? This is what happens even in amalgamation also. A selling company will sell all its assets and liabilities to purchasing company. Yes or no? Yeah. So what is an undertaking? It includes any part of the undertaking. It may be unit, it may be division, it may be business activity as a whole, but excludes individual assets and liabilities, not constituting individual assets. If you are selling, that is not called as sale of undertaking. Yes or no? Remember, assigning value to asset and liability for stamp duty purpose does not count as assigning values. See, definition of slum sale means what? Without assigning values to each and every asset and liability. Their identification is not asset wise. Asset wise values and all you should not allocate. When you're receiving money, you should not allocate for this asset this much, for this asset this much. No. But you can allocate value for valuation purposes. But the buyer has to pay my consideration for my entire division which I'm selling. Clear? Next. Nature of undertaking. Now, slum sale, no, you are selling undertaking, right? 36 months is the holding period criteria. Sir, I started this big division, commercial vehicles manufacturing division is there, right? I started manufacturing 3 years ago, sir. From the date when I started this division until now, today I'm selling it, it's more than 36 months. Then the division is a long-term capital asset. If it is up to 36 months, then the division is a short-term capital asset. Sir, but we said in 2 subsection 42A, short-term means 12 or 24 only, no? Here 36, is this 36 months before amendment, after amendment? In slum sale, no amendment. For slump sale, the period of holding is separately given here. That is not given as a part of your normal 242 capital asset holding period calculation. Understood? I told you, slump sale, the section itself has its own charging section. The section itself, the slump sale itself defines, when this will attract, how to compute, what is cost of acquisition, what is cost of improvement, what is sale consideration, everything is given inside the section itself. Normally, what is full value of consideration? 50C, 50D, 50CA. So many were there. What is cost of acquisition? 49, 55. Period of holding 2 subsection 42A. So many circumstances and all were there, correct? But for slum sale, within a single section, everything is given. That's why I call it as independent charging mechanism. Independent, one provision where it has, it's a separate chapter, I can say, within capital gains. Are you clear? Which has no relationship with others. Able to understand. Next. If the undertaking is held for more than 36 months, it's a long term. Otherwise, it's a short term. The gain is a short term capital gain. Otherwise, it's a long term capital gain. Here, indexation and all, no. I told you that concept and all is for different scenarios. Slum sale is altogether different. Indexation concept, nothing. You know what? How to compute capital gains in a slum sale? First, how to compute? First, what is deemed full value of consideration? What is deemed full value of consideration? What is the consideration here? Very simple. Market value of the assets received. Market value, fair market value. Which fair market value? Sir, I received consideration, sir. Consideration I received is 100 crores, sir. But you know, I transferred assets, you know. Assets I transferred, right? Assets and liabilities I transferred, right? Fair market value of the assets and liabilities put together, net worth. Net worth means book values. Here I am telling you, fair market value of the assets transfer. That is coming 120 crores, sir. Then whichever is higher, that is treated as consideration. Here I have given something called fair market value of the assets on the date of transfer, right? Rule number 11 UAE. That number you will not find in ICA book. This is there in the CA final direct taxes. They have given even how to value this. Very simple. That's very easy. That time in CA final you can understand that. Okay. So fair market value of the assets on the date of transfer. Fair market value of consideration received for the transfer. Whichever is higher, straight away that is treated as full value of consideration. Are you clear? Then reduce transfer expenses. By the way, in slum sale, what is consideration? 2 FMVs, whichever is higher. I sold division, right? I got consideration. What is its market value? Suppose if it is cash, cash. If it is non-monetary, then non-monetary market value plus cash. How much? And I gave division, right? What is its market value? Assets market value, how much? That is whichever is higher. Less transfer expenses, therefore net consideration. Understood? Less cost of acquisition and cost of improvement. Separately you should not reduce, both put together. What is the cost of acquisition improvement? Net worth. What is cost of acquisition? Net worth of the undertaking or division is deemed to be cost of acquisition. No indexation and all. Net worth means what? Assets minus outside liabilities. Yes or no? Here liabilities you take at book value. Assets, no. Two types of assets. Depreciable assets under income tax law. Other assets you take book values. Depreciable assets you take income tax written down values. That's it. Look at how to value. Net worth means what? Depreciable assets, WDV value as per 43.6, nothing but written down values. Written down value as per 43.6 means what? Before 31st March only we calculate depreciation, correct? As on 31st March we will not calculate depreciation. Remember, when I am selling the division to somebody else before 31st March or on 31st March, I am not eligible to claim depreciation. They will claim. Hello? We will calculate depreciation on which date? 31st March. But on 31st March I am not holding the division. Division itself I am selling. So on the division, can I claim depreciation? I can't claim depreciation on the division. Therefore, closing WDV is there, right? Before depreciation, that value. For each and every block, no, for all depreciable assets, WDV of the block. What about self-generated intangibles nil? What about capital asset where deduction is claimed under 35 nil? Any other capital asset, book value. Now, how to calculate net worth? Aggregate value of total assets minus liabilities as per books of accounts. Further, remember, if at all in books of accounts, no, some revaluation is there. Revaluation is done because of that asset value increased. Remove revaluation and then consider book values. Ignore revaluation, and before revaluation, what is its value? Consider. So, revaluation changes in the asset shall be ignored. Now, look at once again. What is slum sale? You know, selling my entire one business as it is. Selling the business as it is fully. Liabilities, assets, everything. Okay, consideration is what? they pay me some amount, right? That one. Or market value of the assets and liabilities I transferred. Market value of assets transfer, technically speaking, whichever is higher, minus transfer expense, net consideration. Is it profit? No, the division has net worth. That's cost of acquisition and improvement. Okay, what is the net worth? Assets minus outside liabilities. Assets means what? Depreciable assets take block values, written down values. Non-depreciable assets take book values. Sir, I have some more assets, sir, which are on which I claimed I claimed deduction under 35 scientific research. I claim a deduction there. Then take nil values. Able to understand? That's it. Okay. Further, whenever there is a slump sale, no, SSE must furnish CA report by specified date. Specified date is nothing but by September 30. Wherever CA report is required, no, under entire income tax law, the due date is 30th September of the assessment year. Wherever CA report is required under income tax law, that is called specified date. CA report, CA certificate, CA related, accountant's report, wherever that comes, that means actually 30th September. Due date for filing IT return means if at all CA certificate is required and the due date there is there, then 31st October. Sir, CA certificate to audit, nothing is required, sir. Then due date is 31st July. Now we will be discussing after a while, like once we complete all these chapters, we discuss return of income. There also I'll tell once again that point. Clear? Yes, that's it, over. Slum sale is over. Now look at the problem. So what is the problem in the slum sale? We kept pending TYK question. What is the illustration, pa? Yeah. Illustration number 10. Illustration number 10. Mr. A is a proprietor of Akash Enterprises having 2 units. He transferred on 1st April 2024 unit 1 by way of slum sale for a total consideration of 25 lakh. You cannot straight away put 25 lakhs, ma. Understood? Because that is market value of the consideration you received. You need to compare with another consideration, market value of the assets transferred. Fair market value of the capital assets of unit 1 is 30. You see, whichever is higher. Therefore, full value of consideration is what? 30 lakh. Correct? Everybody? Minus transfer expenses. Then you get net consideration minus cost of acquisition and cost of improvement, which is nothing but net worth. Then the balance one is called as capital gain. Now whether it is a long term or short term, it depends upon how long we are operating this unit number 1. If at all we are operating this unit number 1 before sale more than 36 months, it's a long term gain. Otherwise it's a short term gain. Yes or no? Long term gain means it is taxable under 112. Short term gain is taxable at normal rates. Understood? Yeah. Next. Okay. Unit 1 was started in 2005-06. Oh, the 2005-06 unit 1 started and we are selling it on 1st April 2024. Date of transfer 1st April 2024 before 23rd July. If it is before 23rd July, tax rate is 20%. Very important. Here the date of transfer is on 1st April 2024, which is before 23rd July 2024. 112 section tax rate is common for every area. Yes or no? Since it is transferred before 23rd July, long-term capital gain is taxable at what rate? Exactly 20. Of course, I think they didn't ask that, but still, I'm just telling you. If at all this slump sale happened on or after 23rd July, the tax rate is 12.5. But tell me, whether I compute capital gain before 23rd July, after 23rd July, the answer is going to be same only. So which is beneficial for the SS? If at all he want to sell a division, sell them after 23rd July. But anyhow, since already time is over, no, there is no tax planning and all required. For slump sale, it is very beneficial. The amendment is very beneficial. Yes or no? Because tax rate is almost became half. Clear all of you? Yeah. Next. The expenses incurred in connection with the transfer is how much, ma? 28,000. How much it is? 28,000. Therefore, net consideration is 29,72,000. Okay. Next, his balance sheet as on 31st March. Because he is selling on 1st April, we should take balance sheet as on preceding date. Preceding date values only we should take, ma. Okay. 1st April preceding date is 31st March. Suppose if at all he is selling on 10th August. 9th August balance sheet we want to know. Because we want to know liabilities exactly on the date of slump sale. Correct? Yeah. Next. Now you see, unit number 1, unit number 2, separate breakup is given. Tell me, what are we selling actually? Unit number 1. Now we need to compute unit number 1 related all that. What are all given? Land, machinery, debtors, current assets. Okay. Unit number 2, outside loans only. Own capital, they are not outside liabilities. Bank loan, 70% is unit 1. Trade creditors, 25% is unit 1. Fine. Okay. I got to know what are the assets and liabilities are there. We'll compute purchase. We'll compute net asset value, net worth. Other information. Revaluation reserve is created by upward value of land. Oh, here you see revaluation reserve for unit 1 only, entire 3. Oh, this land value 12 lakhs is after revaluation reserve. Before revaluation, hello? 9 lakh. When we are calculating net worth, for all non-depreciable assets, I should take book value before revaluation. So land value, how much I will take? 9 lakh. Okay. Then machinery is a depreciable asset. This I will take income tax section 32, 43 subsection 6 written down value. Correct? Debtors I will take book value again. Other assets also I will take book value only. Why will I take all that? Other assets means non-depreciable assets probably. Yes or no? No. No individual value of asset is considered in the transfer deed. Remember, when you are selling, no, in the sale deed, no, individual assets and all, values and all is not given. Lump sum division is like this. But annexure is there. Inside workings are there. Each asset wise value, all that valuation workings are there. That is not treated as just because individual asset wise breakup is there. That doesn't mean we are selling asset and liability each and everything. Yes or no? Yeah. Next. You see one point they gave. Other assets of unit 1 include patents acquired on 1st July 2022 for 50,000. Oh, there is a patent. Yeah, that's an intangible. It's a depreciable asset on which no depreciation has been charged. Now we need to charge depreciation and take written down value. The value of machinery represents a written down value. Oh, here 3 lakhs written down machinery is there, right? That is already a income tax value only. That's it. Information is fully clear. Now let's calculate net worth. Yes or no? Calculation of net worth. Now first assets, land before revaluation 9 lakh. Machinery, that is actually income tax value only, no? 3 lakh. Debtors how much ma? 1 lakh, right? Other assets how much? Actually other assets, no, 1 lakh 50 is there. Inside that 50 is depreciable, so I will eliminate that. Only 1 lakh I will take as it is. Correct? Now intangible is there, right? Patent, nothing but what? Patent. I will give note number 1. Okay. Now patent, no, I need to compute written down value because no, the till date. Patent, no, originally purchased in which year? 22-23 year. What is the value? 50,000. In 22-23 year, on which date it was purchased? 1st July 2022 means that year full rate depreciation, half rate, full rate. Hello. So what is the intangible assets depreciation rate? 12%, 12,500. This is for 22-23. Yeah, as on 31st March 2023, asset is with the company, they claim. Now what is the written down value? 37,500 minus as on 31st March 2024. 24 also over. I am selling on 1st April. So for 31st March 2024 also I can calculate depreciation. Correct? How much it is? Hello, 37,500 into 25%. 9375. What is the written down value on 1st April? 28,000. That's it. Everybody, yes, 28,125. 28,125. Sorry, it's asset, no? Yeah, 28,125. Total assets how much ma? 12, 13, 14. 14 lakh 28,125. This is not net worth. I need to reduce liabilities. Hello, everyone, yes or no? Liabilities. Trade creditors 1 lakh 50. But I should reduce only unit 1 related. 25%, 37,500. Yes or no? Trade creditors, how much it is? 37,500. Now the company has a bank loan 2 lakhs. Out of that 70% is unit 1 only. 1 lakh 40,000. Before I do answer, let me check, is there any other information I left? So this I consider, this I consider, this I consider, this I consider, this also considered. That's it. Everything is considered. Revaluation is everything. That's it. Finally, what is my net worth? 15, 50. That's it. This is my net worth. This itself is treated as cost of acquisition and cost of improvement. 12 lakh 6,000. Sorry, 12 lakh 50,000 625. So what is the balance capital gain? 17 lakh 21,000. Now The undertaking is opened in 2006-7 or 5-6 year. Till now it is more than 36 months. Therefore, it is a long term. Tax rate is 20% before the date of transfer is before 23rd July. If at all date of transfer is after 23rd July, then the tax rate would have been 12.5%. Depending on the date of transfer, you should see balance sheet. Sometimes if at all the same question has to be given in exam with a very tough, they will give you slum sale date different, balance sheet date different. They will give you adjustments to be done to the balance sheet so that latest values you will get. Be careful. Clear all of you? What is the answer? Easy. That's it. Confident or not? Slum sale over. How easy? Yes or no? This is nothing but from accounting point of view, goodwill only. Whatever the goodwill you are getting only, you are paying tax on it. That's it. Confident? Now here one more small doubt I have. Okay. Here net worth we calculated, right? Here also we considered assets market value, you know. Here also we considered assets net assets value, no. What's the why we same we considered? No. Is it right or wrong? Right only. Here what we consider is book values. Here what we consider is market value. Be careful. Consideration point of view only market value relevant. Net worth, cost of acquisition, cost of improvement point of view, it's not market value. At what price I acquired minus depreciation and all reduced. Yes or no? Now you remember one point. I'll show you. Go to depreciation 43 subs. Yeah, depreciation schedule. You go. Depreciation computation format is there. Remember? There one black letters I kept pending. I will discuss that in slump sale. I told. What is the page number? 79. You see here, I kept pending this. Remember this? In depreciation computation format, I kept this pending. Remember? All of you? Now, you know, this question itself you see once. In this company, no, unit 1, unit 2, just check out. Unit 1, unit 2, 3 plus 1, 4 is there, right? Do you think under income tax, unit wise block of asset will be there or total company wise block will be there? In income tax, block of asset, will I create separate unit wise or company wise? Company wise only we will have a block breakup. Agreed? But whereas here, did the company selling entire block? No. Which means block is continued. Under section 32, the block is continued. They are only selling one asset, machinery. Yes or no? Luckily in the problem, this machinery WDV value they gave. That you need to reduce here. Generally, what you need to reduce here? Sale value you need to reduce, part of a block. But here, what we reduce? WDV value we reduce. In case if any machinery is sold in slump sale, any asset forming part of the block is sold under slump sale, that amount, that block, that asset related value I should reduce, right? But in slump sale, I didn't sell asset wise. I don't know asset sale value, I don't know. Hello? See, first tell me, in income tax, the same company you take, example, unit 1, unit 2, they both are part of block, right? They both are forming part of the block, right? They both are forming part of a single block only from income tax point of view. Okay? Part of a block is transferred. How much received for part of a block? I don't know. Unit 1 machinery, towards machinery, how much I received also I don't know. As a whole, I got 70 lakhs profit, I know. Which asset I got this profit, I don't know. Correct? Now, but part of a block is transferred. Amount received, I don't know. What should I reduce? You see here. Actual cost of the asset identify minus notional depreciation. Minus notional depreciation. Nothing but unit 1 written down value of machinery. That's what 3 lakhs. That 3 lakhs you will reduce. Then you continue with the block. You continue with the block under PGBP where you have unit 2 related missions, all that. Are you clear? Now, in our problem, no, they gave WDV very simply. Sometimes what they tell you know, they will tell you full block value they'll give. Full block value they'll give. Inside that this machinery is so and so. Inside that 2 missions were there. Sometimes they'll not give unit 1, unit 2 asset breakup. They will give you total block value. Are you getting it? Unit 1 related asset is there in the block. That unit 1 asset is transferred to so and so. This unit 1 original cost is 10 lakhs. They'll give you that information. Now that asset related WDV value separately you should find out. Sir, but under income tax we don't have separate values, no? Asset wise. We don't have separate values asset wise, no? You don't have. That's why what you need to do, take actual cost of the asset separately, freshly, minus amount of depreciation that would have been allowable to the SSE for any year, as if the asset is the only asset in the block. If at all that's the only asset is there in the block, no. How much depreciation? Just now we computed for intangible, exactly that. Patent is there, that's the only asset in the block. How do we calculate it? For every 31st March we are eliminating depreciation and then calculate a WD value. Like that, calculate here. That you reduce. That return on value you reduce. In the given problem, they themselves give 3 lakhs value. That's why we reduce the 3 lakh value. So that what you need to reduce in case of slump sale. Understood? All of you. So in a slump sale, if you are selling any asset, in a slump sale you are transferring some machineries which are a forming part of existing block. Now how much amount under the block I should reduce, because that is being removed from the block, right? How much amount? Its WDV value I should reduce. Sir, for that asset WDV value we don't have breakup. In income tax we calculate based on block of asset approach. We don't have breakup for that. Are you getting it? When you don't have breakup, do one thing. Its original cost find out. Minus applicable income tax depreciation rate only for that asset 31st March. Every 31st March calculate. Identify return on value as on 31st March after depreciation, but before slump sale. Yes or no? Identify that value, reduce it. Suppose no, okay, leave it, it's okay. That's very advanced. It's okay, leave it. Fine. Are you clear? This itself, many students, this itself they don't know. Yeah, this point, no, I bet many notes will remove this point. Able to understand? Now you got the clarity. If paper has to be very tough, that's how the test. Confident with this slump sale is completely done. Confident everybody? Yes. Yes. So almost every major provisions of capital gains is over. Even slump sale also we covered. Now let's discuss 50AA. Already at tax rates, when I'm discussing long-term capital assets, short-term capital assets at that time, no, to clarify, there are some assets where gains are always short-term. There I once touched this point. But now let us discuss 50AA exclusively. This, and I will also cover 46A buyback. Okay, we have 46A buyback, this one, and then we have something called liquidation related provision, and then we have exemptions under income tax. If at all this is completed, then capital gains chapter is over. Clear? Now, assets covered. 50AA, capital gains under 50AA. Here, though I gave the heading market linked debentures, here totally 3 assets are there. Units of specified mutual fund, market linked debentures, and recently added, what are they? Unlisted bonds, unlisted debentures transferred on or after 23rd July. Remember, if unlisted debentures, unlisted bonds are transferred on or after 23rd July, whether they are long term or short term, or 24 months criteria. And moreover, even though the asset is a long term asset, long term asset, short term asset, the gain or loss is always short term. However, if the transfer is before 23rd July, they are not covered. They are not covered within the purview of 50AA. And for them, that time the criteria 36 months criteria. If they are long term, the gain is long term capital gain taxable at 20%, and if it's short term, the gain is taxable at normal rates. Whereas now after amendment, what happened? If at all the unlisted debentures bonds are transferred on or after 24 July, 24 months is the criteria. 24 months is the criteria. Long-term capital gain is taxable at 12.5%. Short-term capital gain is taxable at normal rates. 111A will come only for 3 assets. Listed equity shares, equity-oriented mutual funds, units of business trust, where at the time of sale STT paid. Most important. For equity shares, purchase time also STT must be paid. Only then 111A, 112A will attract. Yes or no? Now, capital gains arising from these assets are always short-term capital gain regardless of holding period. Chargeable at normal rates of tax applicable to the ESOP. How to compute capital gain? Consideration minus transfer expense minus acquisition cost. No deduction for STT paid. Easy or not? What is a market linked debenture? It's a security with underlying principal component in the form of debt security. Returns are linked to market returns on other securities and indices. Any security which is classified by SEBI as a market linked debenture, that is also called as a market linked debenture. Specified mutual fund, where not more than 35% is invested in equity, means 65% minimum is invested in debt. So specified mutual fund is nothing but debt oriented mutual funds. Specified mutual fund is nothing but debt-oriented mutual fund. Equity-oriented mutual fund means what? We saw minimum 65% is directly invested in equities of domestic company, listed equity shares of domestic company. Then it is called as equity-oriented mutual fund. Or I am investing in another fund where that fund invested 90% of its total proceeds in listed equity shares of domestic company. Then my investments are also called as equity-oriented mutual funds. Specified mutual fund means where investment by the mutual fund of their amount, no, maximum 35% only in equity, means 65% minimum in debt. Are you clear? They are called as what? Debt oriented mutual funds. Are you clear? But they call it a specified mutual fund because they can also invest in real estate assets like that. Some rules and all were there. For us it is not relevant. Okay, next. That's it. 50 AA is done. Confident? Now let's go to 46 buyback. You see, liquidation point I kept pending. Okay, I will discuss at last. Liquidation, once buyback is over, I will discuss at last. I think buyback is at next. Where is it, my buyback provision? Yeah, here itself it is there. 46A. One major amendment again here also. Major amendment 46A. Worst amendment in the history of income tax. Okay, one of the worst amendment, which is actually very damaging the SSEs, literally. I'll tell you. Buyback. This provision is talking about buyback. Buyback of specified securities. Buyback of specified securities. Look at other than shares of domestic company. A company allotted some specified security ESOP something. They're buying back. Preference share capital, debentures, capital, whatever. Buy back there. Securities they're buying back. Whatever the securities they issued, they're buying back. Yes or no? Other than shares. For buyback of shares, there is a separate provision. For buyback of shares, there is a separate provision. Tell me, first of all, tell me, when a company is buying back, from whose point of view capital gains has to be computed? Company is buying back. It is not getting any money. It is paying money. So capital gain is computed not from company point of view. It is considered from shareholder point of view. Sir, now the company buying back, sir, they paid me 10 lakh money. Earlier, the same shares I bought at 5 lakhs, sir. Therefore, the balance is capital gain in the hands of the shareholder. Correct? That's it, 46. Are you getting it? Now the company is paying me at the time of buyback 10. Before, no, I purchased them. See, I am getting today 10 lakhs because I purchased at 5 lakh. Yes or no? Now, if buyback is on 23rd July and before, so before 23rd July, depending upon the security type, period of holding logic will apply. 36 or 24 or 12 or something will apply. Logic. Yes or no? Accordingly you compute whether it's a long term or short term. Accordingly, indexation facility, all that, everything will be common only. Are you getting it? Even on buyback also, indexation is common. If it's a long term asset, you will get indexation. If it's a long term asset, you get indexation. Buyback is treated as transfer in the hands of the shareholder. That's what 46A says. Clear? This is normal provision. Look at this. Applicability. This section applies to specified securities other than shares of domestic company, because other than shares of domestic company separately discussed. Bought back by issuing company. In whose hands it is taxable? For shareholder hands it is taxable. Yes or no? In the hands of the shareholder. Consideration received on buyback. Cost of acquisition, what? Amount paid at the time of purchase of security. Taxability when? Year of buyback. Mode of computation, same 48. Non-depreciable asset format only applicable. Yes or no? Specified security. Companies Act section 68. It has given some meaning. That same meaning you take it. Easy. Now let's look at provisions related to buyback before 1st October 2024. There is another date, 5th date. I think I missed this. Totally 6 dates were there. Okay. What are the dates? What are the dates that we have seen till now? Year order will come. 1st April 2001. 1st April 2018. Yeah. I'm just testing you. Okay. Yeah. 1st April 2014. Okay. 1st February you can 2018 you can take, or 31st January you can take. Okay. 1st February 2018. Then we have 23rd July. No. 31st March 2024. 31st March 2024. Then we have, then we have 23rd July 2024. Just a minute. Then we have right now just is 1st October 24. Correct? 6 dates we have in capital gains. In CA Inter. In final there are 2-3 more over there. Okay, fine. 1st April 2001. This is regarding when the asset is acquired by the SSE or previous owner on or before 1/4/2001. Then cost of acquisition will be cost or market value, whichever is higher. Yes or no? In case of immovable property, restricted to stamp duty value. This is regarding cost of acquisition. 1st April 2004 is regarding for feature, section 51. 1st February 2018 is regarding listed equity shares, equity oriented mutual funds. Yes or no? Units of business trust acquired before 1st February 2018, whereas sale is later on. Then cost of acquisition is what? 31st March 2024. Gifting of ESOP is taxable up to 31st March. Gifting of ESOP securities. Suppose I got ESOP and I am gifting it to somebody, then it is taxable up to 31st March. 23rd July. Amendment regarding long-term capital asset, short-term capital asset, 112 tax rates, 111A tax rates. Yes or no? Everything, indexation, everything got amended. 1st October 2024. Buyback of securities. These are the 6 dates that we saw. Understood? All of you, 6 dates that we saw in capital gains. Confident? Hello? Yeah. Next. Now look at. So buyback on or after 1st October 2024. Buyback before 1st October. You know, if a domestic company buying back equity shares, buying back shares, listed shares, getting it listed or unlisted, doesn't matter. If a domestic company buying back its shares only, equity preference all are covered, shares. Then earlier, no, if a company buy back shares before 1st October 2024, no, and amount is paid to shareholders, no, shareholders' hands it is completely exempt. Nothing is taxable in the hands of shareholder. There is a section called 10 subsection 34A that says amount received on buyback by a shareholder is exempted with respect to domestic company shares buyback. Specified security buyback above we saw, that is always taxable. Even now it is taxable. Domestic company shares are they bought back. What is the tax consequence? Tax consequence is in the hands of shareholder exempted. 10 subsection 34A. The amount received is exempted if at all buyback is before 1st October 2024. Why it is exempted? Because the company is paying buyback. The company is paying, the company on the amount paid, company itself will pay tax to the government. At one place we are collecting tax happily. The company has to pay additional income tax of 20% of buyback amount. Whatever the buyback amount is there, flat 20% income tax applicable. Buyback amount. Gross amount is taxed by income tax, which is very good provision for the income tax department also. 20% plus surcharge at 12% and cess at 4%. Surcharge is applicable irrelevant of total income. Buyback tax is calculated with the surcharge with the cess. Buyback tax under 115 QA in hands of domestic company. This is the provision, original provision. But what the government did from 1st October 2024 onwards, what government did? Buyback, no, they removed this 115 QA section. Accordingly, if a company is buying back shares and then releasing the money, company has no tax consequence. Shareholder has tax consequence, but not like specified security. Different way here. For example, look at what they are saying. Look at the amounts. Suppose, no, I have purchased 5 crore worth of Infosys shares long back. Okay, 2010-11 time and all, 5 crores worth of Infosys shares I bought. 2010-11. Now Infosys, what they're doing, they are buying back 50% of capital, for example. 50%. Of course, I know buyback cannot be more than 25%. I know that condition. Okay. For the sake of convenience, I'm telling you. Okay, your logic will go by law. 25%. Okay, as per company law, up to 25% can be bought back. Yeah. Suppose company decided to buy back 25% of the capital. The shareholder is there, right? Which means 75% will be with the shareholder right now. 3.75 crore cost of acquisition worth of the shares will be with the shareholder only. 1.25 crore worth of cost is there, right? That is what company is buying back. And you know how much company is paying to the shareholder? 5 crore they're paying now. Only on 25%. Market value increased. 1.25 crore worth of shares, no company buying back, and they're paying me happily 5 crore. How to compute capital gains? Generally, logically, 5 crore I received, sir, minus 1.25 crore. If it is listed equity shares, 112A section will apply. Yes or no? Then 1.25 without indexation, then I'll compute capital gains. Sir, if it is unlisted, then 1.25 long term, indexation facility, all that will be there if the transfer is before 23rd July. If the transfer is on or after 23rd July, indexation will not apply. Common. Yes or no? So 5 crore I'm getting, 1.25 crore worth of cost I'm giving back. Let us assume indexation and all not there. How much is capital gains I got? 3.75 crore, depending upon date of transfer, either 12.5%, 20%, or if it is a short term capital gain, normal rates. Suppose if it is listed equity share bought back, 111A rate will apply. Hello? This is normal. This is how the provision should have been. But what they said, under capital gain, full value of consideration is 0. Look at the beauty of the provision. Full value of consideration is 0 you should take. You transferred shares are yes. Relinquishment. Company bought back. Relinquished. My shares are relinquished. My right is relinquished. Okay? How much what price you bought? Sir, I bought them as 1.25 crore. How much company paid? 5 crore. This entire 5 crore, tax it under income from other sources. Tax it under income from other sources, considering as deemed dividend to subsection 22 clause F. New clause has been inserted. Straight away tax it under other sources as dividend. How much? Entire 5 crore. Shareholder immediately questioned, sir, I purchased them with 1.25 crore. What about my cost? Wait, I'll tell you. To first 5 crore tax it other sources, because buyback is on or after 1st October 2024. Tax it first. Tax it, sir. What should I do now? What about my 1.25 crore? In capital gains, consideration treated as 0. Reduce cost of acquisition. What you will get? 1.25 crore capital loss. Depending upon holding period, it might be long term or short term. Capital loss, carry forward or set off with other capital gains if at all you have. Set off with other capital gains if you have. Set off with other capital. You don't have a carry forward for next 8 years. 74 section. Carry forward for next 8 years. In the next 8 years you get capital gain, set off with that. How unfair. Array, I got 5 crore money because I invested 1.25 crore in the company. Yes or no? My cost you are not giving me set off. You know what? Sir, yeah, other sources 5 crore, sir. I can set off these two. No, loss and other. No. There is a section called 70 which says that 71 loss under the head capital gains you can't set off with other heads of income when you are calculating total income. If I cannot set off these two, my total income will be 5 crore only. Are you getting it? See how unfair to the SSC? Yes or no? So what they are saying, when you are getting any money on buyback on or after 1st October by domestic company shares, entire amount received is taxable under IFOS as a deemed dividend. Remaining amount, entire amount, and your cost is there, right? In capital gains, you compute capital gains. Full value of consideration treated as nil. Minus cost of acquisition. Minus cost of acquisition 1.25 crore loss. Please carry forward. Are you clear? In other sources, there is a problem on this. Okay. First, we will see that other sources. Come to the other sources, second page. What is the page number? Huh? 131. Yeah, illustration is there, you see here. Yeah, in the next page, second page only. You see example of provision. Example on provisions of 46A and 2 subsection 22F. Understood? Found out? Yes or no? Yeah, look at this. Number of shares A Limited bought in 2020 by B. Okay? A Limited shares B has purchased. When in 2020 year, at what rate? 40 rupees per share. How many shares? 100. Total cost of acquisition is obviously 4,000. Number of shares bought back in November 2024. Since on or after 1st October 2024, company bought back at what price? 60 rupees per share. How many shares they bought back? 20. 20 shares were bought back. 20 into 60, how much amount I received? 1200. That is treated as dividend. That is treated as dividend. Correct? That's what we understood. Sir, if possible, no, 20 shares I bought each one at 40 rupees, sir. I today got 60 rupees. 20 rupees only I got profit. Technically 400 only to tax. But why are you taxing me 1200? Wait. What department is saying? Long-term capital loss on buyback. What is it? Value of consideration. Treat it as 0. Cost of acquisition 800. You are asking about 800 rupees only, na? Take it as loss. What should I do with this loss? I can't set off with this and then pay lesser tax. No, I can't set off. No. What you need to do? Carry forward. This loss has to be set off and carry forward. Carry forward it. Okay, sir. Carry forward it. What will I do? Next year, what I will get? Next year, you sold the same shares at 70 rupees. 50 shares you sold. That year, how much is the next year you sold 50 shares, right? 50 shares you sold. Originally you purchased 70 rupees you sold. 50 rupees is the 40 rupees is the cost. 30 rupees is the capital gain into 50 is equal to how much capital gain you got? 1500 you got left. Now set off. This brought forward loss set off. Next year you are paying tax only on 700 rupees. No. Indirectly you are getting benefit, na? Department argument is good only. What if I don't have capital gains in next 8 years? What if I do not have a capital gains in the next 8 years? I am not selling anything. I want to keep it for my children's education, wedding, for all that purposes. I don't want to sell this. This loss will lapse after 8 years. This is the blunder. Correct? This is a blunder basically. Especially for stock market active investors and all, it's okay. Passive investors is blunder. You understood now? And moreover, if at all you are taxing it under capital gains, no, the tax rate is 12.5 if it's a long term. Short term, that to listed equity share 20% after amendment. Okay, but here in other sources, if you are taxing, means at slab rates it will be taxed. If you are taxing it as a dividend, it is taxed at slab rates. If SS is in 30% slab, higher tax rate. Higher tax rate. Clear all of you? That's it. This is one major mistake which they did. I don't know who proposed this amendment. I don't know. What is the logic behind this also? I don't know. Any intention beyond common sense. Common sense you apply. Is this right? No. This is called tax terrorism. Understood? That's it. Buyback is over. 46A is over. Easy or not? Again, let's go back to buyback. Now look at this buyback. Where is it? Which one? Page number? Okay. Yeah, you see here. Buyback on or after 1st October. What is the provision? Domestic company buyback its shares. Listed or unlisted, doesn't matter. On or after 1st October. Taxability. The amount received by shareholder is treated as dividend income. See, indirectly, this is to discourage buybacks. Technically, buybacks are discouraged. Now, companies will not go for buyback because they know it's adversely affects the shareholders. Shareholders will not give resolution to it. Why? If you buy back, for me only loss, not for you. Do one thing. You have excess money, give me dividend. Give me dividend. Buyback is one way of repaying capital, yes or no? Nothing but give me dividend, yaar. You have accumulated profits, give me dividend. Happy. I will pay tax. If I don't want to sell, if I don't want shares, I will sell to somebody, and I will have a long-term capital loss happily. Are you clear? Yeah. Okay. Now, taxability. For the purpose of section 46A, full value of consideration is treated as nil. Hence, capital loss is equal to FVC minus cost of acquisition, which may be long term or capital. Such capital loss will be set off and carry forwarded as per 70, 71, 74. Discuss it later. Long term capital loss can be set off only with long term capital gain. Short term capital loss can be set off only with short term capital gain. And balance will be carry forwarded. That's it. 46A is over. Easy? Everyone? That's it. Now let us look at liquidation 46. Now let us look at liquidation 46. What is this 46 is about? The company is going into liquidation. The company is, suppose the company on liquidation, what happens generally? The company will distribute their money, distribute the asset to shareholder. Suppose if a company is distributing assets directly in the hands of the company, 46 subsection 1 says it is not a transfer. The section specifically says it is not transfer. Distribution of assets by a company on liquidation is not a transfer. Generally, assets are distributed in private sector companies. Private limited companies only assets distribution will happen. Normal company, we are running restaurant all these days. Some 2-3 premises were there. We don't want to continue. What I will do? Okay, I will tell to one my another shareholder. Okay, I will take this house. I will take. You take that particular building. You take that building. Over, liquidated. Over. Like this will happen in private limited companies. Whereas in a listed company, if at all they go going for liquidation, large amount of shareholders will be there. Distribution will not happen there. Generally, distribution is not practical there. There, what will happen? The company will sell the asset, and then they get the cash. They do settle all the parties. Then they finally release money to the shareholders. That time, in the hands of shareholders, the tax provision will apply as usual. Are you getting it? But if a company is distributing asset directly to the shareholder, nothing is taxable. But if the company is selling the asset and then distributing the cash, the company is selling the asset, right? That might be attracting capital gains. Then after capital gains tax, again company is distributing that money to shareholder. Again in their hands, taxability will apply. Are you clear? Yeah. Look at distribution is not a transfer, no capital gains tax. Now what about shareholder? Sir, I am getting money, sir. From the company, I am getting money. Okay, you are getting money now on liquidation. How much money you are getting? Sir, money, company paying me some money, sir, and they are also paying me assets, sir. They are giving me some asset also. Then market value. Money received plus market value minus deemed dividend. This is treated as full value of consideration. Is treated as what? Full value of consideration. Yes or no? What is deemed dividend, sir? On liquidation, company paying me so much money. Actually, company already has accumulated profits now. To the extent of accumulated profits, we are treating it as dividend. To the extent of accumulated profits, it is treated as dividend. Very simple. Accumulated profits means what technically? Undistributed profits. Undistributed profits means nothing but revenue profits. Revenue profit given to shareholder back. Revenue profit is given back to shareholder. It should be taxed as revenue income only. That's why other sources. Anything beyond revenue profit shareholder company is distributing, that's called repayment of capital. Repayment of capital is liable for tax under capital gains in the hands of the shareholder. Very simple. Company has some 10,000 share capital, okay, 50,000 reserves and surplus, assets values all put together 2 lakh. Now company giving back this asset entire 2 lakhs. Net worth is 2 lakh. There is no liability. Settle, everything is over. After settlement, 2 lakhs worth of asset is there. 2 lakhs worth of asset is given to shareholder. Entire 2 lakh is not consideration in capital gains. Entire 2 lakhs is not consideration in capital gain. Sir, this 2 lakhs includes 50,000 worth of reserves and surplus. Accumulated profit. So up to 50,000 is taxable under IFOS 2 subsection 22 clause number C as a dividend in the hands of the shareholder. Balance 1.5 lakh is assessable under capital gains. I'm not saying taxable under capital gains. Assessable under capital gains. Now under capital gains, full value of consideration is 1.5 lakh minus cost of acquisition. What cost? Share value. Exactly. Shareholder is cancelling his shares na. Long back he purchased na. Sir, I purchased it for 50,000 shares, sir. So 1 lakh is capital gain. Is it long term or short term? From which date you will count? From the date of acquiring the shares by me till the date of liquidation only, not till the date of distribution. In a liquidation, date of liquidation is different, date of distribution may be later date. Period of holding will be considered up to date of liquidation only, not up to date of distribution. Agreed? This is the consequence. Are you clear? Fine, sir. Company paid me land, sir. Actually, I got 2 lakhs worth of land, sir. I got 2 lakhs worth of land. The company has an accumulated profit of 50,000. Therefore, how I tax it? 50,000 I tax it under deemed dividend under IFOS. 1.5 lakh is taxed under capital gains. 1.5 lakh is taxed under capital gains. Okay, how it is taxed? Full value of consideration in 20. Let us assume this happened in 23-24 year. This happened in 23-24 year. How much is taxable? 1.5 lakh. Sir, I purchased shares at 1 lakh, sir, in this company. 50,000 is long term capital gain. Fine, sir, I paid tax, sir. Now I got this land, right? 2 lakhs worth of land I got, right? What I did, in next year 24-25 I sold this land to outsiders. Full value of consideration, 5 lakhs I got. I got a nice increment, I sold it to outsiders, 5 lakhs I sold. What is cost of acquisition? Cost of acquisition is market value of the asset on the date of receiving it in my hands. How much value considered for buyback purpose? Sorry, how much value considered for 46 valuation? That is only treated as cost. 2 lakhs is treated as cost. 3 lakh is taxable on the land subsequently. That is what I kept pending at one place, cost of acquisition. That point here once again I gave. So here you see, fine. Here you see, money received minus deemed dividend. In our example, 200 minus 50,000. So automatically the answer is 150. Capital gain is 150 minus cost of acquisition 100 is equal to 50,000 capital gain. Yes or no? Next. Other sources, how much is taxable? 50k. Clear? Now, sir, the land is there not 2 lakhs worth of land. Totally I got 2 lakhs I got, right? You see, on subsequent transfer of such 2 lakhs worth of asset received under distribution, the cost of acquisition shall be market value of the asset on the date of transfer. This is also something similar to perquisites. If I got ESOP, perquisite valuation, market value, what is considered? Subsequently, when I'm selling the share, the same market value is considered. When I got a taxable gift, subsequently when I'm selling this gift, cost of acquisition is value considered for valuation of gift. Here also the similar logic. Are you getting it? That's it. And suppose if the company sells the asset, distributes the amount, then exemption under 46(1) does not apply to the company. However, for shareholder, cost of acquisition will be cost of purchasing the share, in lieu of which they receive money on liquidation, long term or short term. It depends upon period of holding of shares held by them. Clear? Now look at cost of acquisition. One point I kept pending. No, just I will reconnect to it. I will connect to that point. You see here, some red box will be there. Yeah, look at same point I already gave there. I already gave this point in 46 itself. Below note point is there na? That only. What is the SSE was taxed under 46 at the time of distribution. Cost of acquisition shall be market value of the asset on the date of distribution. 2 lakhs. Land cost is subsequently when I sell the land at 5 lakhs, 5 minus 2 is equal to capital gain. Over. Easy. Now again, land you got at 2 lakhs. Now subsequently you are selling, right? Holding period of the land will be considered from the date of you got the asset. You got in 23-24 land, right? When you are selling 24-25, period of holding is less than 24 months. That's what it's a short term. That's it. Problems are not there on many provisions, but I told you on every provision numbers. On every provision I gave illustration, holding concept, everything I touched. Because in exam, problem can be tested on anything. So we didn't just discuss mere provision for namesake. We discussed on every point, amount, problem we discussed. Literally, what is given in IC material is nothing before what we discuss in class. Yes or no? That's it. Even on liquidation and all, I don't think anybody give numbers and give illustrations also. I am giving you illustrations everywhere. Getting it? So that in examination tomorrow, when you see a new questions of all together, you can easily, you can easily sync. That's it. 46 is also over. 46A is over. And 50B is over. All the provisions of capital gains are over except 54 series. Exemptions. Exemptions is another hardly 45 minutes to 1 hour. Capital gains will be over. Then income from other sources we will discuss. Okay, that's it. So exemption under 10 subsection 37 and exemptions in respect of 54 series. Now let's understand 54 series. Exemptions. From gross capital gain you will have to take exemption. Okay, you are having a facility of exemption. So see, if you are getting capital gains, no, there is no need to pay tax compulsorily. If you are satisfying these exemption criterias, if at all you invest in so and so new asset, simple. I sold a house, I got a capital gain, I buy another house, you don't have to pay tax. So indirectly department wants, you got money, invest, again help economy to grow, I will not levy you tax. Yes or no? You don't want to invest anywhere, you want to spend it, I will levy in capital gains tax. Indirectly that's what they're telling. Yes or no? Yeah. Now there is a section called 54. Like in this chapter we are going to learn, in this particular last segment we are going to learn 54, 54B, 54D, 54E, EC, 54EE, 54F. Okay, these are the sections which we are going to discuss. Okay, and 10 subsection 37, that is one more section. Like, now look at this section 54. Suppose no, I am selling a long-term capital asset which is a house property, that may be used for commercial, no, residential house property, sorry, which are house property? Residential house property I am selling. It's a long term. I got a capital gain. Section 54 says within 2 years from the date of sale, within 2 years from the date of sale, buy another house. Okay, or you don't want to buy, you want to construct, then 3 years time limit I'll give you. From the date of transfer, within 2 years or within 3 years, you invest in another house property. Suppose no, some people what they do, you know, before they sell the house, first they buy the house. First they buy the house and then they sell the existing house. That is also considered. Before you sell the existing house, you bought a house within 1 year before. Before you sell, 1 year before. Not 2-3 years back I bought. No, not that. In the recent 1 year, today I want to sell my existing house, but in the recent 1 year I newly bought one house. The house which I already bought now in the last 1 year, that also eligible for exemption under 54. That is also treated as new investment. That is also treated as new investment. The section says what you are selling, long-term capital asset which is a house property, which is a residential house property. Okay. Where are you investing? I already invested 1 year before. Just in the past 1 year only I invested. Or I will invest in next 2 years. Or I will invest in next 3 years. Within 2 years or within 3 years, 2 or 3, as the case may be, I will invest in house property. If so, how much amount you invested, that much is exempted. How much ever you invested, that much long-term capital gain is exempted. Suppose I have a long-term capital gain. Look at this computation, very simple. I sold a house, full value of consideration. How do we compute full value? We know already. SDV, all that logics, okay? 100 lakhs. Okay, let us assume I sold a house for 20 crore minus indexed cost of acquisition. Indexation will come if the house is transferred before 23rd July, like that. That's the reason, okay? And indexed cost of improvement, okay? All that. Let us assume that is 8 crore. You know how much capital gain I got? 12 crore. I got a capital gain of 12 crore. But how much cash I received on sale? 20 crore I have money. Profit is 12 crore. But I received 20 crore money, na? Yes or no? Fine. Profit is 12 crore. You have money right now, right? You can invest in new house also, no? You know what I did? My CA told me immediately, sir, you invest that 12 crore in somewhere else, you will fully get exemption. That's what my CA told me. Okay, I will buy another villa. I bought a villa. Entire 12, you know how much I invested, you know, in the villa? 15 crore worth of villa I bought. Even though you buy 15 crore worth of villa, how much is exempted? 12 crore. But the exemption is restricted to 10 crore. Maximum exemption under 54 is restricted to 10 crore. Very simple. The amount invested beyond 10 crore should not be considered. The section what it says, you know, the section does not say 10 crore is exempt or maximum 10 crore exempt. They didn't say like that. They say amount invested beyond 10 crore will be ignored, will not be considered, which means amount invested up to 10 crore is only considered for capital gain exemption purpose. Are you getting it? There is a clear reason why I am talking like amount invested is exempted. I know I'm not saying 10 crore is exempted maximum. I'm saying amount invested above 10 crore you have to ignore. I will connect this in 54F. There is a section called 54F. There I will connect. Are you clear, all of you? That's it. So maximum how much exemption? 10 crore. Now here there is a condition. Here how much is the capital gain? More than 2 crore. Here how much is the capital gain? More than 2 crore. I will tell you one more situation. Suppose no, I sold full value of consideration 5 crore minus indexed cost of acquisition 4 crore. The capital gain is 1 crore only, where the amount of capital gain is less than 2 crore. You know, I can invest this 1 crore in multiple houses also, but only 2 houses. You can invest in 2 houses, that too in India, by the way, remember. They are also in India, here also in India. If I have a capital gain less than 2 crore, no, you don't have to buy one house only fully for 2 crore. 1 crore, for example, 1 crore is capital gain, right? You don't have to invest entire 1 crore in single house only. You can invest small 1 BHKs and all, 2 houses you can easily buy. Yes or no? Sir, I bought 50 lakh one house and 50 lakh one house, sir. This is for my elder son, this is for my younger son. That's the reason I bought. In 2 houses I bought, sir. Small SSEs, small capital gain. 2 houses if the SSE is buying, no, we will give exemption, no problem. But if the capital gain is very big, I will not give exemption for multiple houses. I will give exemption only for one house. If the capital gain, gross capital gain is exceeding 2 crore, you can only invest in another one house only. Getting it? Amount invested is exempted, but amount invested above 10 crore will not be considered. Section over. All of you. 54, look at. Asset transfer. What is it? Residential house property, that which is a long-term capital asset, that you remove, which is a long-term capital asset and is taxable under IFHP. That house property which you sold is originally taxable where? Income from house property. Who is eligible for this section? Only individual HF. Individual HF only will have residential house property. Others, why they will have? Yes or no? If the amount of capital gain is exceeding 2 crore, one house property. What is it? One house property. Exemption available on investment in only one house property. Understood? Exemption is available only on investment in one house property. Further, suppose if the capital gain is not exceeding 2 crore, means less than or equal to 2 crore. Here it is more than 2 crore. Up to 2 crore only I have capital gain. This is one house I sold. I have capital gain 2 crore. See, sale is only one asset. Sale of house is only one asset. Up to 2 crore only capital gain is there. Then exemption available if at all you are investing in two house properties in India. By the way, within what time you need to invest? In both the cases, you can purchase 1 year in advance. Before you sell the house, you buy and keep a house 1 year before, 1 year in advance, no problem. Or you sold, when you sold 1st July 2024, I sold, sir. Within 2 years, buy another house. 2026, 30th June. From 1st July, 2 years means 30th June 2026. Buy 2 years after the date of transfer. Purchase 1 year before or purchase within 2 years after the date of transfer. And or you can also do one thing. You can also go for construction within 3 years after the date of transfer. When you are going for construction, land cost is also counted for exemption purpose. When you want to go for construction, land amount, you invested first in land, that is also eligible for exemption. But remember, on the land you must construct a building. Just I invested in land, not eligible for exemption. Are you clear? All of you? So purchased within 1 year before, 2 years after the date of transfer, construction within 3 years from the date of transfer, all that is fine. Now you see, if the SSC, if the option to purchase or construct two houses is exercised, the SSC cannot claim the benefit for any other subsequent year. See, generally, I sold one house, sir. I bought another house. Over. This house, after 3 years, I sold again. Again, I buy another house. You can happily, lifetime, you can use this benefit. Sell a house, buy a house. Again, sold that house, buy a house. Again, sell that, buy a house. No problem. Sir, I sold one house. Capital gain is 2 crore. I invested in two houses. I got exemption. Next time, these two houses I sold, or one of them I sold. One of them only I sold. I got 2 crore capital gain. Can I again invest in two houses? No. One house only you invest. One time only will be given two houses exemption. Rest of the lifetime of the SSC, if at all SSC want to claim 54 exemption, investment in one house is only considered. Hello? Understood or not? That's it. Now, exemption amount, how much? How much is the exemption amount? Lower of amount invested in the new house property, long-term capital gain. However, maximum exemption shall not exceed 10 crore. In the law, no, they didn't say maximum exemption. Amount invested in excess of 10 crore shall not be considered. That's what they meant. Amount invested about 10 crore shall not be considered means up to 10 crore only I will consider amount for exemption. That's the meaning. Yes or no? All of you? Everybody? Yeah. Now, lock-in period point, I'll come back to it. CGAS. What is this CGAS? Capital Gain Account Scheme, which I said discuss it later. First, I will tell you here briefly. Okay. Look at this question. Suppose I am selling a house on 1st July 2024. Okay. This is before 23rd July. Indexation facility, all that is available. 24 months is the criteria for period of holding house property, immovable property, correct? Even after amendment also it is 23rd July, 24 months only. Full value of consideration I received is, let us assume 3 crore minus cost of acquisition is, let us assume 2 crore I got a capital gain of 1 crore. I got a capital gain of long-term capital gain of how much? 1 crore. Two houses or one house or whatever. I want to buy a house. What is the time limit given? I didn't buy 1 year advance also. I didn't invest yet. Now only I sold. No, I don't have cash to buy in advance also. I don't have that much cash and all. Okay. So what the law says? Within 2 years purchase. Within 3 years construct. Sir, I have not yet decided. Sir, I have 2 years time. No, I will decide whether to purchase or not. Suppose within 2 years I changed my mind. I will go for construction and complete within 1 year. From end of 2 years to third year. Nothing but from date of transfer. Nothing but 30th June 2026. 30th June 2027. This is for construction. This is for purchase timeline. Correct? I have not yet decided, or I decided to purchase only, or I decided to construct only. Okay, I decided to construct, but I have 3 years time limit. This 1 crore I can use it within 3 years. Correct? Now, but tell me, the transfer happened when 24-25. Assessment year is 25-26. 31st July 2025. I need to file IT return. Correct? All of you. In the IT return, I showed 3 crore, indexed cost 2 crore, 1 crore capital gain. I filed IT return saying, sir, 1 crore I will invest tomorrow, sir. 3 years time limit I have. Okay, you take the return first. Department asked, sir, you didn't invest this, no? Sir, you gave 3 years time limit. You forgot, 3 years time limit is there. I will invest in within 3 years. How do department will believe that you will invest in 3 years? They want some proof, right? What is the guarantee that you will invest? Sir, I'm okay. I will give exemption, no problem. What is the guarantee that you will invest that money? You may spend in between, who knows? If you spend, you unnecessarily, whatever exemption given will be waste, no, from department point of view. So do one thing. As on the due date for filing IT return, if at all the amount is still not yet invested, because time limit is there. From date of transfer 2026, 2027, I have time limit up to that. That 1 crore I can invest in 2026 or 27 year. I have time limit. But at the time of filing IT return, department is asking me proof. What is the proof that you will invest this? I want show me proof, then only I will give exemption. Sir, promise, sir, I will invest. Your promise and all department will not take. I want some proof. Do one thing. Okay, go to some nationalized bank or any private sector bank. Open a bank account. Which account? Sir, savings account or current account? Not both. Capital gain account scheme. There is a scheme called capital gain account scheme. Go to bank, ask them, they will tell you what to do. Open that bank account in your name only. Account number will be there, IFSC code, everything will be there. Inside this amount, 1 crore you want to claim exemption, right? That 1 crore deposit in this. By when you should do this? Before filing IT return. By due date for filing IT return. Either filing IT return or due date, whichever is earlier. Due date is the maximum date. Within due date, invest this 1 crore. Show me the proof. You deposited 1 crore within the due data. Yes, sir. I set aside. This is called setting aside. You see, in Companies Act, any amount you receive for any purpose, that shall be kept in a separate bank account. Dividend declared, first keep it in a separate bank. Share application money received, keep it in a separate bank. You see, everywhere the Companies Act says separate bank. Why? First to show, allocate the fund. Tomorrow we don't know, unless something will happen. First allocate for that purpose. Now you got money, right? Allocate first 1 crore, so that I will have a confidence that tomorrow pakka you will invest. That scheme is called as what? Capital gain account scheme. By what time the amount shall be deposited in capital gain account scheme so that I can claim exemption? By due date under section 139 subsection 1. What is the due date for filing IT return? If at all SSC July due date is applicable, then July due date. Suppose if the SSC has a business, tax holder is applicable, then 31st October. By due date for filing IT return, this 1 crore you submit. If at all you are not depositing within due date, I will cancel your exemption. Even though you are buying house reality, even though you are constructing the house in the reality, within 3 years, 2 years, you really constructed, you really purchased, I will not consider. By the time you are filing IT return, you must show the proof, then you claim exemption. By the time IT return is filed, you didn't claim exemption. Because capital gain account scheme, you didn't deposit, you lose exemption. Are you clear? Therefore, under all capital gains, all other sections, capital gain, you have to use the amount for buying new asset. For the time limits for the 2 years, 3 years, 3 years, plenty of time is there. Use it. I'm not asking you to spend right now. Arey, I'm asking you keep the money in a separate bank account. What's wrong in that? Tell me. I want assurance that you will spend. Keep it in a separate bank account. That's a capital gain account. You just deposit in your bank money is there. No? Transfer to that bank. Tomorrow when you're buying, withdraw from there and then buy. That's it. That entire bank, whenever you're withdrawing in capital gain account scheme, you need to give proofs to the bank. Bank will take care of the entire account maintenance. Only if you give proof that it is purchase or construction, they will release the money. If at all you're withdrawing money from that account for some other purpose, no, to that extent taxability will arise. To that extent taxability will arise. Fine. Capital gain account scheme, unutilized money, like that some point is there, that we will come back to it later. Are you clear now? All of you? That is capital gain account scheme. Understood? Fine, sir. As you said, 1st July 24, I sold a house for 5 crore minus cost of acquisition 4 crore. 1 crore is a long-term capital gain. I decided to construct, sir. 30th June 2027, I have time limit for construction. 30th June 2027 is the time limit for which I have, is the time up to which I have limit. Yes or no? 1 crore is the capital gain. Up to 30th June, I have time for construction. Now, okay. Now, but what SSC, 31st July 2024, before itself, this entire 1 crore deposited in capital gain account scheme. And luckily, balance that 1 crore also he showed exemption, 0 tax. Capital gain 0, tax is also 0. Clear? Now, from capital gain account scheme, what he did, within 30th June 27, that is a time limit for purchasing new asset or construction, yes or no? 80 lakhs only he withdrawn and spent. Ultimately, he spent on construction, land, everything. How much he withdrawn and spent? 80 lakhs. Earlier, how much amount exemption is claimed? Compare this with exemption claimed, not amount deposited in CGAS. There's a logic why I'm telling. How much exemption SSC ultimately earlier claimed? 1 crore. Ultimately spent by the SSC on the house purchase construction, how much? 80. Exemption claimed totally 1 crore. Ultimately spent 80. 20 lakhs is retaxable. How much is retaxable? 20 lakh. You know how many students interpret? In capital gain account scheme, how much balance is there? 1 crore. How much is utilized? 80. How much is unutilized? 20. Unutilized capital gain account scheme, the account balance is fully taxable. That's what you might have heard. If at all you listen to it earlier, what you might have heard is unutilized capital gain account scheme is fully taxable. That's what you might have heard. That's wrong. That interpretation is wrong. Suppose, same example, sir, 5 crore I sold house, sir. 4 crore I got the, cost of acquisition. 1 crore only capital gain. But you know what? In capital gain account scheme, 2 crore I deposited to buy a new house. To buy a new house, how much I deposited? 2 crore I deposited in capital gain account scheme. By 31st July 2025 only I deposited. Within due date only I deposited. Even though you invested 2 crore, you are eligible only for 1 crore. Balance is taxable. Balance is 0. Now, 3 years over. 30th June 2027 is also over. 1st July 2027 started. 3 years started. Next one on 1st July, no? Case number 1. In your capital gain account scheme, still 50 lakhs is there. Still how much is there? 50 lakh is there. Originally how much you deposited? 2 crore you deposited. 50 lakh is there. What is the tax consequence? 0. Nothing is retaxable. Nothing is taxable. Sir, why, sir? Why nothing is taxable? Unutilized amount is there, na? Simple, ga. Simple. How much exemption you claimed? You deposited in capital gain account scheme minimum 1 crore and more than 1 crore? Yes. You withdrawn and spent how much? 1.5 crore. Are you spent more than your gain already. This amount is excess money you deposited. This is excess money you deposited beyond your exemption. That is extra money. Why it is taxable? Are you clear? Suppose, sir, 1 crore my capital gain. I also deposited in capital gain account scheme exactly 1 crore, sir. You know what? By 30th June 2027, which is 3 years from the date of transfer, I spent only 80 lakhs, sir. 20 lakhs is unutilized. Is it taxable or not? No need to break your head. How much exemption claimed? How much I invested? Hey, how much amount ultimately spent? 80 lakhs. How much is unutilized? Unutilized, whatever it is. How much gain I did not spend? 20 lakh. Taxable. When it is taxable? In the year in which 3 years is expired. 3 years is expired in 27-28 year. In that previous year, it is freshly taxable as a long-term capital gain. It is freshly taxable as a long-term capital gain. That's how you should read. Are you clear? Capital gain accounts came unutilized amount, that and all, leave it. Exemption claimed how much? Ultimately spent how much? Difference amount is taxable. Easy or not? Then fine, sir. You know what? 27-28. Exactly 1st July 2027 only, I got completion certificate for the new house. I got completion certificate for the new house on 1st July 2027. And house constructed within 3 years, got completion certificate also. 30th June only got, 1st July I am started occupying. Okay, yeah, new house. This house shall not be sold for 3 years. This house shall not be sold for 3. You should not transfer this. From 1st July 2027, you should not sell it for 3 years. You should not. Why? You claimed exemption on this. Keep it for some time with you. 3 years lock-in period. From the date of purchase or construction, 3 years, the new house shall not be transferred. Okay, so 30th June 2028, 29, 30, up to 30th June 2030, this house I should not do anything. I should not touch it. I can only enjoy it. I cannot transfer it to somebody. Yeah, very good. Sir, I transferred it in 32-33 financial year, sir. That time I sold. If you sold at that time, sale consideration how much? This house at what price you purchased? 1 crore. Sale minus the cost of acquisition of that house, capital gain as usual. What if I sell within lock-in period? I sell within lock-in period. 29-30 financial year I sold it. I sold this house for again 4 crore. Very good appreciation I got. I sold it for 4 crore. I sold it. But what you sold it, you know, within lock-in period you sold it. You sold in 29-30, which is after 23rd July 2024 automatically. Yes or no? I sold it within lock-in period. Sold within lock-in period. Earlier given exemption will be cancelled. Earlier given exemption will be cancelled. Okay, how it is cancelled, you know? Generally how it is cancelled, you know, suppose this house I sold for 4 crore. This new house. At what price I constructed this? 1 crore. 1 crore. Let us assume it is 1 crore. Okay. How much is capital gains on this new house? 3 crore. Earlier exemption how much is given? 1 crore. Total 4 crore is taxable. This is how retaxation should be done. Correct? But how the section is drafted, you know? They didn't retax like this. They are doing forfeiture of advance treatment. They are giving which treatment? Forfeiture of advance. Okay, what the section says, you know, if the new asset is transferred within lock-in period, while computing capital gain on the new asset, you reduce cost of acquisition from the cost. Earlier given exemption reduce. Sir, cost is 1 crore, sir. Earlier I claimed 1 crore exemption. Set off with cost. Balance cost is 0. Indirectly 4 crore is taxable. Correct? All of you? Yes, that's how the section is drafted. So, simple. Look at the story once. I sold a house. Long term, which is residential house I sold. 5 crore I sold. Okay, look at this. For 5 crore I sold. Cost of acquisition 4 crore. Capital gain is 1 crore. Gross. Okay, LTCG. Minus amount invested is how much, you know? Full 1 crore I invested. Balance capital gain taxable is 0. This amount is invested in capital gain account scheme by 31st July 2025. The sale is happened on 1st July 2024. Naturally, I have 3 years time limit, 30th June 2027. Correct? Within this time, whatever amount I deposited 1 crore, right, I shall withdraw and then construct. because construction is 27, purchase 2026 only. Yes or no? Withdraw and use it for construction. Luckily, I spent entire 1 crore. In fact, extra also I spent. Are you clear? 1 crore only I spent. Let's assume exactly 1 crore I spent on construction. Total cost of acquisition of the new house is 1 crore. This new house, lock-in period is what? 3 years. From which date? New house is constructed when? Let's assume here I will change the date. Okay. 1st January 2027 only new house came into picture. 1st January 2027 only new house construction completed. Within 3 years it is completed. Now from 1st January, 3 years you should not sell it. By 31st December 2027, 2029. 2029. By 31st December 2029, you should not sell it. But what happened, you know, I sold it within December, within 3 years from the date of construction. Within 3 years I sold. At what price you sold? Yeah, I sold it for 4 crore. What is it cost of acquisition? Sir, I purchased it, I constructed it at 1 crore. Since you sold within lock-in period. Earlier you have long-term capital gain, retaxation shall be done, right? How it is retaxed? Instead of adding to revenue, they are reducing from cost. This is how you need to do in exam also. You can't add it revenue. Sir, whether above added or below added, answer is same only. No, process should be process only. So 1 crore shall be reduced. Balance cost is 0. 4 crore capital gain. Indirectly, the 1 crore getting taxed or not? Hello? That's it. 54 section fully over. One section if you understand in this chapter, remaining all other sections nothing in this topic, in this segment. Clear? Only 54F is slightly different, but that's okay. That is also easy only. That and all very easy. Okay. Now look at lock-in period of the new asset. Correct? Huh? If the new asset is transferred before 3 years from the date of its acquisition or construction, remember, to buy new asset 2 years time, to construct new asset 3 years time, but lock-in period is 3 years only. Okay, then capital gains on new asset transferred within lock-in period you will compute, right? You will compute capital gains, right? First of all on the new asset transferred, because that is also transfer of capital asset only. Basically you compute capital gains at that time. Full value of consideration in our example 4 crore, less transfer expenses, nothing is there. Net consideration, cost of acquisition 1 crore, less capital gain exempted earlier 1 crore, balance cost is 0, less cost of improvement if at all is there, that one also you reduce. Accordingly you will get a gain or loss picture that you carry forward if at all loss is there. Easy or not? Hello? Yes or no? Now you see, you're exempted earlier, star mark I gave. Indexation will be done on this value if at all indexation is applicable, but now anyhow gone, the time is gone. Are you getting it? Amma, but why I gave this point? Suppose no SSC in problem, sometimes what they'll give, you know, 2 years back data they'll give. 2 years back data they'll give. 2 years before SSC purchased a new house and claimed capital gain exemption. That new house he is selling now before 23rd July. That time, and moreover it's a long term now. More than 2 years. After 2 years he is selling, but within 3 years he is selling. Within lock-in period, but after 2 years. It's a long term. That time, cost of acquisition, identify amount invested earlier. Cost of acquisition minus exemption you claim. Balance is eligible for indexation. Even in forfeiture of advance forfeited amount we reduce, right, from cost of acquisition before indexation, after indexation, before indexation. Here also before indexation. Reduce it from cost of acquisition, they said. They didn't say indexed cost of acquisition. That's it. Clear? But this is, if at all paper has to be very tough, then they will give past year data and they will ask you retaxation in the current year. Normal questions generally how they will come? Current year they will sell a new house, they will buy another house, you know, they will give post later period data they will give generally. If at all they give prior periods data and then asking you the provision of computation of capital gain, that time it is useful to you. Understood? See how much research went into when making this book, imagine. Understood? Every point crystal clearly we mentioned. Even if the paper is toughest, doesn't matter. 90%, 99%, every dimension of adjustment we covered. Correct? Next, finally that will be taxable. Understood? Example I gave. Suppose long-term capital gain is 2.05 crore. Since long-term capital gain is more than 2 crore, you can only invest in one house. and the cost of new house is 3 crore. Exemption is 2.05 only. But the new house shall not be transferred for 3 years. If new house was sold after 18 months for 5 crore, then remember within after 18 months, no, within 2 years, no, which means on the new house, short-term capital gain only will apply. Correct? On the new house. So 5 crore minus actual cost of the house is 3 minus gain exemption claimed earlier 2.05. So balance cost is 5.95. Therefore, 4.05 will be capital gain. Yes or no? Capital gain account scheme point I already told, easy. Now, exemption calculation. How much? Sir, I got a gain of 7 crores, sir. Whereas I invested 12, exemption 7. Correct? Sir, I got a gain 12, I invested 14, but exemption maximum 10. I got a gain 11, cost of new house 9, exemption only 9. Sir, I got a gain 15, investment 13, maximum exemption is 10. Clear, yes or no, everybody? Capital gain account scheme related example. Sir, scenario, I got a long-term capital gain 8 crores, sir. Okay? Construction expenditure 5 crore, yes or no? Within due date, the SSE want to invest 5 crore, that's what indirectly. Deposited in capital gain account scheme within due date. Oh, sorry, within due date is directly spent. Oh, so quick. SSE sold the house, he started construction immediately. How much he constructed? Already 5 crore. He's forget about capital gain. Sir, I already constructed a house before filing IT return. That is considered. Hello? Yes or no? And due date, how much is deposited? Capital gain account scheme 2. Total 5 plus 2, how much? 7 crore invested. Capital gain 8 crore. So how much is exempted? 7. Suppose gain is 14, construction 7 crore I spent, 2 crore I deposited with the before due date. Oh, 7 plus 2, how much it is? 9. Easy. Unutilized amount in capital gain account scheme within due date, within 3 years. No, whatever time limit. If capital gain account scheme unutilized amount is there, what is the tax treatment? Unutilized amount, keep it aside. How much exemption claimed? How much actually spent as per the entire process, correct process? Claimed exemption minus amount spent. Balance is unspent. That is taxable. Clear? 54 is over. Easy or not? All of you? That's it. Next. 54 easy. No. 54B we will go. It's okay. We will go in the order. Okay. 54D alone I will cover at last. 54B. 54B, what this section is saying? What is this saying? Capital gains on transfer of agricultural land. What is he selling? Agricultural land. Now look at. SS is selling agricultural land. 2 years is the criteria for deciding long term or short term. But in this section, no, it can be long term, it can be short term. There is no restriction. Whereas in section 54, the original house you transferred must be long term. Then only if you invest in another house, you will get exemption. Correct? Fine. Agricultural land is there. You know, I transferred agricultural land. I transferred. How I transferred, you know? Compulsory acquisition. Compulsory acquisition. Normally I transferred, sir. Otherwise. I transferred. Otherwise. Normally I sold. Compulsory acquisition of compulsory. By the way, which agricultural land I am talking about? By the way, urban agricultural land. If it is a rural land, it's not a capital asset at all. If at all I sell a rural land, this head of income itself will not apply. Correct? This head of income itself will not apply. Able to understand? So rural land is not a capital asset. Urban land I sold. You know what? It is compulsorily acquired. 10 subsection 37 says. 10 subsection 37. Full capital gain on compulsory acquisition is exempted. I bought this agricultural land for 1 crore, sir. Compulsory acquired. Government paid me 5 crore money. 4 crore profit I have. Even though it's a compulsory acquisition, 4 crore profit I have. Fully exempted. No tax treatment at all. Clear? Sir, I sold the agricultural land normally, sir. I sold it normally. At what price? Full value of consideration? 5 crores, sir. What is the cost of acquisition? 4 crore. What is the capital gain? 1 crore. Which asset you sold? Urban agricultural land. Cost of acquisition 4 crore. Capital gain 1 crore. It might be long term or short term, doesn't matter. I don't want to pay tax on this. What should I do? Buy another agriculture land. Buy another agriculture land. Sale agriculture land. Buy agriculture land. Sale is urban land. Purchase can be urban or rural. No problem. You invest in another agriculture land only, they said. They didn't say you must invest in urban land only. They didn't say that. I went and bought urban or rural or some land. I bought 1 crore. I spent in agriculture land. Ma. What is the time limit? 2 years. 2 3 2 years only, na? Yeah. So buy agriculture land within 2 years. Another agriculture land. That may be urban, that may be rural, doesn't matter. So I spent, sir, urban land only I purchased it, sir. Okay. Balance capital gain 0. Now this new asset is there, right? Lock-in period 3 years. Sir, what if the new agriculture land is sold by me within lock-in period? What is the consequence? New land, you sold, full value of consideration how much? 4 crore I sold, sir, new land. Minus, what is its cost? Sir, I purchased for 1 crore only, sir. I purchased it for 1 crore only. Earlier given exemption how much? 1 crore. This entire section is 54B. Right now what I am discussing is 54B. Earlier how much exemption I gave? 1. Balance cost is 0. 4 crore is taxable. Are you clear? Suppose I invested in rural land, not urban land. Okay. You will get exemption, man. 1 crore exempted. After within 3 years I sold it rural land. Lock-in period, within lock-in period I sold rural land. When you sell rural land within lock-in period, first of all, will you compute capital gains on that? If you are selling rural land within 3 years, will you compute capital gains? No. Retaxation also will not come here. That's application of section can't be done here. Why the section says, if at all, what the section says, if at all new asset is sold within lock-in period, while computing capital gain on the new asset from the cost of acquisition, earlier given exemption, reduce it. Here new asset I sold within lock-in period is rural land, which is not a capital asset, where I will not compute capital gain. Accordingly, the computation mechanism will not apply. If a computation mechanism cannot apply, even though you violated capital gains provision, you can't apply tax. Are you getting it? Operation successful, patient died. Provision is there. Capital gains provision is there. Retaxation provision is there. But because of the point which is given here, the section, the way it drafted, that itself created complication for it. Yes or no? That's it. 54B, easy or not? All of you, yes or no? That's it. I use this word many times, frequently on different occasions. Operation successful, patient died. Okay, next. I tell students generally, if you're buying in my income tax class or whatever, I generally tell them, get all our subjects from us. Why I tell you, because every subject will be fantastic with us. You will have high certainty for qualifying. You took my tax class or audit class, which is very good. You studied well. What if you failed in exam because of some other subject? My credit also I will not get. Understood? The credit which I have to get, because you failed ultimately. In auditing you got 55, for example. There's no point, right? Yes or no? Suppose if a student qualify fully, my credit he will give me. Sir, because of you I qualified like that, something. Yes or no? That's it. So that's the reason we always tell, buy full group here. Don't buy one subject. Full group if you take, every subject will be discussed in a top-notch in-depth discussion. Everything will be discussed in an in-depth way. Just like how income tax, everything we discuss like that. So where the student pass, overall pass percentage probability will be very high. Yeah, fine. Clear all of you? 54B, done. 10 subsection 37, done. In both these sections, there are some common conditions. What are the common conditions? Urban agriculture land. What is the asset transferred? Urban agriculture land. Who is the SSC eligible? Individual, HUF. Okay. HUF or individual or their parents, they must use the land for 2 years at least preceding the date of transfer. Today I sold urban agriculture land. No, in the last 2 years we must use it. Ownership during the usage is irrelevant. Sir, last 2 years I'm using it, sir. But land I bought just 2 days back. and now I'm selling it. Still eligible for exemption. Last 2 years, have you used or not only we will see. Are you owner or not, we will not see. Agriculture land you sold, right? At that time you are owner only. But in the last 2 years, I'm not the owner. Maybe 1.5 year only I'm owner. 1.5 year only I'm tenant. 6 months only I'm owner. But 2 years I'm only using. On that land I'm only having rights. Next, the land may be a short-term capital asset or long-term capital asset. New asset, the SSE must purchase another agriculture land which may be urban or rural within 2 years. Exemption, lower of amount invested or capital gain, no maximum limit. 10 or 15 or 20 crore, entire amount is exempted. Okay, lock-in period, same as discussed under section 54. Lock-in period concept. Further, if the new land is a rural land and it is transferred within lock-in period, no tax treatment as capital gains won't arise on the same. Capital gain, I already told, capital gain account scheme concept also applicable here. Easy. Next, 10 subsection 37 UC. Urban agriculture land exempt if the following conditions are satisfied. Exemption of capital gains on compulsory acquisition of urban agriculture land applicable to individual and HUF. Suppose if a company's urban agriculture land is compulsorily acquired, that is fully taxable. Individual HUF only. Firms also not covered. LLP is not covered. Exemption is available if compensation is received on or after 2004. This section came into picture 2004 only. That's the reason. The land must have been used for agriculture purpose preceding 2 years on preceding the date of transfer, either individual, parents, or HUF. Are you clear? Hello, everybody. Then 54D, I'll come back to it later. 54EC, 54EE, there is another section. Oh, 54EC only, sorry. We don't have E, ma. There is another section called 54EE. Okay, that we don't have in the syllabus. EC only enough. Yeah, EC only. Okay, yeah, just 1 minute. You know, fine, I'll have water. For students also, we keep Bisleri water only. You saw what the can? Normally everybody charge, every other can is 35, 40 rupees only. This is 100 rupees. I tell them specifically keep only this can, Bisleri. Even for students also proper water. You know, that's the level we think. Whoever is coming here, everybody has to be very comfortable and happy. Yeah, just a minute. Yes, next. 54EC. Let's continue. Who is the SSE and what is the asset you sold originally? Any SSE, this section is claimed. Any SSE, this section is applicable. 54B, individual HUF. 54, individual and HUF. HUF also not covered, I think. You see there? 54. 54 HUF is also covered. Covered. Only individual and HUF. Residential house property, ma. Okay. Next. Next, 54EC. Any SSE transferring long-term capital asset, depreciable asset also, any asset should be long-term. House, agricultural land, doesn't matter. Everything is covered in the purview of 54EC. The asset you sold must be long-term. Jewelry, shares, doesn't matter. You know, I sold my academy. Slump sale, for example, that is also permitted. That is also eligible. It's a long term. Is it long term? Check out enough. Clear? Suppose now conditions for exemption. Capital gain from transfer, no, you are getting right, must be invested in specified bonds within 6 months from the date of transfer. Within 6 months from the date of transfer, you must invest in bonds. Within 6 months only. Within 6 months means near to the IT return date only. That's why for this case, capital gain account scheme concept does not apply. Capital gain account scheme concept, why it was brought? You are having 2 years, 3 years time. At the time of filing IT return, you must first invest. For that reason, here time limit itself is very short duration. 6 months only. From date of transfer, 6 months only. Even assuming you transferred on 31st March, 6 months is September only. For that, why opening capital gain account scheme? Better directly buy the bonds. That's what the logic. Within 6 months, buy a bonds. What are the bonds? Bonds issued by National Highway Authority of India, Rural Electrification Corporation. Bonds notified by central government such as Power Financial Corporation, IRFC bonds, Indian Railway Financial Corporation, Power Financial Corporation. PFC, Power Financial Corporation, IRFC, Indian Railway Financial, IRFC, Indian Railway Financial Corporation bonds. Yes or no? How much is exempted? Amount invested or capital gains, whichever is lower. But amount exemption cannot exceed 50 lakh. Exemption cannot exceed 50 lakh entirely. Total exemption cannot exceed 50 lakh. Further, lock-in period is there. 5 years. Here lock-in period is not just for sale. Sale also there. You should not even keep the bonds in bank under pledge. If the bonds are transferred, converted or used for loans as a pledge, the earlier given exemption will be re-taxed. The earlier will be given exemption is re-taxed. How re-taxed? No, separately, straight away. It is not reduced from cost, not that. Under 54 EC and 54 F, re-taxation is done separately. Only in 54, 54B, 54D. In these three sections only, re-taxation is not done separately, but as a reduction from cost of acquisition on computation of capital gain on transfer of new asset within lock-in period. Clear all of you? Next. Now I have given one example. Okay, what is this example? Very simple, sir. I sold a residential house property, sir, which is a long-term capital asset. I have a full value of consideration 5 crores, sir. My cost of acquisition 2 crores only. I got a capital gain of 3. Or else, let us do this example, best example I'll tell you. Okay, sir, I have sold a capital gain and I have sold a house property, sir. 11 crore, 15 crore minus cost of acquisition of that capital gain is 10 crore only of that asset is. What is the long-term capital gain? Sorry. Let us do one thing. Yeah, cost of acquisition is only 3 crore. How much capital gain I got? 12 crore I got. I purchased a villa. One only I purchased. Entire 12 crore I purchased. But I can claim exemption only for 10 crore. You do one thing. This is under 54 you made investment, right? Under 54 easy, buy another 50 lakhs worth of bond. You can claim that exemption also. So net capital gain is 1.5 crore. So you sold only one house, but you invested in 2 different sections. Permitted. Are you clear? Agriculture land I sold, urban agriculture land, which is a long term. I purchased another land and I also purchased bonds. Both you can claim exemption. But remember, exemption amount cannot exceed gain amount always. Yes or no? After claiming exemption, the balance gain can only be 0. You cannot call it as a loss. Understood? That's it. So, exemption of long-term capital gain on sale of house, investment in 1 or 2 residential houses as the case may be, invest in bonds, 54 easy, investment time limit here 6 months, amount invested subject to 10 crore, here 50 lakhs exempted, easy. All of you, hello? Yes, that's it. Now, capital gain account scheme point I will discuss first. Capital gain account scheme is applicable for all exemption sections except 54 easy. What unit invest? Capital gains must be invested in special asset. Okay, I'll do one thing. Capital gain account scheme point, I'll come back to it later. Anyhow, we already covered nah. So first we will go and solve the pending, whatever pending adjustments are there, right? That pending adjustments we will solve. Pending adjustments we will solve. What are the pending adjustments? In every problem we have some pending adjustment. You see here 54 easy. Illustration number 12. Long-term capital gain 75 lakh arising from transfer of building 1st May building transfer before 23rd July will be exempt from tax if the capital gain is invested in bonds which is redeemable after 5 years, not fully. 50 lakhs only exempted. That's it. That too, investment must be within 6 months. Next, is there any other illustration kept pending which is linked with this exemption? 9 nothing is there, 8 nothing is there. I think nothing is there in this, correct? All of you? Yeah. So directly go to TYK. TYK questions. First question, nothing is there. Second question also, no, everything is over. Third question, you see, what she purchased? Land. Later land is converted. No. Transfer of land only. Transfer of land is not a transfer of house property. Suppose I have a house property, I converted house property into stock in trade. That's a transfer of residential house property into stock in trade. That's a transfer. That is eligible. Here land. Land means other than house property. Here what happened? They invested in bonds only, ma. Land transferred. 54 years, any capital asset, it must be long term. Correct? Already we computed capital gain, how much it is? 68,14,159 if you recollect. Yes or no? When the transfer happened, by the way, tell me when the transfer happened. Transfer is generally happened. Transfer happened on 20th March, ma. 20th March 2024 only transfer happened. You know what? Amount must be invested within 6 months from the date of transfer, right? Transfer happened on 20th March 2024, conversion date. But for the purpose of calculating 6 months or 2 years or 3 years time limit, no. Wherever capital gain is taxable on cash basis, not transfer date basis. Conversion of capital asset into stock in trade is taxable when? On the date of sale of such stock in trade. From the date of sale, we will count 6 months time limit. Compulsory acquisition is taxable when? Not in the year of acquisition, but in the year in which compensation is received. From that date, we will calculate the time limit, 6 months, 2 years, 3 years, as the case may be. Generally, from the date of transfer only. Date of transfer means what? Conversion of capital asset to stock in trade. Date of compulsory acquisition. Date of destruction, 45 subsection 1A. From those dates only, technically speaking, should be considered. But these 3 cases, capital gains is taxable in the year in which you receive the consideration. At the time consideration received date. Consideration is received when here? You sold when? February month, March month you sold. Now again you invested when? March 31st 2025 you invested 50 lakhs. Another 50 lakhs you invested in April, but total amount invested 50 lakhs only will be considered within 6 months. You invested, yes or no? Are you clear? All of you? Yes. You see here, CBDT circular. In case of conversion of capital asset into stock in trade, the 6 months will be counted from the date of sale of stock in trade. Yes or no? In this case, since the bonds, I hope you can read this and understand. Yes. Next one. Oh, here it is there. What the SSC is selling? Residential house. 16th August 2024 he sold. Yes or no? What is the capital gain we got in this case? 55 lakh, 1.4 crore, which is not exceeding 2 crore. We solved in the previous sessions only. Yes or no? Less than 2. Now the SSC can invest in 2 houses, no? Yeah, look at this, where he invested. After recovering the sale proceeds from first house, Jay Kumar, he purchased 2 houses, one in Kanpur, 20 lakhs on 24th March, same immediately. Another one on 28th May, both are within due date, he purchased directly. Total how much? 55 lakh. So how much is the capital gain? Sorry, for 1 crore 40. Both put together investment is 55. Therefore balance taxable is 85. Easy. I told no, second part of the answer in all these questions, it is easy, nothing. Yes or no? Next. You see here, what he sold? Vacant land he bought. Later residential house. Oh, house constructed. Ultimately what he sold is residential house. Yubika case. Residential house only she sold. Fine. Original. Ultimately, yes or no? When she sold, sale deed was registered on 14th July. Date of sale is 14th July. Yes or no? Now what she sold is a long term only. 2005 land purchase means obviously house is a long term. Subsequent to the sale, she made the following. She acquired 2 houses. Let us see the capital gain. We already computed in the previous session. Array, capital gain is 2 crore above. 1 house only you can invest. Yes or no? Now she acquired 2 houses at Delhi and Chandigarh. One is 130 lakhs, another one 50 lakhs. So both are within the IT return filing due date. I will take higher value investment. 2 houses, 1 house only she can claim exemption. I will take higher value investment. And one more house she acquired at UK. That is not at all. House must be invested in India. See, subscribe to NHA capital bonds, 50 lakh. Yeah, this can be claimed. No. 30th November 2011. Within 6 months. 40 lakhs on 9th January. 9th January is not within 6 months. Check out. 14th July to 9th January. Yeah, both. That is also within 6 months only, ma. No. That's what. See, first consider 90 lakhs she invested within 6 months. But maximum eligible is 50 lakh. Total eligible deduction is 180. Both put together 180. Balance amount is 67.47 only taxable. Easy or not? I request you to solve once again all these TYK problems. Okay, after the class, you please solve all the TYK problems. Then question number 7. What he did? House only he bought. Oh, house only he sold. Hey, this question fully done. Yes or no? Then question number 8. Over. Superb. Done everything. Are you clear? All the problems are completed. Next. Now, we are left with 2 more sections. One is 54D. 54D. Okay. Eligible SSE who? 54D. Any SSE ma? Transferring industrial land building both under compulsory acquisition. Remember, it's not agricultural land. I am selling industrial land building both under compulsory acquisition. I am selling it under industrial land building under compulsory acquisition. Sir, I sold it in a normal acquisition, sir. Normally, I sold industrial land and building. You have only one option, 54 EC. Long-term land. Suppose I sold long-term land and building of an industry, company, business purpose industry. That's a capital asset for them. Long-term, I got a capital gain. Long-term capital gain I got. Or gain might be short-term also, doesn't matter. Yes, it is long-term. I can invest in bonds and claim exemption in 54 EC also. Suppose it went by compulsory acquisition. Suppose it went by compulsory acquisition. Then 54D section will apply. If compulsory acquisition does not happen, industrial land and building, I normally sold, 54D will not apply. Okay, your industrial land and building is compulsory acquired. What is the consequence? I got a capital gain. Invest the capital gain. The SSE must purchase or construct another industrial land and building within 3 years from the date of transfer. Here, purchase, construct 3 years only time limit. You buy another industrial land and building, you construct another industrial land and building within 3 years. Then amount invested or capital gain, whichever is lower, is exempted. Lock-in period is same. Capital gain account scheme, everything is same here. Clear? Here I didn't mention that capital gain account scheme apply, but that is same. Now, asset must have been used for industrial purpose preceding 2 years. By the way, compulsory acquisition government took no. Before 2 years, it must be used for industrial purpose. The land transferred land and building, no, it can be either short term or long term, doesn't matter. Are you clear? That's it. Under 54 EC, no, depreciable asset also word I used. If I sell depreciable asset, I will get what gain? Short term capital gain. But here you said long term capital asset. No, yes, it is long term only. Yeah. Gain is short term. Hello. I sold unlisted debentures, unlisted bonds, which are long term. On or after 23rd July is sold. But the gain is treated as short term capital gain under 50 AA. Still I can claim 54 EC exemption by investing in bonds. Don't interpret. See, in 54 EC and in 54, in all the sections, they said long term capital asset. They didn't say long term capital gain. The gain can be long term capital gain, or the gain sometimes will be treated as short term capital gain. Anyway, it can be treated as. That's it. Clear, all of you? One section is pending. If this is over, 54H, that's it. The section, entire capital gains will be over. Can I? Exemption on transfer of any capital asset other than house property. Any capital asset we are transferring, but not house property. Except house property, we are transferring any capital asset. Which section is applicable? 54F is applicable. You are selling any asset, but long term. Where what you have to buy, house you need to buy. What you need to buy? House. The moment you are investing in house, under 54 you are investing in new house, new asset is house. 54F also new asset is house. The moment you are investing in house, amount invested beyond 10 crore, ignore. Amount invested beyond 10 crore, ignore. Residential house you are buying now, ignore. Here also the 10 crore limit is there. But here exemption is not calculated in all the earlier ways. Here exemption is different. For example, I sold vacant land. It's other than house property. What I sold is other than house property. Yes or no? What I sold is other than house property. Full value of consideration, how much 50 crore. Full value of consideration is, okay, not even 50. Let me take like that. 20 crore. That land cost of acquisition is, approximately 15 crore. How much capital gain I got? 5 crore. Long term capital gain. Okay, long term capital gain is 5 crore. Let us assume. By the way, the asset is a long term capital asset here. Asset nature only important. Generally, until now, if I have to get 5 crore exemption, how much I have to invest until now based on examples? Based on previous all sections, I have a 5 crore gain. I don't want to pay tax on 5 crore. How much I should invest? 5 crore minimum. But here it is not linked with the 5 crore. Here it is linked with net consideration. Here it is linked with net consideration. Let us assume in this question net consideration is also 20 crore only. Let us assume net consideration is also 20 crore only. Here the exemption is linked with net consideration. See, your gain is 5 crore. Keep it. What is your net consideration? 20 crore. How much you invested in new house? 10 crore I invested. By the way, here new asset you have to buy is house only. Okay. How much you invested? 10. Proportionate to 2.5 crore only exempted. Proportionate, how much is exempted? 2.5. Balance 2.5 crore is taxable. Are you clear? Indirectly, if you want to get exemption of capital gain, entire amount you got right on sale, invest it. You got entire amount, no, when you sell, you got amount, no, fully. What you will do with that amount? Invest in house fully. I will give exemption. Okay, sir. Okay, 20 crore I got gain, sir. Let us assume 20 crore I will invest, sir. 20 by 20. 5 crore exemption, huh? No. Amount invested in house more than 10 crore shall be ignored. So, what is the formula for exemption calculation? Under 54F, exemption is equal to long-term capital gain multiplied by amount invested by net consideration. Long-term capital gain is 5 crore. Amount invested 10 crore in our example. Net consideration 20. Therefore, 2.5. Long-term capital gain 5 crore. Amount invested 15 crore by 20. But 15 will not be considered. Amount invested by on 10 shall be ignored. Hello? Yes or no? Now here, same way, sir, I have time limit. Since here I have to purchase new asset, right? That new asset is what? House property. By what time I should buy? Same like 54. 1 year in advance you can buy and keep. Within 2 years you can buy. 3 years time limit is there. The moment time limit is 2-3 years and all, capital gain account scheme applicable. Capital gain account scheme is applicable. Now in capital gain account scheme, 20 sale consideration, 5 crore capital gain. Correct? How much amount I should deposit in capital gain account scheme? Sir, I want to claim 2.5 crore exemption, sir. That is only possible in this section. In the given scenario, based on these amounts, in the given question, maximum exemption possible is how much? 2.5 crore. How it is? 5 crore capital gain into 10 crore amount invested divided by 20. Even if I invest entire 20 also, no problem. 2.5 crore only exempted. So, indirectly, how much amount you have to invest? 10. The 10 deposit in capital gain account scheme. Yes, sir. I deposited 10 crore. I claimed exemption how much, ma? 2 crore. 2.5 crore I claimed exemption by depositing 10 crore. Are you clear? Now, capital gain account scheme I should withdraw in the news, right? But what happened, at the end of the tenure, 5 crore unutilized in capital gain account scheme. How much is unutilized? How much is unutilized? 5. Tell me how much exemption claimed? 2.5. For that I am supposed to invest how much? Hello? 2.5 lakh exemption I claimed. In order to get that exemption, how much I am supposed to invest? 10. 10 I am supposed to invest. How much actually spent ultimately? I am not talking about unutilized amount, how much. I am not bothered about it. How much ultimately spent properly through CGSR, whatever route, yes or no, how much ultimately spent as per law? 5. Divided by net consideration into long-term capital gain, that is retaxable, correct? Earlier long-term capital gain is 5. 10 minus 5 divided by net consideration. What is 10? Amount I am supposed to invest. Amount that I invested or supposed to invest. How much? How much I actually spent? 5 crore. Divided by net consideration 20, capital gain 5 crore. 2.5 crore is taxable. Just a minute. No. 10 minus 5, 5 by 20 into 5, 2.5 crore, ma. 2.5 crore is re-taxable. That's it. Are you clear? All of you. 2.5 crore only is re-taxable. Hello, 5 by 20 into 5. 1.25, yeah, sorry. 1.25 crore is taxable. Earlier also I claimed 2.5 only exemption. Sorry. Hey, I claimed exemption how much earlier, by the way? Sorry. Yes. Just a minute. 1 second, let me give numbers. Net consideration 20 crore. Original asset cost of acquisition 10 crore. Long-term capital gain? No. Cost of acquisition 15 crore. Long-term capital gain 5 crore. Minus, let me calculate 54F exemption. I invested 20 crore in capital gain account scheme. I deposited 20 crore worth of villa I decided to buy. Now, how much is long-term capital gain? 5 crore multiplied by amount invested how much? 20. But amount invested beyond 10 shall be ignored. 10 divided by net consideration is what? 20 is equal to 2.5 crore. 2.5 crore balance exemption, balance 2.5 crore. I paid tax in that financial year. In that assessment year respective year I paid. Capital gain account scheme, no, I ultimately withdrawn and spent 15 crore. I ultimately withdrawn and spent 15 crore. How much is left in capital gain account scheme? 5 crore is unutilized yet. Nothing is taxable. What is it? Nothing is taxable. Are you clear? Why? Very simple. 10 crore only I have to spend. I spent ultimately 15. Fully I spent. Even though unspent amount is there in capital gain account scheme, that is not taxable. That is waste. Correct? Yeah. Okay. Suppose no. Unspent money, capital gain, no, capital gain unutilized, capital gain account scheme, unspent money 15 crore is there. Capital gain account scheme 15 crore unspent money is there, which means ultimately I spent how much? Earlier I showed 10 by 20 into 5, 2.5 crore I said, but actually I spent only 5 crore, right? By 20, how much I'm eligible for exemption? 2.5. Extra exemption, I'm sorry, 1.25. 1.25, 2.5 crore I claimed exemption. 1.25 I'm eligible actually. 1.25 is re-taxable. 1.25 is re-taxable. That's it. Easy or not? That's it. 54F is also over. But in 54F, conditions are little more rigorous. What? Asset transfer. What asset? Transfer of any long-term capital asset other than residential house property. Example, land jewelry I gave. Don't think only land jewelry. It can be shares. It can be debentures. It can be depreciable assets. Anything. Asset must be long-term. Asset must be long-term. SSA must be either individual or HUF. Conditions for exemption. New house has to be purchased within 1 year before, 2 years after, construction within 3 years. Now you see two more special conditions. Two more special conditions. What are they? You see this. The SSE must not own more than one house on the date of transfer of the original asset. I am selling land jewelry. That time I can have one house. By the way, with me I can have one existing house. Okay. Now I am buying new house, right? Again, that will be second house. Under 54F, where should I invest? New house. That should be my maximum second house, or it should be first house either, or it should be second house. Sir, I'm already having 2 houses, sir. Now I sold one land I have. 54F is not open to me. 54F does not apply. Clear? So on the date of transfer of long-term capital asset, you can have one residential house in your name, no problem. Okay, sir. Condition satisfied. I invested new house, sir. I bought new house, sir. You bought constructed a new house, that should not be sold for 3 years. Yes or no? That should not be sold for 3 years. On the new asset lock-in period is there. In addition to this, you bought one house, right? That second house, right? Second house is a new house. That should not be sold within 3 years. Further, second house you bought, right? From that date, you see. Okay, from the SSE must not purchase another house within 3 years. I mean, yeah, not from the day, from sale date. Land I sold. Original I sold a land. Okay. Within 2 years or within 3 years, I'll buy one house. which could be either my first house or second house, max second house. I claimed exemption. Another house you should not buy. Another house you should not construct. Another house you should not buy or construct. You should not. For example, sir, you know, I'm already having one own house, sir. Plus I'm also having land, sir. The land I sold. Now I bought another house property. Within due date for filing item only I bought. Capital gain account scheme also I didn't use, I bought. You know, land and all you sold, right? When you sold 1st July 2024, I sold, sir. From this date, I already invested in one house, claimed exemption. Within 2 years or 3 years, another house purchase or construction you should not do. Very simple. After claiming exemption, don't buy another house. After claiming exemption, don't construct another house. The moment you claimed exemption for one house and again you are buying another one, earlier you got exemption, right? I will retax. Here retaxation applied 2 times. 1, new house is sold within lock-in period, retaxation apply. 2, I didn't touch new house, I bought another house, retaxation applies. Clear, all of you? You want to buy another house, wait for 3 years totally, or 2 or 3 years you wait, then purchase or construct, no problem at all. Clear, all of you? That's it. So how much is the exemption amount? Exemption is equal to gain amount multiplied by amount invested into by net consideration. Any amount invested is considered only up to 10 crore. That's the reason in 54 also what I told, exemption is not 10 crore. Amount invested shall not exceed 10 crore. Lock-in period, if the new house is transferred within 3 years. Generally in 54 section, no. If I transfer the new asset within lock-in period, no. When you are computing capital gain, cost minus earlier given exemption. Here it is not like that. 54 EC, 54 F. Retaxation on lock-in period failure. The retaxation is separately done. The capital gains exempt earlier under 54 F will be taxable as a long-term capital gain separately. That's why you see, I didn't mention as reduced from, I didn't mention that. Huh? That's okay. Okay, so it is retaxable separately. Okay, clear. Next, retaxation. Retaxation, one more retaxation. Failure to comply. What? Another house I purchased within 2 years or constructed within 3 years of transferring original asset, in our example land. The capital gain exempt earlier will become taxable as long-term capital gain in the year of purchase or construction. This is the only section where if you buy, you will get a capital gain. It's indirectly earlier given exemption is retaxed. Yes or no? Capital gain account scheme already discussed. Yes or no? Now, exemption calculation. Sir, net consideration 15 crore. Long-term capital gain 7.5. Cost of new house 12. But I only consider 10. Okay, 7.5 into 10 by 15 is equal to 5. Sir, exemption net consideration is 20, sir. Gain is 12, sir. But amount house purchase cost is 15. You should only consider 10 by 20 into capital gain 12 is equal to 6. Correct? Next, sir, gain net consideration 16. Gain is 12. 8 by 16 into 12. How much ma? Again 6. Yes or no? I hope you understood. Remaining you please solve. Next, capital gain account scheme. When to deposit in capital gain account scheme? If the investment in the new asset is not made before due date, the capital gain or net consideration must be deposited under capital gain account scheme. Exemption limit 54. Gain exceeding 10 crore are excluded from capital gain. Remaining sections, whatever amount you invested, that much exempted. 54F, net consideration exceeding 10 crore is excluded. Yes or no? Actually here net consideration, no. Investment. Okay, here also it is investment only, ma. We can call it as investment only. Investment exceeding 10 crore will be excluded from capital gain account scheme. Here also investment. In both the cases, amount invested only. I think this point you can strike off. Okay, but anyhow, you understood the context, right? Next, deemed cost of new asset. The amount is utilized, no. The amount already utilized for purchase, within the due date will be deemed to be cost of the new asset. So amount utilized within due date and the amount deposited in capital gain account scheme, both put together we treat as amount invested. This is a proof, right? Proof of deposit must be there. Utilization of deposit, that deposit can be withdrawn only for the specified purpose. Now you see consequences of non-utilization. If the if the deposit is not utilized within 2 years or 3 years, as the case may be, the unutilized amount is treated as capital gain in the amount of specified period. Section 54, if the taxable amount is calculated proportionately, because at the time of exemption proportionate, pre-taxing also proportionate. Note, important, unutilized amounts get taxed only to the extent exemption claimed earlier. Suppose earlier I have 5 crore exemption, I deposited 10 crore. Later 3 crore only unutilized. I spent ultimately 7 years, nothing is taxable. Able to understand? That's it. Treatment in case of death of the depositor. Oh, suddenly depositor died without spending, and unutilized amount is not taxable for legal heirs. It forms part of estate devolving, yes or no, on account of disease. Getting it? That's it. Easy only. Okay. Next, 54H. This section is talking about compulsory acquisitions. Relevant in case of compulsory. If compensation for compulsory acquisition is not received on the date of transfer, the time limit for acquiring new asset will be counted. The time limit for acquiring new asset the timeline for acquiring new asset or depositing is extended. The period for making is counted from the date of receipt of compensation. CBDT circular, there is one more circular. CBDT circular is there. In case of conversion of capital asset to stock in trade, stock in trade sale is there, right? From the date only we should consider time limit. Are you clear? Then reference to valuation officer. What is this reference to valuation officer? If the value claimed by the SSE different from fair market value of the asset, or else I'll do one thing. 55A 112 I'll discuss in a separate video. Just 2 minutes gap we'll take and then we'll start the best. Okay, already 1 or 20 minutes came almost the video, so we'll discuss it separately. Clear? Hi guys, in 54 EC there is a small mistake which I told in the previous session. Just kindly rectify. In the material also you may have to rectify. You remember 54 EC, here I told you any SSE transferring any long-term capital asset, right? You might have in the printed book also any long-term capital asset is there. Please rectify, remove that word any and add the word immovable property. 54 EC is also applicable only when immovable property, so land or building or both. Okay. Further, it can be residential property or it can be non-residential, doesn't matter. In the sense, it can be a depreciable property, it can be a depreciable business asset, or it may be used exclusively for residential purpose. Anything it can be, no problem at all. So once again I'm telling you, earlier you have here the word any long-term capital asset, remove the word any. So any SSE transferring long-term capital asset, which asset? That to immovable property. Immovable property means what? Land or building or both. And it must be, it can be residential or it can be depreciable, both, anything. Just 1 minute. Yeah, that's it. So it can be land or building or both. Only this asset if you sell originally, then whatever the long-term capital gain you got, right, up to 50 lakh rupee, if you invest in these bonds, which we already discussed, specified bonds like NHAI bonds or RECL bonds or even PFC or IRFC bonds, which I already explained in the class. So any immovable property, it can be residential or it can be a business purpose used immovable property, or it can be a commercial property altogether. Anything, it just must be immovable. But if you recollect 54, like if you remember 54, for example, I'll just show you once again for a better idea. 54 is what? Residential house property. Suppose the SSE having a house property, that to the house property is used for residential purpose. Whereas under 54 EC, it is just an immovable property. In the sense, it can be a business property. It can be used for own business or profession. It can be in my books of accounts as a depreciable asset. Are you getting it? Now, for example, now it can be depreciable asset also. That's what. Okay. So it can be any immovable property. Now, one point I want to tell. If it is a depreciable asset, no, the gain or loss is always short term. Am I right? If it is a depreciable asset, the gain or loss is always short term. We have already seen in our PGBP also, when we are discussing depreciation computation itself, we also understood section 50. Suppose if I am selling depreciable asset, the asset may be long term or short term, but the gain or loss is always short term. Here the asset only they are talking, they are not talking about gain. Here the asset must be long term capital asset, but the gain can be short term capital gain also. The gain can be long term capital gain. From the gain whatever you got, if you invest that amount in bonds or in these bonds, you can claim deduction, you can claim exemption up to 50 lakh rupee, and which is already, like I already told, 5 years logic, everything I already told. And even here 50, for example, I told, suppose if you are selling a residential house property, you have two sections which are eligible for exemption. One is 54, which is exclusive for residential house property sale, where you should also purchase residential house. Whereas 54 EC, that is also only when you are selling residential house property. So in the previous session, we thought any capital asset, so that's actually wrong. So it's only immovable property. That's it. Okay, clear? Like this, no, what are all the mistakes that we identified in this whole book? We have already added something called corrigendum. I think in the same course where you're seeing rectifications in the middle, like that, you will find one folder, mistakes or some folder is there in the same app where you're watching. Inside that corrigendum PDF is there, you can download. Or alternatively, you can just come to our Shrestha website. You just come to our Shrestha website, go to free resources. Here you see P3A income tax. Here you see P3A tax corrigendum. Suppose CMA students, here you select CMA into, here you go for P7A direct tax. Here also you'll get a DT corrigendum book. That's it. Okay, that's it. Take care, continue watching. And yeah, so let's continue the balance final part in capital gains. And by the way, in PGBP one section we kept pending 43 CA, immovable property related provision. I told the same thing in capital gain 50C, the same provision, the exact copy paste. If you go and see there, 43 CA, open 43 CA, please open in PGBP. What is the page number? 996. Okay, if you remember, this provision we kept pending. Here valuation officer point and all is not there. Okay, okay, fine. Here also everything is covered in this one. Valuation officer, everything is there as it is provision. Same provision I copy pasted here. Same provision copy pasted here. Understood? Now, so 43 CA, same provisions. When this is applicable, 43 CA PGBP, if the immovable property stock in trade. Suppose for a real estate company, they are selling immovable property at 100 lakh, but stamp duty value is 115 lakh. Then stamp duty value will be taken as sale consideration for the purpose of PGBP computation. That's it. In capital gains 50C, how it is? Here it is 43 CA. Provision is exactly same. Can you read this on your own? Yes. Now again, let's go back to capital gains. Whatever pending discussion is there. Okay. 55A 112. Okay. 55A, I'll come back at last. 112, tax on long-term capital gain. Okay. Here, no, I think this I can present much more better, this particular provision. What I will do is, by the way, unutilized basic exemption limit set off, it is available for residents only. Yes or no? Unutilized basic exemption limit is available for resident. If you see this section here as it is, no, like this matter will be confusing. Okay, even in my regular class also I did not tell this clearly. Now I will tell you. Now I will tell you in a very clear way. We will directly open the act and then discuss. Okay. Okay, 112, because this is where many students actually 112 section many don't understand. In act it was given very simple. In IC only they made it complicated unnecessarily. That time, no, generally whenever I'm making material, no, I take IC metal reference, then I also take act. And I'm making 112, no, that's very tight already that time. So fine, it's okay, whatever IC metal is there, little bit I just neatly adjust and then give it here. You see, that's the reason every provision is very clear. Even this also clear only compared to many books. Okay, but act is much more simple. Act is even more simple. Look at the act, what it says. Look at what act says. So here we will make a diagram here. Okay, if you have a space here, you can make a diagram. So this video I will add even in the regular video also. Regular also I'll add. Fine. 112, tax on long-term capital gain. What are they saying? Where the total income of an SSE include any income arising on transfer of long-term capital asset which is chargeable to tax under capital gain, the tax payable by the SSE on the total income shall be aggregate of. First point they are saying is what? In case of individual HUF being a resident. So under 112 subsection 1 clause A, they are talking about long-term capital gain tax rate on individual and HUF who are residents. Correct? First let us keep that. So or else I'll do one thing, I'll write a notes neatly, I'll write a notes, the same thing I'll give you. Okay, section 112. Okay, subsection 1, this is the section which is talking about long term capital gain tax rate. Inside that, clause number A, yes or no, this is talking about resident, individual or HUF. Agreed? This is what clause number A is talking about. Correct? Clause number A, 1 minute. Yes. Now what clause number A is talking about? In case of an individual, the amount of income tax payable on total income as reduced by capital gain, had the total income so reduced been his income, nothing but you should first compute tax on total income excluding capital gain, nothing but excluding special incomes on balancing figure. Basic concepts you remember, tax and the amount of income tax calculated on long term capital gain. On long term capital gain, you please calculate tax at the rate of 20% for any transfer which takes place before 23rd July. Whereas if the transfer is on or after 23rd July, you should tax it at 12 and 1.5, nothing but 12 1/2, nothing but 12.5%. Yes or no? Fine. Look at this. Let us keep this. Okay. Now, okay, if transfer date before 23rd July 2024, then tax rate is 20%. Correct? On or after 23rd July 2024, on or after 2024, then tax rate is what? 10%. Agreed? Yes or no? Remember, if at all you are transferring before 23rd July, some assets, no, some long term capital assets, no, they are available, they are eligible for indexation. I'm telling you guys, this 112 section is something which many don't understand. With indexation, without indexation, 10% to 12%. Okay, sorry. This is 12.5%. What is this? 12.5%. What is this? 12.5%. Okay, please rectify. Okay, fine. Clear? So many students will have in indexation, this 112 section only, many don't understand. In Act it is given in a simplest manner. Okay, this is for individuals and HUF. Correct? Next, provided that where total income as reduced by long term capital gain is below maximum exempt not chargeable to tax. Indirectly, what are they talking? Unavailed basic exemption limit, unutilized basic exemption limit. That point which we already know. Unavailed basic exemption limit is available only for resident individuals and HUFs. That's what they need to. Yes or no? Provided that total income as reduced by is below basic exemption limit, that will be reduced. Okay, that you leave it. Provision 2, you see. Provided further that in case of transfer of long term capital asset being land or building, remember, purchased before 23rd July but sold on or after 23rd July, at the time of tax computation, option is there. That also given here only. Understood? These are the provisos. Proviso 1, proviso 2 to subclause number A. Correct? Now, clause number A over. Okay. In that main noteworthy point, we noted. Clause number A over, unutilized basic exemption concept also you understood. So in the book that also you mentioned. Okay. Also available, yes or no? Note. What note? Unavailed basic exemption. Unutilized, unavailed, any word you can use. Unavailed basic exemption limit concept. Unavailed basic exemption limit. Unutilized basic exemption limit available. Correct? This is what the proviso 1 says. This is what says in proviso 1. Proviso 2 says what? Land and building optional tax comparison. Yes or no? Proviso 2 talks about land and building. If you are selling, purchased before 23rd July and sold on or after 23rd July, option tax system. Yes or no? Tax option is available. Tax option available. You optional tax you don't put. Okay, again you will confuse with resume. Tax option is a tax rate option. Correct? Can I use that word? Can I use that word? Tax rate option available. Correct? Already we discussed tax rate option means what? At the time of computation of at the time of computing tax liability, with indexation once again compute capital gain, apply 20% tax rate. Without indexation already you computed, apply 12 and off. Wherever the tax is coming low, that lower amount only you will apply. That one is provision 2. So clause number A over, correct? Now look at clause number B. Look at clause number B. Clause number B is applicable to whom? In case of domestic company. CA interlevel, company taxation we don't have. Ignore. C. In case of non-resident or foreign company. For non-residents, okay, we have in our slide discussion is possible. For non-resident, we have a slide discussion. What is the tax rate for non-residents? At the rate of 20%, 12 and of same only. However, you see third point, the amount of income tax on capital gains, the amount of income tax on capital gains arising on transfer of asset being unlisted securities, shares of a company, not being a company in which public or substantial interest, the rate of 10%, if at all transfer is before 23rd July, if the transfer is on or after 23rd July, 12 and off. Let's write that. Clause number A, right? Now which clause I am talking about? Clause number C. Clause number C is applicable for whom? Non-residents, yes or no? And foreign companies. Companies is irrelevant for us. Companies taxation is irrelevant for us, yes or no? Now for non-residents, no, here the section is divided into non-residents, no, the section is divided into two parts. For non-residents, no, the section is divided into two parts. Okay, first part is saying clause number C, subclause 1 is saying always long time capital gain separate from total income, compute tax separately. Clause number 2, subclause 2, subclause 3 is saying what is the tax rate. Understood? Okay, you know, inside that subclause 2, subclause 3, one is irrelevant. Remember, subclause 1 irrelevant, not required for you. Subclause 2, what is it saying? First subclause 3, what is it saying? I will identify. First subclause 2, what is it saying? I will identify. The amount of income tax on long-term capital gain arising from, you see, long-term capital gain arising from transfer of capital asset being unlisted securities, shares of a company, not being a company in which public or substantial, nothing but closely held company. Closely held company, yeah, now you see, under subclause 3, which assets are covered, ma? Unlisted securities. Unlisted securities are shares of closely held company. Unlisted securities are shares of closely held companies. Okay, for them, what is the tax rate? What is the tax rate for them? Here the tax rate, you see again. Okay, I hope you are able to see. Okay, tax rate, the amount of income tax, the tax rate is at the rate of 10% for any transfer which takes place 23rd July. Which takes place before 23rd July. Which takes place before 23rd July. What is the tax rate? 10%. Okay, before 23rd July. Okay, let me divide this into two parts. What is the tax rate? Transfer date before 23rd July 2024. What is the tax rate, ma? 10%. What is the tax rate on or after 23rd July 24? The tax rate is 12.5%. Easy. Yes or no? That's what they mentioned here. Is there any other thing mentioned here? That's it, over. Then they are going for in case of any other resident. In any other case of a resident. Any other case of a resident only, any other case. Already individual HF covered, company covered, partnership firms, for all of them this is not required for us, because for us the taxation is not required. Okay, now again, this C class is not yet over. The amount of income tax calculated long-term capital except subclause 3, nothing but what? Remaining assets. Indirectly here they are talking about unlisted securities, correct? Unlisted securities and shares. Remaining assets, can I say like that? Hello? Remaining assets, can I say? Yes, remaining assets. What is the tax rate? What is the tax rate for remaining assets? I'll do one thing. Okay, so I'll go up to here. Now, remaining assets. Okay, what is the tax point they're saying? Remaining assets at the rate of 12 and half, at the rate of 20% for any transfer which takes place before 23rd July. Correct? Same only. Yes or no? transfer date, correct? Before 23rd, before 23rd July 24, what is the tax rate? 20%. Okay, what is the tax rate on or after 23rd July? 12.5%. Yes or no? Now again you see third one, you understood? That's it. Now below there is some point given, provided that, you see this is a proviso, provided that is given for entire section ma, correct? It is given for the entire section. 112 below is their proviso, you see here. Understood? So it is the proviso for the entire section, provided that where tax payable in respect of any income arising from transfer of long-term capital gain which takes place before 23rd July being listed security other than unit or zero coupon bond exceeds 10% of the amount of capital gain before giving effect to provisions of second proviso 2 section 48, then such excess shall be ignored. What is this? Don't worry, this is a provision applicable for entire section, all cases. Can I say like that? Since it's a provision given to the section itself, subsection 1 itself, it is a provision. Subsection 1 for all clauses it is applicable. Means what are they saying? Provision for all the clauses. Provision for all the clauses. Correct? Provision 2 112 subsection 1. You see 112 subsection 1 provision, subsection 2 provision, we'll see. It is provision 2 subsection 1 ma. Subsection 2 separately given here. Yes or no? So it's a proviso to subsection 1. What this section says? Proviso to subsection 1. What this section says? This says, suppose if you are selling listed security, they used word, provided in respect of capital gain arising from being listed security other than unit. Yes, listed securities other than units or zero coupon bonds. Yes or no? Zero coupon bonds where the transfer happened before 23rd July 2024. Before 23rd July 2024. Okay sir, what is the consequence? What is the consequence? Here you see, that section is interpreted like below. Then tax shall be lower of A and B. Okay, tax shall be lower of A or B. Understood? A is what? Capital gain you calculate. Okay, 20% tax rate on capital gain with indexation. You calculate. Here you calculate 10% tax rate on capital gain without indexation. Wherever the tax amount is coming low, ultimately that option is chosen. That's it. 112 over. How many of you got clarity now? 112. Because in 112 tax rate is very confusing. Where 10% indexation, without indexation, somewhere it will say 12.5%. What all that? Understood now? That's it. Sometimes act will give better clarity. So once you see here 112 subsection 1, what are they saying? Clause number A, what it is talking about? Resident individual HUF. So okay, clause A only. Transfer is before 23rd July. Transfer is before 23rd July 2024. Okay, indexation facility is naturally available, 20% tax rate. Yes or no? Transfer is on or after 23rd July. Tax rate is 12.5. Proviso 1, unutilized basic expansion concept. Proviso 2, land and building concept. Remember that? Then clause number C, it is talking about non-resident. Inside that subclause 1, ignore. Subclause 2, remaining assets. Oh, remaining means what? First, which asset? Clause number 3, unlisted securities. For them, the unlisted securities of a closely held company. Transferred before 23rd July, the tax rate is 10, on or after 12.5. Remaining assets 20, 12.5. Easy. Now For entire this subsection 1, there is a provision. What this provision, which means this provision is applicable for residents, non-residents, domestic company, foreign company, partnership firm, LLP, everybody. Sir, they are selling listed securities, sir. They are selling zero coupon bonds, sir. Before 23rd July, sir. For them, no tax amount they can pay on those two items at 20% with indexation, 10% without indexation. For zero coupon bonds, anyhow indexation is not there. Straight away tax rate is 10% on the capital gain. That's it. Easy or not? All of you. Okay. Now let me select these two. Hello everybody. One, two. Okay. Hey, where is it? Export. Section 112. LTCG rate. Correct? In ICA book, if you see, resident, non-resident, multiple classifications they'll give. Very headache. Okay. Now, yeah, it's okay. I will share it in your group also. Just a minute. Yes. This entire notes, this entire whatever this 2 pages notes, whatever is there, right? This I uploaded below the video itself. The video wherever you're watching, there itself you will find the file. Okay, that's it. Now you got the clarity. Now ignore this entire point given in the material. This 112, please mark it as read from handwritten notes. Okay, able to understand? Very soon I will update this entire into the chat format. I'll update this date. Otherwise, it will be very tough to understand. By the way, 112 is applicable when, first of all, if 112A tax rate do not apply. 112A section is applicable when listed equity share, listed equity oriented mutual fund, units of business trust if I am selling, STT paid at the time of sale, then straight away the tax rate is 10% or 12.5% as the case may be, depending upon date of transfer beyond 1.25 lakh income. Correct? That's it. So here you can strike off this. Clear all of you? That's it. Now, reference to valuation officer. What is this case? If the value claimed by SSE based on registered value estimate varies significantly from fair market value, whatever the value claimed by SSE, full value it may be, or it may be cost of acquisition, anything, if at all it is significantly different from fair market value, assessing officer felt market value is different, what value SSE showing is different, department is losing money, like that assessing officer felt, yes or no? Then if the AO believes that market value is more than what is shown by the SSE by more than 15% or 25,000, whichever is higher only, more than 15% or 25,000, difference is more than 25,000 or 15%. Sir, I showed 1 crore, sir, cost of acquisition. Assessing officer will 80 lakhs only cost of acquisition, market value. Sir, I showed 1 crore, sir, stamp duty value and ignore 1 crore. Assessing officer feels market value 120, 1.2 crore, 20 lakh or 15,000, whichever is higher, sorry, 15%, nothing but 20 lakh. Or 25,000, whichever is higher, 20 lakh. By the way, the 20 lakh difference must be more than 15%. More than 15% of the consideration. Whatever SSE claim would know, more than that market value. According to me, market value between what SSE showed and market value, the difference is more than 15% or 25,000, whichever is higher. Then assessing officer can refer to valuation officer. Able to understand? Assessing officer may refer the valuation of capital asset to valuation officer. If AO consider nature of the asset, he may also refer at other time also. At some other case also he can refer. Need not be complying with 15% criteria. Literally speaking, valuation assessing officer can refer to valuation officer if at all he feels there is a huge difference between market value and this one. Clear? This is not required for us. Basically, this income tax officer power, not our provision. Clear all of you? That's it. Capital gains completed. Confident?